Harish, we are ready to go. Unmute, kindly unmute.
Good morning. Good morning, my dear friends, colleagues, invitees, dignitaries, and speakers for the conference. I, Harish Shugani, Honorary Secretary of Tax Friends Mumbai, on behalf of Tax Friends Mumbai, in association with Tax Practitioners Association Thane, Bhiwandi Tax Practitioners Association, Income Tax Bar Association Varanasi, Income Tax Bar Association Prayagraj, GST Bar Association Varanasi, and Josh Professional Foundation welcome all the dignitaries and delegates to the first ever virtual National Tax Conference. It is rightly said, the show must go on. And yes, during the time of COVID-19, we aforesaid professional associations decided that knowledge sharing should not stop. And we salute to the true spirits of our professional brothers and sisters that with their support, we have organized this National Tax Conference, but with a difference. Yes, a virtual National Tax Conference. We take pride in being the first one to conduct such a virtual National Tax Conference for sharing knowledge globally and presenting before the globe the gala of our dignitaries and speakers. Conducting National Tax Conference and routine webinars are different. We have put in all the efforts to conduct this conference without any glitches. But if there are any technical glitches, errors, or any mistakes, I seek your forgiveness in advance. I am obliged and thank my consortium of professional associations for selecting me as MOC, Master of Ceremony, for this conference. That means we are going to see each other almost in the entire conference till the end. Time being the essence of this conference, and with the permission of delegates present here, I welcome the following dignitaries to the dais. I welcome our chief guest, Honorable Mr. Justice B.R. Gavai, Judge, Supreme Court of India. I welcome our guest of honor, Honorable Mr. Justice, retired P.P. Bhatt, President, ITAT. I welcome Conference Chairman and President of Tax Practitioner Association Thane, CA, Mr. Vijay Kewalramani. I welcome Conference Advisor, Shri J.D. Nankani. I welcome President of Tax Friends Mumbai, Advocate Mr. Atam Tekchandani. I welcome President of Income Tax Bar Association Varanasi, Advocate Mr. G.P. Shukla. I welcome President of GST Tax Bar Association Varanasi, Advocate Arvind Shukla. I welcome President of Income Tax Bar Association Prayagraj, Advocate Mr. S.K. Yogeshwar. I also welcome Conference Secretary and Chairman of Josh Professional Foundation, CA Mr. Kamlesh Sabu. I welcome President of Bhiwandi Tax Practitioner Association, CA Mr. Rakesh Agarwal. I welcome Conference Convener, CA Mr. Bhatt Sachdev. I acknowledge and applaud the presence of all these dignitaries on the dais. Friends, before starting the conference, let us all invoke the blessings of Lord Ganesha. Yeah, welcome back, friends. I now invite Conference Chairman and President of Taxation and Taxation Thane, CA Mr. Vijay Kewalramani, to welcome our delegates. Mr. Vijay, please.
Thank you, Harish. Welcome, friends. Today's chief guest, Honorable Mr. Justice B.R. Gavai, sir. Our guest of honor, Honorable Mr. Justice P.P. Bhatt, sir. Our mentor and guide, Advocate J.D. Nankani ji. President Tax Friends Association, Advocate Atamji Tekchanani. President GST Bar Association, Varanasi, Arvindji Shukla. President Income Tax Bar Association, Varanasi, Advocate Gyan Prakashji Shukla. President Income Tax Bar Association, Prayagraj, Advocate Shri Krishnaji Yogeshwar. President Bhiwandi Tax Practitioner Association, CA Rakesh Agarwal. Conference Secretary and Chairman, Advocate Arvindji Mishra and Advocate Om Prakashji Shukla. Conference Conveners, CA Bharat Sachdev, Advocate Manoj Murani, Shri Harish Chugani. Seniors in the profession, and I can see our seniors, Advocate PC Joshi sir, Senior Advocate Primlata Madam, Senior Advocate Ganesh Purohit ji, Senior Advocate Ashok Saraf ji, and our Deputy President MS Rao for AFTP. I welcome you all. And my dear seniors in the profession and fellow professionals, wishing you all a very good Saturday morning. I extend a warm welcome to all the delegates from all over India on behalf of the consortium of associations led by Tax Friends Association, and congratulate you all for being a part of this very unique online tax conference. We have delegates from Jammu to Trivandrum and Mumbai to Guwahati, covering the length and breadth of the country. Friends, as we all know that with the lockdown in place, it was difficult to move out. It had made life very lonely and depressing, and especially to our Indians who are used to socializing. Just 1 minute. We were discussing in the managing committees of Tax Friends Association and Tax Practitioner Association Thane as to how to utilize the time sitting at home. So it was thought to start off with certain online webinars which would serve a dual purpose, that is to keep members busy and also impart knowledge amongst the members. And the webinar series which we started from the last week of March 2020 just went on with the members enjoying it and demanding more, and it also brought in other professional bodies across the country to join us, and thereby a consortium was formed. And with the blessings of the Almighty, we have successfully completed 50 webinars on 5th July 2020 on various topics of not only professional importance like GST, income tax, money laundering, etc., but we have also had an educational series on tally and also on social topics which affect the society. Like we had a talk on depression and suicide prevention. Friends, we will not stop here. We have planned an education series on Indias, which will be coming up in the first week of August. With the success of the webinars, the core team thought of conducting an virtual next tax conference, which was as a challenge because it was the first time that such a national tax conference is being held spread over 2 days. Definitely was unique in itself, and we definitely had some skepticism on the success of it. But as John Bernard Shaw has said, life isn't about finding yourself, life is about creating yourself. We took it as a challenge, and today we are before you with a houseful audience of 525 plus delegates. And friends, we had to close the registration, though we have been receiving registration inquiries even till today morning. The theme professional practice post COVID 19 was then thought of keeping in view the current situation where we as professionals have to adjust to a totally different way of practice. That is, most of the work is done from home, and virtual hearings have started in various courts, including the Honorable Supreme Court of India and various high courts and other judicial platforms across the country. And so it becomes important to guide the professional brethren in the changing situation. I would like to thank our chief guest, Honorable Mr. Justice B.R. Gavai sir, and our guest of honor, Honorable Mr. Justice P.P. Bhatt sir, for readily accepting our invitation in spite of their busy schedules and gracing this occasion. and we look forward to your guidance and blessings, sirs. I would also like to thank all the eminent paper writers and chairpersons of the session who, without blinking an eye, accepted our invite to enable us to spread the learning. I would, friends, be failing in my duty if I fail to acknowledge the blessings and guidance of our mentor, Shri J.D. Nankaniji, who has always supported and guided me. And I also acknowledge the support TPA Vice President C.A. Bharat Sachdev, who has been with me as a pillar, Tax Friends Association President Shri Atamji Tekchanani, who has forced the trust in me and allowed me freedom to organize the webinars. Now the conference. Shri Manoj Moryani ji, who has always been of support in organization of webinars. And whenever I call him Manoj ji, ye support chahiye, he is always there. Shri O.P. Shukla ji, Varanasi, and Shri Arvind Mishra ji, Prayagraj, and Shri Radhakrishnan from Vellore. They especially need a special mention. They have put in all the effort to ensure the registration for this conference. Of course, all my core committee members, who I will not be naming due to paucity of time, who have always been with me at just a call. I would also like to acknowledge the services of Shri Kartik Mishra from Prayagraj, son of Arvindji Mishra, who has selflessly worked back scene and technology part from designing the brochures to the presentations and online registrations. I would like to thank my family for being supportive in these testing pandemic times. And lastly, I would like to thank all the delegates for registering in large numbers across the country and making it a great success. Thank you all. Now I would like to say a few words about our association, Tax Practitioner Association Thane. Friends, Tax Practitioner Association Thane is a registered trust since November 94, and thus we have completed 25 years serving the profession. It was started by stalwarts like CA V.K. Kelkar, Advocate S.S. Shamdadhani, CA C.W. Marathe, to name a few. Over a period, we have been acting as a link between the members, public at large, and tax authorities. We are the only association in this area comprising of members from all fields of the profession, including CAs, advocates, and tax practitioners and company secretaries. We have been making representations to various tax authorities, including the CBDT, CBIC, MCA, other than the GST Council and the Finance Ministry, on matters affecting the taxation laws and public at large. We have been organizing study meetings and conferences to impart knowledge amongst the members. We have also been organizing joint outreach programs jointly with the Income Tax Department over the past few years. We had organized a very successful physical national tax conference, the first of its kind to be held in Thane, with over 300 registrations from all across the country in October 2018. Now, I will not be coming further between you and the learning. I would just like to say that there are moments when it felt as if nothing was going through, and we used to feel dejected and lost at not being able to achieve our goals. But the blessings and teachings of my father, who has always been my guide and ideal, always used to push me and say, "Har raat ki baad ek subah hoti hai." And as Lord Krishna has said in the Bhagavad Gita, you may think that you are doing things, but actually it is actually me who is making you do things. So have faith in me and all will be positive. Further, friends, I would also like to quote Babe Ruth, who said, "Never let the fear of striking out keep you from playing the game," which made us continue and enjoy the scene. I once again thank you all for making the conference successful and wish you a very memorable learning experience. Thank you all. Back to Harish. Thank you, friends. Harish, unmute.
Thank you. Thank you, Mr. Vijay. Now I invite Tax Friends Mumbai advocate Mr. Atam Tekchandani to say a few words. Mr. Atam Tekchandani, please.
Thank you, Harish. Good morning to everyone. Honorable Mr. Justice P.R. Gavai, sir. Honorable Mr. Justice P.P. Bhatt, sir. C.A. Vijay Kewalramani, Conference Chairman, dignitaries on the dais, seniors in the profession, and my professional colleagues. It is my honor to welcome you all on behalf of Tax Friends Association, Mumbai. I would like to thank all the joining associations for their support and cooperation in making this conference a great success. I would personally like to thank our immediately past president and conference chairman for visualizing this concept of first ever virtual national tax conference in these testings times of COVID-19. He was also instrumental in organizing 50 successful webinars, and he, along with the core committee, has taken personal efforts to ensure the success of the conference in getting over 500 registration across the country. Now, I would like to brief you about Tax Friends Association. Tax Friends Association was formed in the year 1976 as a study group between friends under the leadership of late Hemant Israni, who was the founder, for imparting knowledge, and it kept growing over its journey of 44 years. We have had stalwarts like Shri Chandru Gurubakshani, Shri C.C. Basantani, Shri L.R. Bajaj, Shri Govind Tek Chandani, Shri Jagdish Nankani, Shri K.K. Ramani, Shri S.D. Israni, late T.M. Chatpar, late Anand Panjwani, Shri D.T. Khilnani, Shri Vikram Nankani, and Shri Jagdish Punjabi, to name a few amongst our members. Tax Friends Association is a Section 8 registered company with members across the country and has been organizing study circle meetings and conferences for our members and tax professionals. We also often arrange get-togethers and picnic with families for greater bonding. I once again like to thank you all for registering in large numbers and making it grand success. Wishing you all a very educative conference. Now, friends, sit back, relax, and enjoy. Thank you. Over to you, Harish.
Thank you. Thank you, Mr. Atam Tek Chandani, for your address. And now I invite Conference Coordinator and President of GST Tax Bar Association, Varanasi, Advocate Mr. Arvind Shukla, to say a few words. Mr. Arvind, please.
Thank you, Master of Ceremonies. Chief Guest, Honorable Mr. Justice B.R. Gavai Sahab, Judge Supreme Court of India. Guest of Honor, Honorable Mr. Justice P.P. Bhatt Sahab, President, Income Tax Appellate Tribunal. Conference Chairman, Vijay Kewalramani Sahab. Dignitaries on the dais, all fellow delegates. I'm honored and privileged to be part of this unique tax conference, perhaps first of its kind, where delegates from all parts of the country are participating from the comfort of their homes through the best use of technology. I have had the honor to welcome Honorable Justice Gavai as well as Justice Bhatt in the Devi Tax Conference at Varanasi. I am again honored to be in their august company once again. There is an old English proverb, sweet are the fruits of adversity. The COVID adversity has taught us many lessons, including the gainful utilization of technology. I hope we will be able to sharpen our professional edges after hearing the learned speakers in this webinar. Welcome to all, and fasten your seat belts for some enthralling sessions ahead. Thank you very much. Thanks.
Thank you. Thank you, Mr. Arvind Shukla. And now I invite President of Income Tax Bar Association, Varanasi, Advocate Mr. G.P. Shukla, to say a few words. Mr. G.P. Shukla, please. Mr. G.P. Shukla.
Yes, GP.
Hello. Mr. G.P. Shukla, you can please start.
I think his net connection is gone. Harish, you please proceed.
Proceed to the next one.
Sorry, we will get him later. Meanwhile, I invite Conference Secretary and Chairman of Josh Professional Foundation, Mr. Kamlesh, to say a few words. Mr. Kamlesh, please.
Yeah, thank you, Harish bhai. Hello and namaskar to one and all. Hello
Right.
and
Sorry.
present here. Is it?
I think.
Am I audible?
Just a minute, Mr. Kamlesh. Yeah, Kamlesh bhai, you can start.
Yeah. Hello and namaskar to one and all present here, delegates and all the dignitaries. And I, on behalf of the Josh Professional Foundation, do welcome you all in this beautifully arranged virtual National Tax Conference. We, along with other esteemed organizations, conducted more than 50 webinars in this pandemic period. And we are really happy to be a part of this virtual National Tax Conference. And my sincere thanks to Shri Vijay Kewalramani, who has come out with an extremely great idea to conduct such seminar, and thanks to all the other joint organizers for being part of this historical event. I am expressing my gratitude to all the 525 plus delegates for their eagerness to gain the knowledge and making this event a grand success. I wish all the happy learning to all of you, and over to Harish. Harish,
Thank
please.
you. Thank you, Mr. Kamlesh. I now invite President of Income Tax Bar Association, Prayagraj, Advocate Mr. S.K. Yogeshwar, to say a few words. Mr. S.K. Yogeshwar, please. Yes, Mr. Yogeshwar. Hello.
He has to unmute.
Unmute.
Yeah, please unmute yourself.
Good morning to all members. I welcome you all to this virtual National Tax Conference organized by Tax Friends Mumbai. My name is Advocate S.K. Yogeshwar. I am President of the Income Tax Bar Association, Prayagraj. I would like to say a few words about glorious past of our bar. Our bar was formed in the year 1962, and our first president was late Shri R.L. Gulati. Our bar boasts up many reputed advocates who were office bearers and later become Honorable Judge of the Allahabad High Court. To name few, late Justice R.L. Gulati, Justice Rajesh Kumar, Justice S.P. Kesarwani, and many prominent advocates who have made a mark in the fraternity, like Sri late P.N. Pachauri, late Sri R.G. Gadbole, and now Sri Ajit Dhawan, Sri K.N. Kumar, and Anand Gadbole, and many more. Our bar has always cooperated in promoting such professional and educational programs to promote awareness and brotherhood among tax jurisdictions herein. I extend my thanks to the Tax Friends Mumbai, Tax Practitioner Association Thane, ITBA Varanasi, GST Bar Varanasi, Josh Professional Foundation, and Bhiwandi Tax Practitioner Association for organizing the virtual National Tax Conference. Now I welcome our Chief Guest, Honorable Justice B.R. Gavai, Judge Supreme Court, who is also our keynote speaker, and guest of honor, Honorable Justice P.P. Bhatt, who have graced this occasion their presence, and all other members. Thanks.
Thank you, Yogeshwar ji, for your address. And now I invite President of Bhiwandi Tax Practitioner Association, CA Mr. Rakesh Agarwal, to say a few words. Mr. Rakesh, please.
Thank you, Harish ji. Good morning to all. I, Rakesh Agarwal, President of Bhiwandi Tax Practitioners Association. I welcome all the dignitaries and delegates on the dais and off the dais to the first ever virtual National Tax Conference. I would like to take this opportunity to thank Tax Friends Mumbai for inviting us to be a part of this first ever virtual National Tax Conference. And I am obliged and thank my consortium of professional association for conducting and completing 50 Golden Jubilee webinar during this lockdown period due to COVID. Now friends, I would like to share some information about BTPA. Friends, Bhiwandi Tax Practitioners Association formed in the year 2008. And during these 12 years of journey, BTPA had organized various seminars and residential refresher course every year in the month of December for its member. As we know, friends, that the Bhiwandi is a hub of textile industries and warehouses. So many representations has been made to the income tax and GST department is made in respect of textile issues during the GST scenario. BTPA is also organizing regularly seminars with income tax department, GST department and others department. The present core committee of Bhiwandi Tax Practitioners Association are myself, Rakesh Agarwal, President, Advocate Prashant Jadhav, Vice President of BTPA, CA Pawan Singhal, Secretary, CA Dinesh Loda, Treasurer, AR Ansari Sir, Viren Popat Sir, Hitesh Pandya, CA Mahesh Birla, CA Ashutosh Trivedi, CA Pratik Shah. Friends, again, I would like to welcome all of you for the conference and wish you a very good learning experience. Friends, be at home and be safe. Thank you. Over to Harish ji. Thank you very much.
Thank you, Mr. Rakesh. Now I request our conference coordinator, Advocate Mr. Arvind Mishra, to introduce our guest of honor, Honorable Mr. Justice P.P. Bhatt, President, ITAT. Mr. Arvind Mishra, please.
Thank you, Harish Bhai. It is honor to give introduction of guest of honor, Honorable Mr. Justice Pradeep Kumar Prem Shankar Bhatt was born on 6 September 1956. He had primary education in different districts of Gujarat and graduated in art with political science from HK Art College, Ahmedabad. Honorable Justice Bhatt obtained degrees of law from Shri Sir L. A. Shah Law College, Ahmedabad, affiliated to Gujarat University. He was enrolled as an advocate with the Bar Council of Gujarat and started practice in the High Court of Gujarat in 1984. As a lawyer, Honorable Justice Bhatt appeared in several matters relating to constitutional law, service law, civil as well as criminal law. Honorable Justice Bhatt joining the judiciary and appointed as judge, City Civil and Session Court on 10th July 1995 and dealt with numerous civil as well as criminal cases. He was also the member secretary, Gujarat State Legal Services Authority. Honorable Mr. Justice Bhatt also served as a Registrar General of High Court of Gujarat, and as a Registrar General, he has played a pivotal role in a development of infrastructure for judiciary at the High Court, as also the district level. He has been convener of East Zone Conference and environmental issue, as also All India Meet of Legal Services Authority held at Ranchi. Honorable Mr. Justice Bhatt, in his early career, has also served as a judge in the City Civil and Session Court, Ahmedabad, and as special judge, CBI Court. Honorable Mr. Justice Bhatt was elevated as an additional judge, High Court of Gujarat on 7th February 2011. He was transferred to the Gujarat High Court, transferred to the High Court of Jharkhand on 27th June 2011, and retransfer to the Gujarat High Court. He retired from High Court of Gujarat on 6th September 2018 and subsequently assumed charge of Office of the President, Income Tax Appellate Tribunal on 24th October 2018, and since then, Honorable Justice Bhatt is heading of the Income Tax Appellate Tribunal, the oldest tribunal in India, which is often referred to as the Mother Tribunal. Income Tax Appellate Tribunal was set up on 25th January 1941, which has now 63 benches at 28 different stations spread across the country, covering almost all the cities, having a set of the High Court. It is the second appellate authority under the direct taxes and first independent forum. It is appellate hierarchy. He was conferred upon a national award by Capital Foundation, New Delhi, for his contribution of infrastructure development and systemic changes in the judiciary. I am again welcome Honorable President ITAT, Mr. Justice P.P. Bhatt, sir. I request Mr. Justice P.P. Bhatt, sir, for a kind address to our virtual audience.
Mr. Bhatt, sir, please.
Honorable Justice Shri B.R. Gavai, Judge, Supreme Court of India, Shri P.K. Bansal, former Vice President ITAT, Shri J.D. Nantani, Advocate and Conference Advisor, C.A. Vijay Kewalramani, Conference Chairman, C.A. Kamlesh Sabu, Conference Secretary, Advocate Shri Atam Tekchandani, President Tax Friends Association, C.A. Bharat Satyeva, Haresh Jugani, and Advocate Shri Manoj Moriani, Conference Convener, O.P. Sukla, Shri Arvind Mishraji, coordinators of the conference, President and secretaries of all other joining associations, organizing committee members, Advocate Shri Arvind Shuklaji, Shri Rakesh Agarwal, Advocate Shri S.K. Yogeshwar, Advocate Shri G.P. Shukla, professionals and delegates. A very good morning to all of you. A very warm and pleasant greetings to all of you. It is indeed my privilege to be with all of you on a different platform called webinar, as all of us are passing through an unusual, unprecedented, trying time owing to the pandemic caused by the novel coronavirus. I am happy to interact with organizers, tax practitioners, and income tax bar associations on a very vital and important topic, professional practice post-COVID-19. It is indeed a matter of great honor for all of us that the conference is inaugurated in the gracious presence of Honorable Mr. Justice B.R. Gavai, Judge, Supreme Court of India. In fact, I had a privilege of sharing the dais with His Lordship on earlier occasion at Varanasi while attending a conference organized by All India Federation of Tax Practitioners. It is always a pleasure to be in the company of His Lordship. His Lordship's vision and input about the professional practice post-COVID-19 will give the right direction to the professionals to adopt new methodology of digitalized world in legal practice. His Lordship's rich experience in the field of law is known to everyone, and I am sure that the participants will be enlightened and enriched by His Lordship's keynote address. I have seen the conference schedule, which has almost covered all vital and important topics. The selection of topics for discussion in 5 different technical sessions is contemporary and relevant for the professionals. The chairperson and speakers of each of the sessions are very renowned professionals, having rich experience in the field. I am sure that the deliberations which may take place during the course of technical sessions will be very useful to the participants. The theme of the conference selected by the organizers, that is professional practice post-COVID-19 is very much significant in the prevailing circumstances. After the outbreak of COVID-19 in the country and in the world, it has almost been 3 months that people are locked in their houses and are either working from home or working through using digital modes like video conferencing, Zoom calls, and WhatsApp calls to connect with their employees and other co-workers. Once this pandemic is over, everything from our lifestyle to eating habits will change. Life, as we know, it will change under the circumstances. One can only use this pandemic to reorient and use this opportunity to bring a positive change in the society. Since laws are what govern the society, the pandemic has given a chance to the legal fraternity to bring out change in the way of litigation and in the professional practice. By making use of technology, things can be innovated in a way to enhance the legal acumen as well as the legal knowledge around the country. Right now, the way the situation is prevailing, the only method left with the courts, lawyers, and the legal professionals is to shift to digital mode in order to run the administration of justice and to maintain and administer law and order in the country. In the legal arena of our country, things are set to take a paradigm shift. Trend of virtual hearing and e-court system, in any case, started taking center stage in ongoing debates between bar and bench at all levels. On one hand, lack of individual e-knowledge, skill, and expertise, and on other hand, the need of balance, cost, and time needed for enhancing efficiency in litigation management are being argued by both sides. I am happy to inform this August gathering that the Income Tax Appellate Tribunal has taken a lead, and at almost all stations in the country, benches are functioning through the mode of virtual hearings. My colleague members of the bench and other stakeholders, that is members of the bar and the income tax department representatives, have wholeheartedly participated in the new innovative method of conducting judicial proceedings through video conferencing. The bigger stations like Mumbai and Delhi have been disposing of a healthy number of appeals by using the facility of video conference hearing. Even at other benches, the virtual hearings are taking place effectively. The method of virtual hearings adopted by bar and the bench during this critical period is definitely a useful and effective method of conducting judicial proceedings before the courts and tribunals. The standard operating procedure evolved by the Income Tax Appellate Tribunal for conducting virtual hearing is user-friendly, and the members of the bar as well as the departmental representatives have extended cooperation in adopting and implementing such practice. In the recent celebration of Constitution Day, the Honorable Chief Justice of India, Honorable Shri Justice S.A. Bobde, has proposed to introduce the system of artificial intelligence to improve the judicial system of the country. Such a system will help in better administration and delivery of judgments. However, the CJI has also mentioned that people should not form an opinion that digitalization will ever replace the judges of country. The event was organized by the Supreme Court Bar Association, in which the Honorable CJI said, I quote, "We propose to introduce, if possible, a system of artificial intelligence. There are many things which we need to look at before we introduce ourselves. We do not want to give the impression that this is ever going to substitute the judges." Unquote. Apart from the court cases, online consultations have been started by the lawyers for their clients. Lawyers are now giving online advice through video calls or telephonic calls to make their client knows about the correct legal position. The lawyers are able to devote time and study cases so that when the courts reopen, they will be able to represent their cases effectively and quickly. It is indeed a time for the lawyers to interact more with the clients and consolidate their trust and confidence. Such a strategy will in fact help the lawyers in increasing their work in times to come. Big law firms are enabled to connect their clients through social media and work from home techniques for the employees is working well for such firms. As most of the work these firms tackle it about research and writings, the work from home discipline is providing to be supportive of their activities. Thus, in my perception, the legal fraternity has witnessed a significant shift in the way they would work and practice post-COVID so that the same is more productive as well as beneficial for them. On a positive note, the pandemic has enabled the legal professionals to change their age-old legal practice to digital quickly. And I hope that this shall continue even after pandemic and lockdown is over. However, law firms and individual lawyers must prepare themselves for the rough road ahead. Though the litigation as well as non-continuous work would steadily increase post-COVID-19. However, they must be conscious that rise in volume of work may not accompany the revenues as per their expectation. In my view, this is one aspect which the management of law firms is required to ponder over and restructure their practice so as to balance the interest of all stakeholders. The legal profession must be conscious of the fact that every year thousands of law graduates join the profession and the new entrants have to be suitably placed amidst crisis. Thus, what is required to be generate confidence in the client that like other sectors, the legal profession is also prepared to face the new challenges and the expectation. COVID-19 is of course a troublesome situation for everyone, but these are the testing times. The legal mind has to be now creative, identify the challenges and solutions and opportunities in this chaos. The big law firms as well as the individual lawyers and small law firms are doing stellar work concerning the COVID crisis. Innovative new services helping clients with their current legal problems, and some have set up the dedicated desk for COVID-related work. Therefore, one who will well prepared will be able to find the right opportunities amid COVID-19. It is needless to say that despite all adversities, the habit of reading, writing, researching, etc. must continue as opportunities will definitely arise as they never come with prior notice. Attending webinars, e-conference and workshop, writing articles, delivering e-lectures, appearing in virtual court matters and regular knowledge updating are the key drivers for the lawyers during the post-COVID-19. To conclude, I would like to say that the law practitioners and law firm should reassess and re-strategize during COVID-19, and I believe this adjustment and transition will ultimately ensure that organizers, advocates, and tax practitioners are in a better position to take up the challenges for the future. Last but not the least, I would like to express my gratitude to the organizers for inviting me to participate and interact with the tax practitioners in the gracious presence of Honorable Justice Shri B.R. Gavai. I wish a grand success to this virtual national level conference. At the end, I would like to say the one song which was very popular in the old days. छोड़ो कल की बातें, कल की बात पुरानी, नए दौर में लिख देंगे मिलकर नई कहानी. सो आओ दोस्तों, सब मिलकर एक अच्छी नई कहानी के लिए सब तैयार हो जाएं, नए पड़कारों को झेलने के लिए तैयार हो जाएं. धन्यवाद. जय हिंद.
Jai Hind, sir. Thank you very much, sir, for your blessings to the August gathering. Now we come to know even the professionals like you can even sing a song. Thank you so much, sir. Thank you. I think Mr. GP Shukla has joined in again because there was some internet issue at his end. So I request Mr. GP Shukla, President of Income Tax Bar Association Varanasi, to say a few words to the gathering. Mr. GP Shukla, please. Mr. Shukla, GP Shukla, are you there?
सभी को यथोचित प्रणाम, नमस्कार एवं वंदन, and gratitude to the Almighty God for favors already received, and gratitude to the chief guest of honor and other dignitaries who spared their precious moments to enlighten, bless, and honor us. Thanks to the organizers for this first virtual tax conference and to the participating professionals and brethren. बंधु, निज भाषा उन्नति है, सब उन्नत के मूल. Sanskrit being natural mother to all Indian languages, I will prefer a few words in Sanskrit. ज्ञानम एवं विद्या द्वय परम परस्पर जड़िता, एको बिना द्वितीयो नास्ति. अतः ज्ञानिना कथितवान विद्यानम ददाति एवं ज्ञानम ददाति विद्या. अधुना युगे विद्या एवं ज्ञान परम आवश्यकम. विद्या विहीन पशुभिः समानः. विद्यायाः एवं ज्ञानी मनुष्याः संसारस्य सर्वश्रेष्ठ प्राणिनः भवन्ति. विद्यायाः प्रसारम् अति आवश्यकम्. एवं तत्कृते सर्वे जनाः सामूहिक प्रयासं यथा संगोष्ठी सेमिनारम् अति आवश्यकम्. ज्ञानं तु द्विधा प्रोक्तम्. शाब्दिकं प्रथमं स्मृतम्, अनुभवाख्यम द्वितीयम च तदुर्लभम निपः. In continuation, sir, in continuation to our drive to boycott China, I suggest all of you to boycott Chinese product, including this Zoom platform. शायद यही सच्ची श्रद्धांजलि होगी हमारी उन साथियों की जिन्होंने मातृभूमि की रक्षा करते हुए अपने प्राण न्यौछावर कर दिए. May Most High Baba Vishwanath continue to bless us. May brotherly love prevail. All moral and social virtue cement and unite us. विश्व की सबसे पुरानी नगरी काशी से मैं आप लोगों को बाबा विश्वनाथ की तरफ से आशीर्वाद और प्रणाम करता हूँ. हर हर महादेव. वंदे मातरम. जय हिंद.
Jai Hind, sir. Thank you, Shukla ji. I now request our conference convener, Advocate Mr. Manoj Moriani, to introduce our chief guest, Honorable Mr. Justice B.R. Gavai, Judge, Supreme Court of India. Mr. Manoj, please. Mr. Manoj. Mr. Manoj.
Good morning to all of you. Our chief guest and keynote speaker, Honorable Justice Bhushan Ramakrishnan Gavai, Sir, Judge Supreme Court of India, Honorable Justice P.P. Bhatt, Mr. P.K. Bansal, former Vice President ITAT, Advocate J.D. Nankani, Conference Advisor, C.A. Vijay Kewalramani, Conference Chairman, C.A. Kamlesh Sabu, Conference Secretary, Advocate Atam Tekchandani, President Tax Bar, Tax Friends Association, President and Secretaries of all other joining associations, organizations, committee members, professionals, and delegates. I am privileged to part of the first virtual National Tax Conference 2020. Thank you, everyone. Greatness is not something you all born with, and what is why great peoples are few, for they take the old and broken the change it to something new. So when a great man arrives, he makes his mark among all and guides us through difficult times and pick us up when we fall. We are here with one of the great persons, Honorable Justice Bhushan Gavai, sir. Sir, it is an honor for me to speak words about you, sir, born on 24th November 1960 at Amravati. Joined bar on 16th March 1985. Worked with the late barrister Raja Sahib S. Bhosle, former Advocate General and Judge of High Court till 1987. Practiced independently at Mumbai High Court from 1987 to 1990. After 1990, practiced mainly before Nagpur bench of Bombay High Court, practiced in constitutional law and administrative laws. Served was Standing Council of Maharashtra Corporations of Nagpur, Amravati Municipal Corporation and Amravati University. Appeared regularly in various autonomous bodies and corporations like SICOM, DCBL, etc. and various municipal councils in Vidarbha regions. Sir was appointed as an assistant government pleader and additional public prosecutor in High Court of Judicature at Bombay Nagpur bench, Nagpur, from August 1992 to July 1993, and was appointed as a government pleader and public prosecutor for Nagpur bench. On 17 January 2000, was elevated as additional judge of the High Court. On 14 November 2003, became a permanent judge of the Bombay High Court. On 12 November 2005, presided over the bench, having all types of assignment, all principal seats at Mumbai, as well as benches at Nagpur, Aurangabad, and Panji. Sir elevated as a judge of the Supreme Court of India on 24th May 2019. Sir is always known for his rich values and his steadfast efforts to ensure that everyone gets justice, irrespective of the case, class, and gender, which are the two things professionals must follow. Because of these high rich values, Sir is considered as one of the most exceptional judge of the Supreme Court. Sir have always practiced the dignity of the people should be maintained at any cost. Words will fall short if tried to personalize Honorable Justice Bhushan Gavai sir. Incomparable work. Sir has been a man of his words. His simplicity, humbleness, kindness, brotherhood, nature speaks for his values. No matter what, Sir will never leave his value. Sir, these values plays a vital role in my life too. As a professional, one of the leading case laws of the Supreme Court held by Honorable Bhushan Gavai sir in case of Ananda Social and Education Trust versus Commissioner of Income Tax and others, in which it was held that newly registered trust registration can only be declined if it is not contrary to the object of the trust, not otherwise. There are men and women who are beautiful by look or by body, but there are some who makes these words a better place just by being in it. We, on behalf of First Virtual National Tax Conference, once again, thank you all, sir. Thank you very much, sir. Over to Harish Bhaiya.
We request Honorable Justice Sir to kindly address the gathering. Sir, kindly give your blessings.
Honorable Justice Mr. P.P. Bhatt, the President of ITAT, Shri Bansal, former Vice President ITAT, Advocate J.D. Nankani, Conference Advisor, Vijay Kewalramani, the Conference Chairman, Sabu, the Conference Secretary, Advocate Atam Tekchandani, President Tax Friends Association, Conference Convener, Advocate Manoj Moriani, the President Secretaries of all the joining associations, organizing committee members, professionals, and delegates. Good morning to all of you. As mentioned by Honorable Justice Bhatt, I had the pleasure of meeting many of you a couple of months ago at Varanasi in the National Conference under the blessings of Kashi Vishwanath. I had the pleasure of sharing the dais with Mr. Justice Bhatt along with other two colleagues. We imagine on that occasion, a couple of months after, when we meet next, it will not be a physical meeting, but a virtual meeting. I am grateful to all organizers for giving me an opportunity to be with you in this virtual conference. As all of us know, the current coronavirus COVID-19 pandemic has had a profound and complex effect on the life of the individual, the society, the nation, and the globe at large. As one commentator suggests, the COVID-19 pandemic has produced a black swan set of events, such as the intensity of its fallout and the complexity of ensuing implications that we are still attempting to fully understand and meaningfully respond to them. Kautilya, in his magnum opus, Arthashastra, has identified 8 ways of increasing the prosperity of the state, namely, increasing the agricultural production, promoting trade, ensuring adequate support and guidance to state enterprises, eliminating theft, continuing success policies, avoiding troubles and calamities, increasing cash income, and adopting judicious and robust tax policies. Even though troubles and calamities cannot be completely avoided, their widespread and harmful effects on the state and its citizens can be guarded against. So while the world attempts to undo the damage caused by the current pandemic, Kautilya's prescription, and in particular, the last one, adoption of judicious tax policies, provides a valuable way forward. Globally, governments have enacted several relief measures in response to the economic conditions resulting from the pandemic. These measures, which include extension of deadlines, deferral of payments, remitting penalties and interest, debt payment plans, suspending debt recovery, quicker refund to taxpayers, temporary changes in audit policy, and ways to provide quicker tax certainty, enhanced taxpayer services and communication initiatives have focused on preventive hardship, reducing burdens and supporting their citizens, businesses while ensuring continuing provisions of vital public services. In India as well, we have adopted such tax policy measures. We must remember that policy measures take time to generate desired effects, and we must allow that time before we critically analyze their performance. Given the limitations of human foresight and the unique challenges posed by this pandemic, our ability to predict what may come is limited, and so is our ability to plan and articulate appropriate future responses. It is often said that forethought spares us afterthought, and yet hindsight is notably cleverer than foresight. Therefore, even though I have been asked to speak today on changing professional practices post-COVID-19, considering the above and the fact that we are still amidst an ongoing pandemic, instead of focusing on specific micro tax practices to be engaged in by the professionals, let me instead dwell on the bigger picture here. What design adaptations should our tax administrator undergo for it to be robust enough to deal with challenges that are likely to be emerged in the future? I propose to do that by posing 3 questions, responses of which, in my view, will outline for us the nature of changes that tax administrators, practitioners, and consumers can expect in the coming times, and what understandings should inform efforts to tackle those concerns. It first looks at the overall picture, moving to the macro design of the tax system, and finally, micro concerns. This, I hope, would adequately set the base for more informed conversations in your technical sessions around specific aspects of taxation practice. The first question that I pose to myself is, what ought to be our tax shastra during extraordinary times? Taxes are not just a method of revenue generation for the state. They are also an important instrument to achieve economic or distributive justice. This is the reason why administration of taxation attracts intense scrutiny. It is both a site of conflicts of economic self-interest and of conflicting ideas of justice and fairness. It is for this reason that a modern tax system is called upon to answer a varied set of questions about its purpose. For instance, on what kind of things should the tax be levied? How much tax should be levied on them? And for what purpose? What should be exempt from taxation or deductible and when? What kinds of inequalities are considered legitimate post-imposition of tax, etc. Of course, there are some areas which are beyond controversy, such as defense, public order, and similar public goods. But should taxation be used to redistribute resources from rich to poor, or at least to elevate the conditions of those who are unable to support themselves adequately because of unemployment or loss of earning, possibility or capacity? These are difficult issues and their complexity is only exacerbated during extraordinary situations such as the current pandemic. But they need to be addressed creatively, effectively, and inclusively, simply because such responses and principles which evolve therefrom would eventually inform the design of the overall tax system. The second question I pose to myself is, given these unprecedented times, what are the key attributes of a desirable tax system on a macro scale? Any tax system must exhibit the following three attributes. It must be stable, it must be efficient, and it must be designed to achieve equity. Each of three attributes serve a specific objective. Focus on stability would enable effective tackling of unwanted and unexpected fluctuations, especially in crisis and post-crisis periods, whereas equity would prevent disproportionate demands being placed on the worst affected and from differently placed individuals and corporations. Finally, focus on the efficiency of resource allocations would minimize the tax policies that would distort relative prices across sectors and result in erroneous signals being generated by the economy. An inefficient tax structure, though might assist in raising revenue in short term, but it would impede on economic growth and lead to revenue stagnation in the medium and long term. A tax system must be, as Kautilya describes in Arthashastra, and I quote, "State tax is such we should not prove to be a burden on the subject. The king should behave like those bees which collect honey without causing harm to the trees." I unquote. Another key attribute is simplicity of the law. Often, a slew of measures is outlined to deal with the fallout of extraordinary situation. But more complex or hard to interpret a tax provision is greater the likelihood of litigation. Similarly, the more unmanageable the law, the longer the litigation process is likely to be. It is said that Albert Einstein had once jokingly remarked about his tax returns, and I quote, "This is too difficult for a mathematician. It takes a philosopher." I unquote. Therefore, it is crucial that a tax system is both straightforward and easy to interpret. A closely related principle is the ease of taxpayer compliance complemented by taxpayers' rights. I will revert to this point in little more detail later. However, a larger point to be made here is that a tax structure, that is the laws and procedure, should not adversely affect market confidence and the associated stability in business decision making, which is essential to ensure production supply and economic growth. Such a system would promote growth, engender trust, secure transparency, limit corruption, and encourage impartial application of law and administrative rules. The third question that I pose to myself is, as COVID continues to challenge us on a daily basis on multifarious levels, what considerations should be kept in mind while designing specific tax measures? In addition to general relief, any specific relief measure must first commence with identification of taxpayers that are the most affected by the pandemic. Such taxpayers may be asked to actively demonstrate that their difficulties are related to the pandemic. Post such identification, measures, policies targeting specific problems faced by those affected must be adopted. This might be measures for particular sectors which are hardest hit or which are most crucial to helping mitigate the impacts of the crisis, such as the healthcare sector. Or it may be for particular taxpayer segments, such as the self-employed or small businesses, which in relative terms may suffer the most from cash flow issues or from reporting burdens during this period. If such a course of action was adopted, then clear criteria on which such determination would happen must be provided to reduce further stresses on both taxpayers as well as the tax administrators. The consequences which might arise from taxpayers from actions of tax administration must be considered during formulation of specific measures. For example, decisions to defer tax reporting may have impacts on refunds. For instance, delay in refunds may compound cash flow problems. This problem might be acute in instances where there has been over withholding of tax or more advance payment than the final liability has been made. Similarly, there is often a close link between reported income in tax returns and eligibility for benefits of or availing loans. Lacking a clear picture on pending taxes would have an adverse effect on their ability to raise adequate funding. The duration of measures must also be taken into account during the formulation of relief measures. On the one hand, short-term measures may not provide the extent of certainty that some taxpayers desire. Longer-term measures, on the other hand, may make it more difficult for taxpayers to return to normal conditions if, for example, debts build up to unsustainable levels or deferred payments lead to severe cash flow problems at a later date, potentially causing system-wide business liquidity issues at a later time. Measures introduced to deal with exigencies are often vulnerable to fraud. For example, where someone sets up a new company with fictitious staff and seeks government support, where someone seeks to dispose of assets before debts can be collected, or in instances where deferred payments are involved, examples such as GST, input tax credit frauds. Adequate risk measures may be introduced or existing ones strengthened depending on the design of support measures. Attention must also be paid to integrate technology in a significant manner in tax administration. In the recent years, extensive investment has been made to ensure online availability and delivery of services across various taxpayer segments. Therefore, greater focus should be on understanding how various measures and other relevant information could be digitally communicated to the end user. A clarity on the above ideas would enable a more efficient, flexible, effective, and responsive tax system, which in turn would go a long way in ensuring what Kautilya had suggested, judicious and robust tax policies. However, before I conclude, let me briefly talk about three more ideas which I believe are of extreme importance. The first one being consumer focus. We all understand that these times necessitate a change in the approach of all involved. Tax practitioners play an important role, especially as a vital intermediary between the tax administration and the taxpayers. Till now, we have discussed the expectations of professionals from the existing tax administration structure. In equal measures, we also need to focus on expectations of taxpayers from practitioners. The first one is improving the services provided to taxpayers. Lowering the effective cost of compliance should be a primary concern of tax practitioners. During difficult times, a slew of new measures are often adopted by the state. It becomes ever more important for the professionals to suitably customize their services, which ensure ease of information flow about tax obligations and tax payments. It is the tax practitioners who have to understand the framework and help the consumers navigate it and assist administrators in differentiating between honest mistakes and deliberate avoidance or evasion. The second one is engaging with the customers. The tax professionals are charged with maintenance of communication between the tax administrators and its consumers. This would enable them to play a key role in identifying bottlenecks and problems with the existing tax systems and provisions. This could be done through industry forums, workshops, public consultations, etc., to discuss proposed changes and undertake independent reviews of tax provisions and practices. The third one being securing access. One of the most debilitating effects of the pandemic has been the severe limitations on the physical contact. This is likely to create enormous problems in tax administration because many of the processes depend heavily on physical contact. In the new contactless scenario, various organs of the state, including the judiciary, have increasingly utilized information and communication technology to secure access to justice. In this regard, the 2019 assessment scheme and the Central Board of Indirect Taxes' recent decision to conduct virtual hearings are steps in the right direction. I'm happy to know, as mentioned by Justice Bhatt, that all the benches are working through virtual hearings. It's a pleasure that in such difficult times, they are working to the best of their ability and providing services to the consumers as well as the professionals. I must congratulate Mr. Bhatt and his team for this endeavor. I am also given to understand that efforts are on to automate further processes such as filing of returns, allotment of registration, issuance of refunds, etc. It is here that tax practitioners can play a crucial role. They must not only become proficient in use of technology, but also embrace such advancements to enhance taxpayers' experience. They must make it a conscious part of their professional development. In this pandemic, it is also equally important as resolving today's concerns is developing the ability and foresight to deal with emerging concerns. These days, it seems everyone is leading a demanding life. The tax practitioners are no exception as they continuously face enormous pressure on the professional front. Such demanding lifestyle and the immense stress caused by the pandemic can have great consequences on the health of an individual. It is therefore important to focus not just on the physical well-being, but also on the mental well-being of the tax practitioners. Efforts will be made individually and collectively to both destigmatize this idea and make available professional help where necessary. Bodies such as Tax Friends Association can play an important role in that regard. In the conclusion, I would say that the outbreak of COVID-19 and the consequent implementation of nationwide lockdown had a debilitating effect on the economy's production, consumption, and income generation capabilities. Such events often lead to policymakers pushing for aggressive tax regimes aimed at securing national finances and tightening of regulatory frameworks to prevent leakages. As a result, the current tax administration system and all its stakeholders, including tax professionals, have to augment revenues while addressing unique and existing complex concerns such as retrospective application of tax laws, non-taxation of indirect transfers, understanding deeming fictions, including concepts such as permanent establishments, scope of tax exemptions, tax-based erosion through profit shifting, suspect efficacy or existing dispute resolution mechanism, compliance costs related to GST audit, taxation of digital economy, transfer pricing, online dispute resolution system, etc., to name a few. These policy measures require thorough analysis, especially by experts in the field. In this context, today's program is an important initiative by the Taxpayers Association and the other organizers, for it provides an appropriate platform to discuss wider and continuing ramifications of the ongoing pandemic in an attempt to identify and investigate the current concerns, predict the future trends, and where possible, offer insights to articulate effective solutions. I'm sure that this 2 days virtual conference will be of an immense help, not only to the professionals, but also to the tax administrators and ultimate consumers, that's the taxpayers in the country. I commend the efforts of the organizers, congratulate them, officially inaugurate this conference, and wish the program a grand success. I once again thank you all for giving me an opportunity to be with you. Thank you very much.
Thank you. Thank you, sir. Thank you very much, sir, for your generous words and blessings to the gathering. It is really an honor to have you and Bhatt, sir, with us. We have still to learn a lot from both of you. Thank you so much. Thank you once again to both. Thank you. Now, before I move ahead, I welcome and acknowledge the presence of Dr. M.V.K. Murthy, past president of All India Federation of Tax Practitioners. Now, with the grand inaugural and introduction section, I may now request our conference convener, CA Mr. Bharat Sachdev, to propose vote of thanks and to make conference announcements. Mr. Bharat, please.
Good morning. Thank you, Harish. It gives me a great pleasure to propose a vote of thanks for the inaugural session. First, I would like to thank Honorable Mr. Justice B.R. Gavai, Judge, Supreme Court of India, for accepting our invitation and agreeing to be the chief guest for this virtual national tax conference held online. Thank you, sir, from all those present here today. I would also like to extend our warm thanks to Honorable Mr. Justice P.P. Bhatt, President, ITAT, who accepted our invitation to be a guest of honor. Thank you, sir, for your time today. I would like to thank the Sutradhar of this National Tax Conference, my very own dear President of Tax Practice Association, Thane, CA Vijay Kewalramani, for his vision and reach, and thus connecting all of us here today for this conference. Thank you, Vijay. I'll fail in my duty if I don't recognize all the leaders of the consortium of organizers who supported us all for this National Tax Conference and all the 50 webinars which we held, which led to this conference today. I thank you all for all the support throughout this COVID period, where we all kept on meeting regularly, even though only virtually. Thank you all. Last but not the least, a big thank you to all the 532 participants who registered for this conference and for making this conference a grand success. Thank you all from the bottom of my heart. Over to Harish for further announcements. Thank you. You are on mute, Harish.
Friends, we will now take a comfort break and will be back at 11:45 a.m. for the first technical session. All are requested to join using the same link. Thank you. Thank you so much. Virtual National Tax Conference. I welcome the following dignitaries on the dais for this session. Shri P.K. Bansal, Chairman of the session. CA PVSS Prasad, Speaker of the session. Shri O.P. Shukla, Conference Coordinator. Shri Virendra Popat, Bhiwandi Tax Practitioner Association. I now invite CA Virendra Popat to introduce Chairman and Speaker of this session.
Thank you. Thank you very much, all of my 532 persons who attended and give the opportunity. Sri Praveen Kumar Bansal is one of the Vice Presidents of Income Tax Tribunal, retired from Mumbai in January 2018. He is the Company Secretary, Chartered Accountant, and LLB. He is the rank holder in the CA Inter 1975, 39th rank in India in CA Inter. He is also first rank in CA Final of North Range and the 30th All India 1978. Immediately after becoming a chartered accountant, he started his own practice as a CA firm, Vinod Praveen and Associate. While being the practice, he has a vast experience of different fields of the professional related to finance, accounting, administration, consulting, and taxations. After that practicing in CA for near about 20 years, he joined as a tribunal in 1997 as an account member. He served 20 years in the tribunal as a member and provided the vice president's ITAT in March 2017. During the 2000 income ITAT, he had the opportunity to serve near about 23 stations across the India, either as a station member or two, which is as the single record. He is having the judicial experience residing the appeal relating the income tax. He is dispersed the highest number of appeals every year as a member and as a vice president of the income tax tribunal. He was the disposed of the appeal immediately. He is delivered the number of landmark decision which of the appeared in the Supreme Court, Hon'ble Supreme Court. On such cases, the case of Reliance Petroleum Production, which is the wide relied by the professionally. This case is afferred by the Honorable Supreme Court. It has mainly his ability to grasp the issue the matter of the hand, and he quick the decision making the so command in the subject is a vast knowledge of his income tax. He is also the life member of Indian Institute of Law, Bombay Chartered Accountant Association. He is also remained as a secretary of Commercial Association JV Jain College, Saranpur, secretary of All India Income Tax Appellate Tribunal members and Association of Till the Supremacy. Member of the Finance Law Committee of the Institute of Chartered Account of India for 4 years and concerned as a treasurer, founder member, and part of various charitable social welfare organized in Noida. Welcome, sir. Welcome, P.K. Bansal, sir. Please, P.K. Bansal.
Thank you.
CA Shri PVSS Prasad, CA O.P. Shukla ji, CA Virendra Popat ji, CA Vikram Nankani ji, Senior Advocate, Srimati Prem Lata Bansal, Senior Advocate, Sri P.C. Joshi, Senior Advocate, Mr. Srinivas Rao, CA Deputy President, All India Federation of Tax Federation, Sri J.D. Nankani, Senior Advocate, CA Kewalramani ji, CA Kamlesh Sabbu, CA O.P. Shukla Advocate, Sri Arvind Misra Advocate, CA Bharat Sachdeva, CA Manoj Moryani Advocate, Haresh Shughani, GST Practitioner, Sri Atem Tek Chandani Advocate, Sri Arvind Shukla ji Advocate, Sri S.K. Yogeshwar, CA Rakesh Agarwal, and other dignitaries, office bearers, and members of the Tax Friends Association, Mumbai, office bearer, and members of the Tax Practitioner Association, Thane, office bearer, and members of the Tax Bar Association, Prayagraj, Mr. J.P. Prayagraj, office bearers and members of the income tax, members of the GST Bar Association Varanasi, office bearer and members of the JOS Professional Foundation, office bearers and members of the Bhiwandi Tax Practitioner Association, and other professionals, both gentlemen and gentlewomen. Jai Hind. I hope you and your families are safe and healthy during this difficult time. I congratulate the organizers of this National Tax Conference, being the first of its kind on taxation in India through digital mode, for taking the pain during this hard time of COVID-19. The impact of the COVID-19 has been profound. I also congratulate the organizers for arranging more than 60 virtual conferences on taxation to enlarge and enlighten the knowledge of the young professionals in such difficult time and make them aware of the new technology of having meeting through the web. The spread of the virus has strained local medical infrastructure, introduced travel restrictions, limited social contacts, and created unprecedented disruptions not only to domestic economy but to the global economy. A wide variety of industries are seeing disrupted supply chains, reduced customer demand, curtailed operation and output, decreased liquidity, and significant changes to how business is conducted, that is working from home and virtual meetings. The topic selected is the need of the day. The foundations for the current international tax system were laid early in the 20th century when transnational corporations were in their infancy, and most international investment flow consisted of private and public loans. The aim was to ensure that they reflected the net business income which it might be expected to derive if it were an independent enterprise engaged in the same or similar activities under the same or similar conditions. This became known as the arm's length principle. By the second half of the century, transnational corporations become increasingly dominant in the world economy, managing operations in different countries. They also developed increasingly complex techniques for reducing their overall taxes, exploiting the loopholes in the loosely coordinated international tax system. International tax avoidance involves two main methods. First, transnational corporations can create intermediary entities in convenient countries, usually those countries where there is no tax or low income tax, known as the tax haven, to carry out the activities that is financial transaction, transportation, providing advice or other services, or to act as a holding companies owning assets like intellectual property rights, bonds, shares. By attributing profits to them, the group overall taxes can be reduced, even though they usually exist only on paper, perhaps with a nameplate on an office building. Secondly, a translation nation corporation can adjust the prices of the transfer between the members of
I think there is some technical glitch. Please bear.
Bansal sir, your voice is cracking, some internet issues.
corporation group to shift profits from the locality. This is not that it is concerns to the audible. Hello.
Yes sir, now थोड़ा बीच में connection गया.
Just a minute. Is it okay?
Yes, very much.
To combat the use of the tax havens, in 1962, US enacted the measures to include in the profits of a US parent company the income of its affiliates formed in the low tax countries, if they fall within the definition of a foreign corporation. Many other OECD countries later introduced similar rules. Subsequently, US introduced detailed regulations in 1968 elaborating how such prices should be determined. Where possible, the
बंसल साहब आवाज में प्रॉब्लम
pricing of the specific transaction. Studies showed that the comparable could be found for only a minority of cases, and applying this was time-consuming, burdensome, and created uncertainty. In 1988, the US Treasury, where comparable could not be found, proposed a new method for calculating an arm's length return, attributing to the affiliate a profit based on analyzing its function and applying an industry average rate. The comparable
There seems to be a net issue with
there seems to be some problem.
Bansal sir, there seems to be a network problem at your end.
Yes. At the Bansal just place, there is some.
Sir, there seems to be an internet problem at your end, problem with connection.
Network problem or what is there?
Network problem. The voice is breaking.
Yes, Bansal sir, now you speak.
Unmute, please unmute. Bansal sir, please unmute.
So you have to unmute.
I am unmuting myself.
Yes.
Yeah, now please.
Yeah, now you are able to hear me?
Yes.
Yeah. Studies showed that comparable could be found for only a minority of cases, and applying this was time-consuming, burdensome, and created uncertainty. In 1988, the US Treasury, where comparable could not be found, proposed a new method for calculating an arm's length return, attributing to the affiliate a profit based on analyzing its function and applying an industry average rate. That is called the comparable profit method, or we call it CPM. This caused considerably conflict within the OECD, but was eventually adopted as the transitional net margin method, that is called TNMM, in the revised transfer pricing guidelines of 1995. In India also, transfer pricing was brought in the Income Tax Act for the first time by the Finance Act 2001 by introducing Section 92 as well as Rule 10D under the Income Tax Act, so that income earned in India must be charged to tax, and the transnational corporation may not divert their profit without tax to other countries. Double tax avoidance agreements has also been entered into with the various countries. From a transfer pricing perspective, during the COVID-19 crisis, we would expect companies to record results which could differ significantly from normal business conditions and could possibly incur operating losses. While the tax authorities appreciate that the losses can be incurred in independent situations due to the unfavorable economic conditions or other legitimate business factors, it remains to be seen how these factors can be identified and quantified for transfer pricing purposes. Further, from benchmarking perspective, application of the TNMM may entail inherent challenges in terms of getting appropriate comparable companies, particularly for the financial year 2021, which is going to be ending on 31st March 31st March 2021. At the time of preparing the contemporaneous documentation, availability of the data may practically be limited to 2 financial years, that is the financial year 18-19 and 19-20, both of which are not impacted by any COVID-19 downturn. since impact on profitability will be visible for taxpayers and comparables in financial year 2021 margins, taxpayers would have to appropriately take steps to mitigate potential risk. In these times of uncertainty, multinational groups are likely to encounter significant internal changes, including the restructuring of the supply chain, renegotiations in contractual arrangement, etc., and may be expected to attract heightened attention from tax authorities worldwide. It is imperative for multinationals also to mobilize efforts now to ensure effective contemporaneous documentation is in place of substantiating the arm's length nature of transaction in light of the current economic condition. Recently, as you know, the Australian Tax Office has come out with the guidelines in the types of the analysis that it would expect to be performed to assess the impact of COVID-19 on a company, which, in my opinion, is a much welcome move by Australian Tax Office. The COVID-19 outbreak has led many countries to implement border controls as a temporary measure to curb infections, and many employers find their employees working from home in locations outside their jurisdictions where employers typically operate or are located. International travel restrictions affect board of directors and employees of multinational enterprises alike who find themselves marooned in various different locations around the world. This may trigger a local tax purchase for which the employers has not planned. This will in turn give rise to international tax complications, including the increased permanent establishment risk and in some circumstances a change in the residential status of the employees as well as the corporate tax residency. In early May, as you are aware of, Central Board of Direct Taxes has eased the tax residency rules for the financial year 1920 for non-residents stranded in India due to the COVID-19 pandemic, which is a welcome move. We are in extremely uncertain times, predicting new norms and managing how business are run as supply chain are disrupted, business moving rapidly into digital integration, and above all, keeping safe and healthy. We have seen unprecedented rise in e-commerce and digitization of the business, with employees working from home to virtual meeting to online ordering of everything. The various countries are coming out with the guidelines and ways to keep their tax base intact in light of the increased digitization. Section 165 was inserted under the Indian Income Tax Act in 2016, which levied equalization levy. The scope as well as the levy of this has been enlarged in the budget of 2020. Further, under the OECD G20 inclusive framework of BPs, over 135 countries are collaborating to put an end to tax avoidance strategies that exploit gaps and mismatches in the tax rules to avoid paying tax. 15 action plans are being implemented to tackle tax avoidance, improve the coherence of international tax rules, and ensure a more transparent tax environment. These action plans cover inter-area transfer pricing and multinational instruments rules for exchange of the information and multilateral instruments rules for exchange of information and coordination between the countries having appropriately framed. I would leave it to our dear speaker to take it up in further detail. I would conclude by saying that in such times, having active dialogue with tax authorities to encourage them to have some relaxation or consideration for taxpayers would be highly appreciated, as the financial effects of the COVID-19 will soon be established when financial accounts are drawn and tax returns are filed for the financial year 2021, for the assessment year 2021. Lastly, every cloud has a silver lining. And the silver lining in this time of COVID is more family time for all. I would say enjoy this time till it lasts. With these words, I hand over to our esteemed speaker, Mr. P.V.S.S. Prasad.
Shall I go ahead?
Sir, I have to introduce yourself.
Okay, okay.
So, yeah. Sorry for at that time. And now I'm doing this.
Yes, yes.
Sorry for that time, sir.
Virendra bhai, please continue.
CA PVSS Prasad is a BCom, FCA, DISA, and LLB. He is a practicing chartered accountant and information system audit, and is a partner as a Prasad and Prasad chartered accountant from Hyderabad since 1986. He is the past chairman of the Hyderabad branch Institute of Chartered Account of India. He is a past president of the AP Tax Bar Association and the past chairman of International Fashion Physical Association Hyderabad of Subchapters. He is co-author of a book titled is International Taxation, a Basic Study, published by the Books Corporations, Calcutta. He is also appointed one of the branch reported of FCA Congress in 2010. That was held in the Rome, Italy, and the subject is tax and the tax advice application of anti-advising provisions. He is also chairman of the All India Federation of the Tax Practice South Zone for the term of 2010-11. He was also the member of the Committee International Taxation and Institute of the Chartered Accountant of the India in 2016-17. He was invited as a speaker of IFA Asia and Africans conference held in Mauritius, May 2012, May 2014, May 2016. He was invited as a Pacific Region Tax Conference 2016 held in the South Korea in May 2016. He is a regular faculty of the diploma courses of international taxation of ICA. He is also a member of the committee of the international taxation of the Institute of Chartered Accountant of India in the year of 2018-19. He is a presently vice chairman of IFA India branch 2018-20. Thank you. And over to PVSS Prasad, sir.
Thank you, Mr. Virendra Popat, for generous introduction, and I thank at the outset Mr. Vijay Kewalramani for inviting me to speak at this very landmark virtual conference being done in a very grand scale. And in fact, I would also recognize the presence of the Mr. Haresh Chugani and Bansalji, Shri P.K. Bansalji, Honorable Chairman of this session, and other dignitaries who are on the virtual platform. And it's my pleasure to be with you this morning to share some of my thoughts on the present state of affairs with respect to international taxation and how things are moving. And we are in most unusual times, and the pandemic is really creating havoc across the world. And never ever we would have seen such situation in our lifetime. In fact, when I asked even elders of age 80, 85, they are mentioning that they have not seen such a situation. Probably this would have happened 100 years back when Spanish flu attacked the entire globe in 1918. Anyhow, every calamity has some opportunities thrown to the economies, and this time we will just see. Can you just move this slide? Yes, next. No, previous. Our previous. No, prior to that. You're going forward. Don't go forward. Go back. Go back to the beginning. Next. That's COVID-19 pandemic, as mentioned, has disrupted not only a particular country's economy, but the global economy as a whole. And every country is a victim now. And we don't know when we'll come out of this. And in fact, no, come back. Go back. Go back. Please go back. Crossbar. No, don't move. Till I tell, please don't move. Cross-border movement of goods, service, people, intangibles, and financial flows have been really jeopardized. And now we are now coming out with new rules of living. And please don't move till I tell. Please, please. I don't know who is operating. Please don't move. I will just request, then you please move. Physical distancing has become the new normal, and we have to wear masks and go around. We are not in a position to meet our friends so freely as what we used to do in the past. In the same way, we're not having the seminars or conferences in the way we were having in the past. And the new virtual webinars are happening. And this is a classic example of such an event with an excellent participation of more than 530 people, I'm told. And physical distancing now has become the new normal. And the entire mindset has changed now. We are trying to do everything online. We are trying to become more techno-savvy, and we want to complete transactions right from payment of the small utility bill like your electricity or whatever may be the municipal taxes and all that, to the largest payment. You are going online and trying to do that. Next slide, please. And this physical distancing in our life has brought in so many changes in the behavior of the consumer or the citizens of the country. Most of the service sector companies are asking their employees to work from home. We used to always think that work from home is a feature that is available only in the software companies. And now it has become a very common thing among all service sector companies especially. And even among the brick and mortar system also, they're trying to they're trying to ask some employees to work alternate days and not regularly, and so many measures to contain this COVID pandemic spread and all that. And financial transactions, all of us know, we know how to operate Paytm now, how to make payments through Paytm, how to make UPI payments, and all this we have become quite familiar now. And in fact, even a housewife is well equipped to order groceries online, and fruits, groceries, vegetables, everything online now. And even meetings, as I mentioned, we have now the Zio Meet, the Zoom platform, what we're using in this conference, and also, the Google Meet and even Microsoft Teams and all that. And even over-the-top platforms have become so common today, where the most popular thing is the Netflix, where you have variety of movies in whatever language you want, and you will be watching them on the streaming of such movies at your most comfortable position in the houses. So all this has got a negative side because the economy is taking a big beating, and we'll all have to revive the economies. In fact, if you all remember, much before the pandemic, the economists were already struggling. And in fact, even our economy was really limping that time. And on the top of it, this pandemic has created havoc across the world. Next slide, please. And in fact, this is a picture imported from OECD website, which is giving the pandemics. The red is the pandemic, and the dark brown is the double hit. If at all the pandemic revives again, let us pray God that it should not happen. And in fact, they have given their projections. It's all negative projections if you observe. And the double hit comes from down again. That is, if at all there is a revival or a relapse of the pandemic. And let us pray God that it should not happen. And go to the next slide. And this pandemic has led to lockdowns, affecting governments, incurring huge expenditure for containment zones, for taking various healthcare measures, and ensuring that the citizens of the country are safe and healthy. Every government, central government and state governments have been doing their best in this particular unusual and unprecedented atmosphere and the environment. And Organization for Economic Cooperation and Development, all of you would call it as OECD, chiefly call it as the OECD, is a organization which has a focused body on taxation and which brings out the taxation principles which are recited by our honorable chairman during his inaugural address as to what are how the transfer pricing guidelines and how guidance is being brought by OECD for the purpose of various countries' consumption and all that. And OECD is really giving some sort of guidance as to what relief measures each government have to take, which even our government has taken some substantial measures. And in fact, OECD is looking at consumption tax and the environment tax as some of the avenues on which the governments might depend in the future post-COVID-19 to mop up revenues. And in fact, in this unusual time and trying times, there is always a silver lining, or some sort of positive dimension is, as we have mentioned, every transaction is happening digital. Now the digital organizations, digital companies are doing phenomenal business and they're going to record super profits. Already we have a lot of work being done by OECD as to how these digital transactions have to be taxed. That is what is, in fact, the challenges of the digitalization of economy is already a major issue before OECD and the inclusive framework of 137 countries, which are trying to arrive at a consensus approach to evolve a new principle of taxation to tax the digital transactions. At this point of time, the COVID and the post-COVID context would increase the importance of digital transactions in a big way and making it all the more important to arrive at an early solution as to what taxing principle should be adopted by everyone. Can we go to the next slide? And these are just a bird's eye view, a glance of some of the estimates made by one of the organizations called South Center in Switzerland, which has given some sort of estimates as what each country is going to mop up on this digital tax unilateral measures which some of these countries have taken. In fact, pending consensus approach which is yet to be finalized, many countries, including India, have already initiated some unilateral measures to capture digital transactions, which our honorable chairman has already touched upon, which has been introduced in the form of equalization levy in 2016 and which got extended to a new format in 2020 Finance Act, which we'll discuss a little later. Can we go to the next slide? Next slide. Now, let us quickly get into, see, the COVID and post-COVID context also has overemphasized the importance of digital taxation, how these digital transactions are going to happen, how we have to capture and how we have to conduct the taxation system from each country where the users or the customers for these digital transactions are placed. And this is $1 billion question. We don't have ready answers today. In fact, OECD has been seized of this matter and set itself with a deadline of December 2020, which looks not possible in the advent of pandemic is number one, because of the COVID-19 is number one. Number two, US being, the largest economy, and US has got its own reservations, and thereby it has put some sort of pause in their participation in this, which we'll see in the later slides. And why you require a new taxation principle at all to tax the digital transactions? Why the existing rules would not help us tax this transaction is a question which we need to understand first. And in fact, as you all know, as mentioned by Honorable Chairman, our tax rules were designed, the existing tax rules or the pre-MLI or pre-BEPS existing rules have been designed 100 years back, around 1920s, by the League of Nations. They have initiated the process. and thereby you have come up with two principles as the source principle and residence principle. A person in resident, a person say in US, a business person, a business entity comes and does business in India, start opening a branch in India, then we'll have to tax such branch in respect of the activity carried on in India. That is called the physical presence on a permanent basis, which is otherwise known as permanent establishment. Whenever a non-resident goes out of his country to another country to do business and establishes himself in a more permanent manner than a temporary manner, and then projects himself in that country through his establishment, that establishment is known as permanent establishment, which concept has been explained in great detail by the Honorable ITAT in its landmark Honorable Andhra Pradesh High Court in its landmark judgment Visakhapatnam Port Trust. Justice Jagannath Rao has explained this PA concept in an excellent manner, and then this particular celebrated judgment is widely quoted across the world in every discussion of the international taxation among the academicians and the and the tax practitioners, and also before the industry captains. So whatever rule we have in the past is all on the basis of the physical presence of a non-resident entity in a source country. It's a very simple concept we need to understand. A non-resident country would be taxed in a source country. A non-resident from a resident country would be taxed in a source country only when he has permanent physical presence there, which is otherwise known as a permanent establishment. Then only he would be taxed, he or she or it or the entity would be taxed in that source country. So the entire taxing rules in respect of non-resident operating in a source country outside his country are dependent on physical presence of such non-resident entity in the source country. Now the technology has grown by leaps and bounds, and now the new business models have totally displaced the old rules as ineffective, because the large corporations, the digital corporations today, they don't require to operate in the old brick and mortar model. They would operate in a virtual model, as how we are conducting our conference today. Through digital means, they can operate and reach out to their customers, their users across the world. Google is a classic example. Facebook, you have Apple, you have all these techno giants from US. 9 out of 11 techno giants are based out in California, in the Silicon Valley of USA. And they have spread across the world their business activities in such a manner, and which you just cannot imagine. And all this business activity is virtually happening through digital means and not meeting the requirement of the physical criteria enunciated under the PE rules of the present taxation principles of international tax law. Thereby, all these corporations are not triggering permanent establishment to make any sort of payments in the source countries where they're really generating substantial revenues. So that is the main reason. And in fact, European Union has come out with a very detailed report on the digital taxation, which is an excellent thing. You can visit European Parliament's website and you can download their report, which is very, very informative about the digital taxation. And mind-boggling revenues are generated by these digital corporations through their digital means across the world without any physical presence. Today, if you have Google India is set up for a different purpose, and Google India is definitely paying taxes in respect of its income in India. That's a different proposition. But what mainstream of income they have through their customers spread across every country, including India, that doesn't require any presence, That is for what? Today we have the discussion how the digital transactions have to be brought to tax. The main limitation or the main problem we have in the existing rules is the physical presence requirement to trigger the permanent establishment of a non-resident entity in the source country, without which you are not able to tax the transactions. So, but the digital corporations do not require any physical presence to carry out their operations. For this purpose, for this sole and main purpose, we need to come out with a new taxing rule. That is the effort now going on among the inclusive framework countries, and thereby now we will have to decide which is the source country and which is the resident country, not on the basis of the old principle, but on the basis of the new principles of what are going to be brought in. Next slide, please. And in fact, pending this, because this action plans, as again referred to by the Honorable Chairman, have been, the reports have been, the whole BEPS project have started in 2013, and then the BEPS final reports have been submitted on October 5th, 2015. The first action plan is the challenges of digitalization of economy, or the digital economy. And in fact, that was kept open and not finalized that time. They have given some pointers and they have given some leads for the discussion, and it could not be finalized because it is very difficult to come to a conclusion at that point of time. Even now, it is difficult to come to a conclusion. Anyhow, that is the reason many countries now did not wait for the consensus solution to come up. Pending that, many, including India, have come up with unilateral measures to tax this digital transactions, which has created a lot of hue and cry, especially from US, and US is retaliating all these digital tax, unilateral digital tax measures through trade sanctions and all that. And then let's go to the next slide. And OECD's journey continued, though MLI has become a reality, incorporating the other action plans into a reality. And as far as India is concerned, it has become a reality from 1st April 2020, incorporating the other action plans and other principles, whereas digital taxation is still kept open for want of consensus and arriving at a foolproof solution. And in fact, in its journey to get into a consensus on the pending work, OECD's interim report has given some pointers as how we have to go about in March 2018, and how digital transactions are happening, how digital platforms operate and all that. And again, they have come up with some more refined information through their policy note in 2019 January. And again, as recently as January, in October, they have come out with the Secretariat proposal, which has given Pillar 1 and Pillar 2. Pillar 1 deals with the digital taxation specifically, and Pillar 2 deals with anti-avoidance measures and trying to tax the multinational corporations with respect to minimum rate of taxation, which is not subject matter of this particular presentation. And the unified approach deals with the digital taxation, Pillar 1, and it has given a proposal how to go about taxing these digital transactions in the source countries. Source countries are otherwise known as market jurisdictions for our clarity and understanding in the entire presentation here now. Next slide. And OECD's program of program of work has developed 3 approaches to deal with digital taxation. The 3 proposals are user participation, because as you know, today Facebook has got innumerable users across the world, including India. India is one of the, high user-oriented country because of the high population here. And you have the other concept is the marketing intangibles, and the third concept is significant economic presence. For us to understand, the claim from each tax jurisdiction is today, if we have 130 crore population in India, at least 90 to 80 crore population is using Facebook or Google and Apple and all these digital transaction, I mean, all these digitally facilitated programs through these companies are being used by these users because there is no cost attached to the user of these particular programs, softwares, or applications. That way, they have a huge user base, which user base is utilized through exploiting revenues from advertisements given to the corporates. Because you have a huge user base of say 70, 80, 90 crore in India, and all multinationals or large business houses would like to use the digital space of Google or Facebook to advertise themselves. So this is the biggest revenue they have. Here the revenue model is totally different. Can you call these users as customers? We do not know, because no user is paying even 1 rupee to Google or to Facebook. But that is the real value creation for these companies, which database what they have of the users is the main attraction for various large corporations, companies to approach these giants to give the advertisements of their companies in their digital spaces. So user participation is recognized as a high value creating proposition for the digital companies. Thereby, countries in European Union have brought this concept and told user participation is good enough to claim a taxing right in that particular country if sizable users are there in that country, and through whom you are having sizable revenues. And then comes the marketing intangible concept. This marketing intangible concept dates back to the GlaxoSmithKline's popular drug, which sold in big volumes in US, and US IRS came out with a concept stating that your particular drug, if I am not wrong, it is the Genitac or something, and it has sold in huge volumes in US, which created super profits for the UK company. And the US IRS came out with a concept of marketing intangibles way back 15 years back. And they said, because this brand is well established and well publicized in this country, which gave you super sales and super profit, then an additional profit must be attributed to this country, because a marketing intangible is created for that particular drug in that market. So thereby US today also supports only marketing intangible concept to tax the digital transaction and not the other concepts. Significant economic presence is a concept canvassed by India in a big way, stating that this is one concept which will cover any type and every type of the transactions in the digital mode, and also the non-digital mode also is part of the significant economic presence. Because today it is very difficult to ring fence and say this is the digital economy and this is the non-digital economy. It is impossible to ring fence the digital transactions. That has been acknowledged by all the countries, and in fact even OECD has acknowledged that, because even the brick and mortar companies now are digitalizing all their transactions. Ford India, Ford the US has digitized most of their transactions. Like that, other companies, pharma companies, are digitizing their transactions. So it is very difficult to keep a strict line of demarcation as to what is digital companies and what is non-digital companies. Okay, these three proposals have been thrown for discussion by the pillar one. Next slide. And now the marketing intangible and the user participation. You broadly remember marketing intangibles is canvassed by US, and user participation is canvassed by the European Union. And both of them are of the view that portion of the non-routine profits of the multinational, a Google-like company, if it is making a super profit beyond the routine profit, there's a non-routine profit in a particular jurisdiction, let us say like India, then India can claim a portion of that profit, which is commensurate with their presence in that particular country, is what is being worked out as a formula. We'll see how it is being worked out. And then significant economic presence, as I mentioned, India canvasses this rule, and in fact portion of all profits, be it routine or non-routine. So significant economic presence says, no, you can't demarcate what is routine, what is non-routine. What is routine might become, what is non-routine today might become routine tomorrow. So that is the reason there is no demarcation as far as SCF principle is concerned. Next slide, please. And they have come out, I am not discussing this formula in a detailed manner for want of time, but I'm just giving the flavor of what they have proposed, which is not yet finalized. It is still at the consultation stage. US has not given its consent. All that I'm going to explain now. Amount A, amount B, and amount C. As mentioned by the Honorable Chairman, arm's length principle is the guiding principle when you have transaction between group entities in two jurisdictions. Why? What is the arm's length principle? Arm's length principle is nothing but when you are dealing with your own subsidiary outside India, let us say in Singapore, because Singapore has got only 17% tax rate, whereas we have got 33%, of course, 21%. I'm not discussing about that. 33% what we have all through these 33%. Suppose there is always a motivation for you to shift your profits to your subsidiary in Singapore, where the tax rate is only 17%, by way of selling your goods to your Singapore entity at a lesser price, or trying to buy raw materials from Singapore at a higher price. That way you would successfully shift your profits from India to Singapore. That is where the transactions have to be benchmarked at arm's length price by the tax authorities, and you will have to demonstrate that what I have transacted with my associated enterprise, with my subsidiary outside India, are comparable to any transaction that I would have done with an unrelated party in such circumstances. This is nothing but called the arm's length principle, which is the simple mechanism, simple and also the most complex, whatever you may say. So the arm's length principle guides the transactions between group entities among tax jurisdictions. Still, arm's length principle is still there, well intact, even under the digital taxation rules. But what they have arrived broadly is, over and above the arm's length principle, you have to use a formulary approach. That means you have to use a particular formula with respect to each source jurisdiction, that is called the market jurisdiction, where these digital transactions are happening, to arrive at what profits, what portion of profits would get taxed in such jurisdiction. That particular formula is going beyond the arm's length principle. As far as amount A, suggested by OECD in the unified approach, talks about deemed residual profit. Residual profit means non-routine profit of the multinationals. The consolidated profits must be taken, and you must arrive at a formula given by this approach after deciding what is amount B and what is amount C. Amount B is a fixed remuneration for baseline marketing and distribution functions. They have come out with a fixed remuneration, like your presumptive taxation, as how you give 8% profit for a retail trader in 44 AD. They would like to come out with a particular fixed remuneration for baseline marketing and distribution functions of a non-resident entity in the source jurisdiction. And then amount C is, if at all this particular entity is working beyond its normal baseline marketing and distribution function and trying to promote the non-resident's product in a big way, that may create a marketing intangible. And such extra efforts also should be benchmarked under the arm's length principle, and extra remuneration must be attributed to the source country where such activities are carried out. That is all amount B and C. Once amount B and C are finalized, you are still left with the residual profit, which is the non-routine profit. In that, a particular formula is being proposed to work out what is the proportionate share for each market jurisdiction. Google is just not operating only in India, across various countries in the globe. Then how do you apportion? A particular formula is given. Next slide. So that is how this is being called a three-tier profit allocation mechanism. Amount B and C depend on arm's length principle, which is already there in our understanding. And amount A is being derived at on the basis of a formula. That is the reason it's called a formulaic approach. And this summary, they have the last statement is 31st January. They have come out with a final statement stating that digital corporations must be separated and consumer-facing entities must be separated. And they are coming out with a concept called consumer-facing entities. Such entities alone will have to be brought under the digital taxation new principle. And in fact, for some business models, market jurisdiction is where the user is located. That is what we have discussed in the Europe, how European Union has brought out the concept of user participation, like your Facebook users, Google users, and all that, intended to restabilize the international tax system, assisted, enhanced dispute prevention and resolution process. And these three amount A, B, C, there might be some overlap which needs to be avoided. Otherwise, it would result in double taxation. Next slide, please. See, US has been not so well absorbed in this entire project for the simple reason US would be directly impacted because all the giant digital giants are from US, and the entire tax base which is getting mostly taxed in US, now they will have to distribute those taxes across the world, which is not to the liking of US. And US sees, in nutshell, US is supporting the existing international tax rules. And they strongly believe that the existing tax rules alone would answer issues of digital taxation also, which is not being agreed by as many as 137 countries in the inclusive framework. And US has come out with a very typical concept which is never expected. They told on 3rd December 2019, the entire digital taxation proposal and the unified approach, what you are coming out under Pillar 1, can be treated as a safe harbor regime. What is a safe harbor? Today we have safe harbor rules even for the transfer pricing in India, which no one is taking to that because the safe harbor rates proposed there are very high. Be that as it may, safe harbor is an option. If a taxpayer would like to get covered, he will go there. Otherwise, it's not a mandatory thing. So whatever digital tax proposition that has come out in the form of Pillar 1, US proposed that let it be treated as a safe harbor, which is strongly opposed by the entire inclusive framework of 136 countries. They said safe harbor has never been an idea which is discussed across this project for so many years, and we cannot accept that. That is what the OECD Secretary has replied to the Treasury Secretary of the US. And recently in June 2020, because of the severe pandemic, which is also impacting US in a big way, they have proposed that they are giving a pause. Pause is a very, it's a new coinage now for any sort of stopping the proceedings for a while. They said we would like to give a pause for this particular project because of this pandemic situation. That is what they have mentioned. We also know US is going through the presidential election now, which is coming up in November 2020. So I think the Philip Baker, one of the leading counsels in UK, who is Queen's Counsel, the other day in one of the webinars he mentioned, US has put a similar pause even in 2000 when some international tax proposals were going on that time because of the presidential election. The same thing is happening now also. We can expect the US to come back to the discussion table only after January or February 2021. Next slide, please. So now the key features that are under discussion among all the countries is scope. What is a consumer-facing business? A consumer-facing business will keep out B2B, that is business to business. Consumer-facing means business to customer. You are keeping out business to business. But whereas India-like countries are telling, why are you keeping out business to business out? Significant economic presence would cover everything. We should not keep out business to business. So there are some differences among various countries which are discussing now. And what is the new nexus? And they have proposed 750 million euro as a threshold to apply the new digital taxation rule. That means any corporation having revenue less than 750 million euro, that means roughly 5,500 Indian rupees, 5,500 crore Indian rupees. So if at all a particular corporation is having 5,000 crore revenue, then you are not applying the digital tax principle. India is opposed to that. It says the threshold is very high. You should not have a threshold. In the other place, you must have a lower threshold and not 750 million euro. And new profit allocation rules beyond the arm's length. For the first time, we are going beyond the arm's length principle and trying to give a formula for arriving at the taxation right of the source country, that is the market jurisdiction. So this is called the three-tier mechanism. Next slide, please. And India has come up with the equalization levy. Equalization levy is one of the proposals indirectly suggested by Action Plan 1 in 2015 final report. But they have given all the safeguards to be taken. They have said equalization levy must be levied in a manner respecting or complying with the international treaty obligations. That is very important. See, whatever levy you make, that should come within the four corners of the treaty obligation. That is one of the conditions, but we have not followed that. And the levy has been brought in, neither it is income tax, nor it is a transaction tax, nor it is it's an indirect, it is only a transaction tax. It is not an indirect tax, it is not a direct tax. And it is very clear, it's clearly explained that no credit can be given for this tax paid by the non-resident here in their resident country. So this is a double whammy. That means the entire profit, what they earn, is again subjected to tax in the resident country. Thereby, you are subjecting the income earned in the source country twice, which is not having any relief, which is against the basic principle of double taxation avoidance agreements and the treaty law. And originally, 2016, India introduced only advertisement income earned by non-resident from the residents of India should be brought under the purview of equalization levy at the rate of 6%. And they said if you do not, this 6% must be paid, must be deducted and then paid to the non-resident. A Google-like company, will they allow such deduction? I am a small business person in India availing Google services. If I have to pay $10,000, I am at a weaker side of the bargaining. And I would be said, you pay $10,000 net, whatever you do, I do not know. So ultimately that 6% cost is falling on me. It is adding to my cost. I, being a smaller businessman, has to take, being a resident of this country, my cost is going up. It is not genuinely being recovered from the non-resident. That is what has happened all these days from 2016 to 2020. And as a real shocking surprise, 2020 Finance Act has brought in an extended levy in the form of equalization levy applicable to the e-commerce operators at the rate of 2%. And in fact, a non-resident has to comply with equalization levy proposed in 2016 is an obligation cast on the resident payer making payments to non-resident company who is providing the advertisement space digitally. Whereas here, the non-resident e-commerce operator must comply with this rule of equalization levy, which needs to be paid at 2%, for which there is no appeal available. Appeal is available only for penalty order and not the main order. And it is very surprising that this has come without any discussion. This was not proposed in the Finance Bill 2020. It has come as a very surprising shock in 2020 because the digital taxation discussions and the US intervention and all this is delaying the whole process. And in the Finance Act, our government took a view to extend this levy to the e-commerce operator, which is creating a lot of uncertainty. So many issues have come up in equalization levy, which are still to be answered and clarified by the government. For want of time, I may not be able to go deep into that now, but that is the digital tax as of now, proposed in being levied. It has become effective from 1st April 2020 in India. The new nexus rule, significant economic presence, also is proposed, but it is kept on hold till 2022 in the Finance Act. And introduction of, again, another withholding tax on e-commerce transaction, that is 194(o). And for your kind information, 194(o) which is proposed in the Finance Bill and continued in the Finance Act, will overlap with equalization levy too. There are instances where these two would overlap and it creates another dimension of double taxation. And also, the Central Board of Direct Taxes has come up with new attribution rules for permanent establishment in a draft report in April 2019, which also has some relevance for our discussion today. And in fact, that is still at the draft stage for the simple reason that this inclusive framework, OECD inclusive framework approach to digital taxation must result in a consensus solution. Next slide, please. And then we will quickly come to the second dimension of today's presentation, and what is the most happening thing today, and what is a reality today. As how equalization levy has become a reality, today multilateral instrument is a reality. It's a new dimension to the existing tax treaty network. Next slide. That means the double taxation avoidance agreements, as many as 93 double taxation avoidance agreements, India has notified them as covered tax agreements, and all those CTAs are undergoing change because of this multilateral instrument. First of all, let me explain what are the action plans in nutshell in 1 minute. As you all know, all of you would have heard the BEPS action plans number of times from last 5, 6, 7 years. The BEPS action plans are nothing but anti-avoidance measures in the international tax context. They have identified where tax leakages are happening and how to arrest these tax leakages. And first of all, the top and the foremost thing which every country has agreed to arrest is the treaty abuse or treaty shopping. What is treaty shopping? We all know what is treaty shopping. India-Mauritius tax treaty, we all have seen the India-Mauritius tax treaty was used and utilized by third country residents by interposing a company in Mauritius and claiming the benefits of India-Mauritius tax treaty. Suppose a US entity or a European entity will float a subsidiary in Mauritius, and Mauritius in turn will invest into India, and India-Mauritius tax treaty would apply because there is no anti-abuse rule like limitation of benefits rule, insisting that not only the company must be a resident of Mauritius, but also the entire shareholders of such company must be residents of Mauritius. That rule was never there in the India-Mauritius treaty, like a rule what we had in India-US tax treaty. So that limitation of benefits rule was not there, because of which all third country residents have exploited Mauritius route to reach India. But of course, India has categorically agreed for such negotiation way back when Mauritius treaty was signed, and then that has come up as a big blow because at a later point of time, capital gains tax was abolished in Mauritius also, and thereby the capital gains tax which is sacrificed by India, not levied by India, was also not levied by Mauritius. Suppose these investments coming through Mauritius, if they want to exit the investment with all super profits, the gain was not getting taxed either in India or in Mauritius. That's a classic example of double non-taxation. So that is called the treaty shopping, and that needs to be arrested, and that is the most basic target of the BEPS action plan, which everyone has agreed as a minimum standard. That means minimum standard means every country, they will not have any option. They will agree to this because no one wants to lose their revenue. That is, prevention of treaty abuse is a minimum standard. In the same way, effective dispute resolution is also a minimum standard. Even the taxpayers' rights must be protected, and taxpayers must be, grievances must be redressed on time. So both these action plans, action plan 14 and 6 are the minimum standard, and the other minimum standards we have here. Action plan 1 talks about the digital taxation, and action plan 15 says all these amendments which we are trying to bring to various tax treaties must be brought in a very swift and effective manner. How you can bring it? If at all India-Mauritius tax treaty has to be changed, It took 10 long years to change the tax treaty. You know, it happened in 2016. The hue and cry started from the revenue authorities 10 years prior to that. Say in 2005-4 they started, we are losing a lot of revenue, neither capital gains is brought to tax here when the Mauritius companies are exiting their investment in India. Neither they are taxed here nor in Mauritius. So which plea got addressed through anti-abuse rules in the treaty in 2016. That means it took 10 long years to renegotiate a treaty. And the international group of experts have suggested that if you have to modify as many as 3,000 tax treaties, it would take another 30 to 40 years, by which time the proposals you're trying to make would become redundant. By that time, the technology would have taken many more jumps. That is the reason they have proposed a multilateral instrument must be brought in, which will be signed by all the inclusive framework countries so that their respective treaties get modified. Next slide. So this is the first of its kind and first of its scale operation, and developing a multilateral instrument modifying bilateral tax treaties concluded that multilateral instrument providing an innovative approach to the countries to swiftly modify their bilateral tax treaties to implement measures developed in the course of the BEPS project. And this is what is suggested by the group of experts, which has become a reality today. Next slide. And the journey of MLI, India is one of the front runners in the G20 because India is part of G20 and not a member of OECD, it's only an observer, but one of the prominent members and the most popular members and the most vocal members of the G20 group. And many of India's views have been considered and have been implemented. And the journey started like this. October 2015 is the release of BEPS reports, as I mentioned. So 2016 MLI draft, MLI instrument has been brought in for discussion. And June 2017, 7th June 2017, the MLI was signed by as many as 67 countries, including India, when the then finance minister, Mr. Arun Jaitley, late Mr. Arun Jaitley, went and signed in Paris. And 25th June 2019, MLI was ratified by India. And on 9th June, MLI was notified by the Ministry of Finance also. And it has come into force from 1st October 2019, and it has become effective from 1st April 2020. It is a reality now. We need to know how MLI operates. Next. And this is how the MLI structure has come up. I'm just giving a broad outlook of what is MLI, and it is not a detailed discussion. And we have, this is how the MLI is structured with various parts and various articles. And substantive articles are from 3 to 17. And let's go to the next slide. And each signatory to MLI indicates its position as to what tax treaties it would like to cover. They have given a lot of flexibility. No country is forced to come and sign MLA, and it would not happen also. Every country has its own sovereign right, and it has to protect its sovereign functions. Accordingly, each country is given its flexibility to join the MLI program and sign the multilateral instrument as per its own wish. Today, US is not a signatory to MLI, it has not signed MLI. Even Brazil has not signed so far. Each signatory to MLI indicates its position as to what tax treaties it would like to cover. Suppose I'm not covering a particular tax treaty, it would not be treated as a covered tax agreement. India has notified all its then 93 tax treaties. That way it has all the 93 tax treaties have become covered tax agreements. And signatories can amend their MLA positions until ratification. They have the flexibility to ratify the position, to change the positions. Even after ratification, and the member countries can again bilaterally modify the positions in their bilateral tax treaties. And MLI is not coming like a protocol. MLI is not a protocol. What is a protocol in the international tax? Like an amendment. As how you have an amendment through Finance Act every year to the income tax law. You have amendments that's called protocols to the treaty. It is not a protocol. It is a modification being done through a separate instrument, which instrument works alongside the tax treaties. That is the mechanism suggested by the group of experts. And MLI, they have used the word modifying. It modifies the article in the covered tax agreement. And the modification was deliberately chosen after an in-depth discussion by the experts. Next slide. And as I told, all the inclusive framework countries have got exclusive liberty to modify their positions bilaterally, even after signing the MLA and ratifying the MLA. And how this modification has happened, that is where the entire crux is there. How MLA is sitting alongside the treaty and trying to modify, say, Article 7, Article 5, that is dealing with the permanent establishment. How it is happening? It is happening through compatibility clauses like in place of. In place of means the MLI provision will come and sit in place of the existing provision. Modifies, it doesn't come in place of, but it would modify the existing article. In absence of, if there is no article of that nature, then it will get included now. In place of or in absence of means it would apply to each and every covered tax agreement. That is how the modifications happen. You need to carefully read the articles of MLI, and you have to see the positions taken by the treaty partners. What position, suppose it's an India-Netherlands tax treaty, what positions they have taken, what positions we have taken to each article, what we have in MLI, and then accordingly decide what is the modification done for the tax treaty. This is a big exercise by itself. You have to be extremely careful. If at all you are trying to apply the double taxation avoidance agreement, this is how you need to do now. You cannot ignore MLA. MLA is part and parcel of the overall interpretative framework. And in this regard, the object and purpose of the convention is to implement the tax treaty related BEPS measures. Then we'll go to the minimum standards I've already explained, and go to the next slide. And these are all the countries who have already, and these are all the countries with whom we have the DTAs, who have also ratified the MLA along with us, and as many as 36 countries have now ratified their MLA till now, with whom we have the double taxation avoidance agreement. That means when we are trying to interpret the provisions of, say, New Zealand, you need to see the MLI positions taken by them, MLI positions taken by us, along with the existing provision, then arrive at the correct proposition, what you need to apply to arrive at the treaty law proposition. Next. Next, we are coming to the last module, which will just take another 3 to 4 minutes. And with that, I would be closing my presentation. And transfer pricing is the third topic which I thought I should discuss. These are all offshoots of BEPS action plan only. See, digital taxation, what I have discussed as the first module of this presentation is nothing but action plan of the BEPS, action plan 1. And then multilateral instrument, all other action plans have been formulated and brought into an instrument called multilateral instrument. Whatever propositions have been brought in the action report, it has come into MLI. Some part of the proposals of the action plans will have impact in the domestic law, and some proposals will come and sit in the treaty law. Such proposals have come into MLI. And next slide. And action 8 to 10 of the BEPS action reports, final reports, deal with transfer pricing principles. And then 13 also deals with the transfer pricing related matters. 8 to 10 have an agenda because the slogan of BEPS action plan in respect of transfer pricing proposition is the value creation is happening at one place, and the value creation economic activity is happening at one place, and the contractual risks are positioned in another place. That means the contractual risks are borne by low tax jurisdictions who are not doing the real work for the economic activity, but entire revenues are getting accumulated in the low tax or nil tax jurisdictions, whereas the value is being created in high tax jurisdictions which are not reporting this particular income. So there is a disconnect between value creation and the revenue aggregation. So this is being now synchronized. That is, the transfer pricing actions are aligned with the value creation. That is the slogan with which the action plans have been brought in. For that purpose, now it is transfer pricing officers have been authorized even to recharacterize your transaction and ensure that this value creation is aligned with the transfer pricing actions. Next. And action plan 8 looks at transfer pricing issues related to the intangibles. As we all know, an intangible is developed in India. The outsourced work is given by, let us say, US, because the Indian human resource is cheaper than the human resource that is in US or Europe. Most of the outsourced projects come to India. That is the most popular revenue model, even for the transfer pricing purposes we know about it. So now, in the past, how things are happening, suppose a particular software product has to be developed, like a banking solution or something. The entire work could be outsourced to Indian subsidiary of a large software giant of US. Which project will be carried out by India at a cost plus model? It will just, what all cost it incurs, it will just add another 10 or 12% maximum, and then they will bill and collect. And then the entire, the intangible value, everything, the ownership is owned by the parent. So thereby, the appropriate compensation or remuneration or profit is not being apportioned to the Indian entity, which is not possible now because of the new guidelines that have come into OECD TP guidelines 2017. They have come out with various actions, which I will tell you in the next slide. And action 9 talks about the risks must be allocated properly to those entities who have the capacity to bear those risks. And it can't be assigned to some entities and where they don't have the capacity to bear the risks. And action 10 also is including the scope for addressing profit allocation resulting from transactions which are not commercially rational. And there were many transactions happening which are not commercially rational, only to achieve the tax avoidance purpose in the past by the multinationals. Action Plan 13 talks about country by country reporting. That means the international group, the multinational enterprise group spread across various countries, if the entire chart is given in the form of country by country report to the tax jurisdiction, they will, each tax jurisdiction will assess whether proper profit is attributed in their tax jurisdiction, commensurate with the activity carried out. Next. And in fact, these are the DEMPE functions. I have come to the last 2 slides. And the DEMPE function is of an intangible, is development of intangible, enhancement of intangible, maintenance of intangible, protection of intangible, and exploiting of intangible. So just because you are a legal owner, you can't say my entire profits on exploitation of the intangible must be attributed only to me where I am sitting in a low tax jurisdiction like British Virgin Islands, Cayman Islands, or say Singapore or Mauritius. No, that is not possible. Now, whoever carries out functions in this particular phase, a DEMPE function, that is development, enhancement, maintenance, protection, and exploitation, each player in respective roles must be attributed appropriate profit attribution. And India is also part of this in country by country reporting and master file. These are the two, exchange of information with reference to the entire transfer pricing policy and how they're operating in each jurisdiction. Even India has implemented that. Next. And this is the last slide. And the future of transfer pricing, as mentioned by our Honorable Chairman, Mr. Bansalji, that hard to value intangibles is going to be, because this is a knowledge society now. The information technology companies are growing in a big way. Digital companies are going in a big way. Intangibles, the value of intangibles is going in a big way. So hard to value intangibles for which you don't have comparables. You don't know how revenues are going to be generated by those intangibles. So how do you set benchmarks? Is a very difficult proposition. Marketing intangibles, as I mentioned to you, when your product is publicized in a big way in a particular market and it sells in a big way, you have created a marketing intangible in that country. We have the marketing intangible cases pending before the Supreme Court. In the case of Maruti Suzuki, as you all know, originally the issue started in the LG, and then we have the Maruti Suzuki, now it's pending before the Honorable Supreme Court. And arm's length principle is not be all and end all, and every problem cannot have a solution through arm's length principle. That is what OECD and the inclusive framework members have agreed, and that is what is being proposed in the unified approach to bring out the new digital taxation rule. That is going beyond the arm's length principle and trying to give a formulary approach. Friends, this is what I thought I would deal with in the limited time available. And in fact, the topic given to me is the new paradigm of international taxation. After a lot of brainstorming with my close friends and my associates, I thought these three dimensions would be most appropriate for discussion with you. My whole effort is to bring broadly at a high level what is happening in the international tax front. And my idea in this presentation is not to familiarize you with the nitty-gritty of each and every thing what I have discussed. And I'm very thankful to the tax friends, various associations, the conglomerate of tax friends, and Mr. Vijay, Kewalramani, and my good friend, Mr. Sachinarayana, who proposed my name as a speaker for this event. And I also thank Mr. Malaj Srinivasrao, who is indirectly instrumental for my presence here in this event. Thank you very much for a very patient hearing. I would be happy to take questions time permitting. And I would revert it back to the Honorable Chairman and the organizers.
Thank you. Thank you, Speaker, sir. And it can be seen the efforts that you have put in making this great presentation. Thank you once again. I think there are no questions asked as of now. We had requested, but still there are no questions. So I would like to invite Chairman, sir, to have a concluding remarks over your presentation.
So I will just take 1 minute before passing it on to Chairman. I'll just take 1 minute. I'm always reminded of a small anecdote just to lighten the burden what we have faced in this marathon session. There is always something called an interpretation which courts will do in respect of terms defined, not defined, and everything. And in a lighter vein, I will share a small anecdote in 1 minute. In a classroom, in an English classroom, there was a discussion going on as to what is the word trousers, Trousers, trousers. Is it singular or plural? Trousers, trousers, that is pants. And no one is able to explain whether it is a singular or plural, because there is a lot of case law that is developed at the apex court level as to what is singular and what is plural. And no one is able to decide. And suddenly an accountant, a chartered accountant has come. He's found and he's invited to solve this problem because it's something to do with the numbers. And the chartered accountant gave a ready answer. Chartered accountants have got ready answers whether they are right or wrong. And the chartered accountant gave a ready answer in the classroom. The word trousers is singular at the top and plural at the other extremity. Thank you very much. And it's my pleasure to be here this morning. And it's over to the chairman. Thank you.
Thank you. Thank you so much. Chairman Bansal, sir, please.
Yes, Mr. Prasad, you have given a wonderful presentation. And I am surprised to hear you that within a period of 60 minutes, you have covered each of the topic relating to the transfer pricing, digital taxation, MLI, then the all problems which is being faced in the present situation. In my opinion, each of the topic requires at least 1 hour. In what we can say the presentation given by him is a gagar mein sagar. The gagar mein sagar bhar diya ho. So this is the presentation which he has given, and very wonderful presentation. Even nobody has raised any question. I am surprised to see that. This means that the presentation which he has given has clarified everybody about the international taxation.
Thank you.
Sir, there is one question that I'll ask after you complete your concluding remarks. It has just come on.
Question will be from Mr. Prasad.
Yes, yes. Let them ask.
Yes.
Can I ask
Mr. Prasad has covered everything that now physical presence is not possible under these circumstances also. Now the trading is being done through the digital, and what will be the effect on taxation? How the country should tax the transaction so that the tax may not be avoided?
Sir, what is the question? Can you kindly come again?
There is only one question. It is asked by Advocate C. Radhakrishnan, and the question is, what is the position of equalization levy in India?
Okay. So equalization levy is the reality now. Whether the levy is right or wrong, it has become a reality. And now it is going to cover all non-resident e-commerce operators. That is equalization levy 2. And equalization levy continues from 2016 on the advertisements on online digital space and all that. And equalization levy 2 is very, very concerning because there are many questions unanswered. And there is a strong representation from large multinationals to the Indian government to keep it on hold, pending consensus being finalized by the OECD inclusive framework. And till now, government has not responded to that. And in fact, be that as it may, even if it continues, we would like to know how this levy is going to be administered, because the non-resident e-commerce operator has to comply with these rules. And how do you enforce? He is not a resident. He is not available to you. And how do you enforce that he doesn't comply this? This is a big billion-dollar question. And not only that, and there are instances of double taxation, as I mentioned. Equalization levy overlaps with 194 WO, what is proposed. And equalization levy, there is no credit of such taxes paid in the resident country because it is not recognized as part of the treaty law. And there are many issues, and we do not know what is an online platform. Whether suppose I am a non-resident, I come to India with an IP address, I am of Indian origin, with IP address here in India, if I make a booking, for my utility outside India again, even that would come under the scanner of equalization levy. So there are many unintended consequences that are arising because of this levy. This levy is really rushed in great hurry, which no one knows, no one expects, because it was not introduced in the bill. And it suddenly came up as a surprising shock in the Finance Act. So at least now, I think because of the pandemic, there is already a representation to keep this equalization levy on hold for one more year, so that meanwhile a consensus can prevail and we can arrive at a more practical and a more desirable approach of the levy. So that is what all I could say for the present.
Thank you. Thank you, sir, for your response. I think there is one more question. Can I take this last question?
Yes.
Yeah.
And organizers have to tell, I am ready. Whatever way. You can tell it. You can read out the question.
Actually, I'm not getting it properly, but I think what the question says, can you take a few everyday life examples, sir?
Pardon?
Can you take any few routine examples, everyday life examples?
Regarding
equalization levy.
That's an equalization levy.
Just one example if you can give.
Equalization levy. The other day I was just going through one case study where suppose you have Netflix, you are a user using Netflix. Suppose if it is used by any chance by your office for the for any streaming of any particular content or anything, then you will come under the equalization levy impact. And such a even the Zoom platform what you are using and everything would come under that, because it comes under the service, because you are utilizing the service to carry out the event. This will come under equalization levy. And even your Microsoft Teams, if at all you are paying for that. Google Meet also, there is a payment beyond a particular level. So all this will come under the equalization levy, and these are some of the glaring examples what we have. Even the hotel bookings, now there is no clarity. If at all you make a hotel booking on an online platform where you get real discounts for your hotel, but in real the service is physically made. So you are going to use the room, go stay there. But in spite of it, because you made an online booking, there is no clarity that might come under equalization. Same way the flight bookings. These are some of the classic examples for which there is no clarity today. So that is the reason the scope is very, very, unwieldy, and the scope is very, very bothering. And we need to know where we stand, for which we request the CBDT to come out with more clarity.
Thank you, sir. Thank you so much. Chairman, sir, if you are done, so can I?
Mr. Prasad, will it be on the source basis or on the residence basis?
No, actually, equalization levy, there is no source, or they are telling it is beyond the treaty law. It is beyond the income tax law. Under what law it is being brought, we don't have the clarity.
Will it be unconstitutional then?
That is the most important question you are posing, sir. And constitutional experts feel that it can be challenged under the constitution, because they say that GST, after the advent of GST, equalization levy has no place. That is what they say. Constitutionally, it can be challenged because there is already a transaction tax happening in the form of GST. So definitely that can be challenged. That is what is the strong popular view of the scholars.
Does it not fall within the action plan?
No, an action plan one
entirely different one.
No, pardon?
It does not fall within the action plan.
No, action plan one, that is the, see, our government says that they have followed the suggestions given in the action plan 1 report of 2015, which they have mentioned withholding taxes, equalization levy, and significant economic presence as the 3 pointers for digital tax. That time nothing was finalized. It was totally at a raw stage that time. And that was taken immediately, and we have jumped at it, and we have brought in equalization levy in 2016 itself. But they have very categorically mentioned, the report has categorically mentioned, whatever levy you bring in, it must comply with the treaty obligation. But now it is going beyond the treaty obligations, because whatever you pay, non-resident pays, that is not going to be given as a credit in the resident country. So it is not fitting into the treaty obligations at all. See, that is what is being opposed strongly by the international community.
But the treaty amendment will take a lot of years. It's not going to be amended.
Sir, let us proceed. There is one more question and we have to end also. People are waiting for that.
This is the last question, and then we'll go for vote of thanks. The question is, transfer pricing rules on manufacturing are... Sorry, the question is... Just a minute. The question is, transfer pricing rules on manufacturing are creating problems. Hence, we are going to Colombia, Thailand, and other countries. The question says that there are some problems in the transfer pricing rules are creating some problems for manufacturing. Hence, these manufacturers have to go to the countries like Colombia, Cambodia, Thailand, and other countries.
No, it is not the transfer pricing rules, because there are no separate rules for manufacturing activity or anything. Transfer pricing rules apply across the board for all transactions. And in fact, I would be optimistic with the Make in India concept now being very strong after the recent developments. Definitely, the Indian government would not spare any effort in creating the conducive atmosphere to attract foreign investments into manufacturing sector. And whatever transfer pricing issues that are there, by and large, I think there would be more of safe harbors practically created, which are acceptable to the industry, and all that framework would happen very shortly. That is what is my optimistic view.
Okay, thank you, sir. Now I invite our conference coordinator, Shri O.P. Shukla ji, to present a heartiest vote of thanks.
Thank you, sir. श्रावण मास में बाबा विश्वनाथ की नगरी काशी से जो ज्ञान, भक्त, वैराग्य, मोक्ष वह कल्चरल हेरिटेज के नाम से शास्त्रों में जानी जाती है। मेरा वर्चुअल नेशनल टैक्स कॉन्फ्रेंस में भारतवर्ष के विभिन्न प्रांतों से सम्मिलित सभी सम्मानित सदस्यों को सादर प्रणाम व साधुवाद। After an exhilarating and wonderful executive session, it is proud privilege to propose a vote of thanks. First of all, our sincere thanks to CA Vijay Kewalramani, immediate past president of Tax Friends Pune and conference chairman, who have organized wonderful first virtual national tax conference in association with our Income Tax Bar Association Varanasi, GST Bar Association Varanasi, Tax Practitioners Thane, Income Tax Bar Association Prayagraj, Bhiwandi Tax Practitioners Association, and Jose Professional Foundation. And also thanks to Vijay Bhai, who have organized 50 virtual seminars in lockdown period. He deserves to be big clap, and और इनकी प्रोफेशनल क्षमता की जितनी तारीफ की जाए उतना ही कम है. Friends, our sincere thanks and congratulations to all the members of our Income Tax Bar Association, GST Bar Association Varanasi, who have given extreme support to the first virtual national tax conference. And also thanks to all the associate concerned member who is participating in this first virtual NTC. Today, first technical session has completed, and first of all, I thanks our respected of the session chairman P.K. Bansal sir, former vice president ITAT, who is encyclopedia of income tax law, and who have very well conducted the session. I have been lucky to present in number of appeals before him, and it has always been very satisfying appearing before him, notwithstanding the outcome of the appeals. Today, the subject is international taxation, new paradigm. The Revenue Authority must protect their revenue base without hindering the development and use of the new technology. Low-income countries are more dependent on corporate income tax revenue than richer countries, and at the same time, this is proportionate affected by tax multinational avoidance. Our research of this theme investigating ways in which developing countries protect their tax base, including through simplified transfer pricing method and improved tax treaty policy. It also examines the challenge and opportunities developing countries face from their participation in international tax negotiations. Our sincere thanks to keynote speaker CA PVSS Prasad ji, who have explained the extremely interactive subject in such a lucid manner, and tax avoidance policy India and other countries has executed double taxation avoidance treaty, but looking to the world economic scenario, the treaty made with United States, Russia, China, Australia, Japan, and other neighbor countries must be reviewed. And computation of income from international transaction have regards to arm's length price, meaning of associate enterprises, and meaning of basic domestic transactions, reference to transfer pricing officer, and avoidance the pricing agreement must be reviewed. I also thanks my friends on the dais, Biren Papat, who have introduced the biodata of chairman and the keynote speaker. Lastly, but not the least, thanks to each and every delegates who have participated and benefited from this session. As पड़ोसी देश
I think there is some internet issue. Shukla ji,
I think you move ahead, Harish.
Yeah, thank you, Shukla ji,
No
for your
audible.
kind words. We shall now take a lunch break and shall reassemble at 2 p.m. by using the
our
same
Indian
link.
government and
हाँ शुक्ला जी, सॉरी, आपका इंटरनेट प्रॉब्लम आ गया था वहां पे. आप प्लीज कंटिन्यू कीजिए, कंप्लीट कर दीजिए.
ओके, थैंक यू. आज पड़ोसी देश चाइना के कारण संपूर्ण विश्व कोविड-19 से त्रस्त है. चाइना अपने सभी पड़ोसी देशों के साथ आर्थिक सहायता के नाम पर अपना सैन्य विस्तार कर रहा है. इवन दो यूनाइटेड स्टेट अमेरिका भी चाइना के आर्थिक और सामरिक नीतियों के कारण अपने को चाइना के समक्ष मजबूर समझ रहा है. लाखों लोग इस कोविड-19 वायरस के कारण काल के गाल में समाहित हो चुके हैं. हमारे स्पीकर CA PBS प्रसाद has raised some technical issues which should be considered our Indian government and reviewed tax avoidance treaty, जिससे भारत में मल्टीनेशनल कंपनियों को निवेश का अवसर प्राप्त हो सके. Once again, our sincere thanks to all the participants, delegates, speakers who are participating in first virtual national conference. Thanks to all. Jai Hind, Jai Bharat.
Thank you, sir. Thank you, sir, for your kind words. We shall now take a lunch break and shall reassemble at 2 p.m. by using the same link. Thank you all.
म्यूट करने का तो बंद करना, आवाज एक होता सर.
Harish, we are on.
Good afternoon, everyone. So welcome back for the second technical session of the day. I welcome the following dignitaries on the dais for the session. Shri Vikram Nankani, Senior Advocate, is Chairman of the session. CA Rajendra Arora, Speaker of the session. Shri Haresh Chugani, Conference Convener, that is myself. And Shri Mansukh Waghela, Tax Practitioner Association. Now I invite Shri Mansukh Waghela to introduce Chairman and Speaker of this session. Mr. Mansukh Bhai, please.
Yeah, thank you, Harish Bhai. Good afternoon, friends. Let me begin by welcoming you all for this post-lunch session. Please allow me to express my gratitude to Mr. Vijay Kewalramani ji and the coordinating committee. I am really privileged to have the pleasant task of welcoming today's chairman and speaker for this webinar. We are grateful to today's chairman, Senior Advocate Mr. Vikram Nankani ji, who graciously and readily accepted our invitation, and let me introduce him to you all. Shri Vikram Nankani ji is a designated senior advocate. He is an India qualified lawyer at bar since 1986 and LLM from Government Law College, Mumbai, 1988. Very early in his career, Vikram ji has started a lawyer with Chamber of Mr. Ashok Desai, Senior Advocate and former Attorney General of India. After gaining experience for more than 17 years, there he became a partner in economic law practice from 2003 till his designation as a senior advocate in the year 2014. He is an expert in matters concerning commercial dispute, corporate issues, economic offences, and is also a fellow Chartered Institute of Arbitration from London. Vikramji is also a member of SIAC India National Users Committee and acknowledged by Legal 500 as a leading individual practitioner in dispute resolution and litigation in India. He also regularly appears before various high courts and Supreme Court of India and has it to his credit several landmark judgments rendered by court that have been reported by various authoritative journals and reporters. Vikramji has also been invited as an expert lawyer on various occasions, including a Singapore court and arbitration proceedings. Vikramji has also been appointed arbitrator and also appeared before arbitral tribunal in India and internationally. It is our privilege that Vikram sir has agreed to be a chairman for this session. Thank you, sir. Thank you, Vikram sir. Now, let me introduce you to today's speaker, CA Rajendra Arora ji. Rajendra Arora ji is a managing partner of Spark and Associate and heads GST division in the firm. He is also knowledge partner with Clear Tax and Tax for Wealth. Also a law graduate, he is a member of Delhi Sales Tax Bar Association, BCAS, CGPI, All India Federation of Tax Practitioners and International Fiscal Association India branch. As an elected representative of Northern India Regional Council of ICAI, he has served as a secretary in 2017-18, treasurer in the year 2018-19, and as a chairman for GST committee for the year 2019-20. A prolific speaker and a voracious reader, Mr. Rajendra can deliver lectures in GST at spur of a moment. He is an acclaimed YouTuber and successfully runs YouTube channel named GST Ki Raah Mein Aapka Dost Rajendra Arora. Thank you, Rajendra ji, for being with us. I now request Chairman of the session, Senior Advocate Vikramji Nankani, for his opening remarks. Over to you, sir. Thank you.
Good afternoon, everybody. I must congratulate the organizers for this first virtual tax conference. The new normal that we are all getting used to. This is the time where we can really think of new innovative ideas. And I must congratulate the conference chairman, Mr. Vijay Kewalramani, in putting this act together. Today we have a very learned speaker with us, so I'm not going to take away his time. I'm just going to very briefly give a preface to the whole topic, the micro details of which CA Rajendra Arora is the competent person to deal with. So we all know that there was a lot of funfair when on 1st of July 2017, a new tax was introduced and slogans like one nation, one tax, everything was given. Constitutional amendments were also made, and a new regime was set in motion. We really have now to look back and see how the last 3 years have gone. I have had the privilege of looking at Rajendra Arora's presentation in advance. It has got some of the very, very telling issues which still need to be ironed out and creased out. And these 3 years have taught us a lot of lessons. In fact, a few constitutional issues also need to be tackled with. One of the issues is pending before the full bench of the Bombay High Court is that can one state now legislate in respect of its sales tax law for the period prior to 1/7/2017 in respect of pending assessments, pending appeals, and bring in new provisions, because Article 246A has been now supplanted, and you have got Article 248 also saying it is subject to Article 246A. We also have the Supreme Court judgment in Mohit Minerals where they upheld the constitutional validity of compensation cess. So if we expect now a COVID-19 cess, would that be something which will fall within the purview of Article 246A? Will it take color from Article 270 of the Constitution? Is Article 270 a standalone empowering provision to the Parliament which can make a law, notwithstanding whether the GST Council recommends that or not under the Constitution? So there are going to be several challenges, several burning issues, and I will leave it to Rajendra Arora to take you through nitty-gritties of these issues. Some of them are still real serious thorns in the smooth functioning of the business and the industry, and I'm sure you will all be enlightened at the end of it. Over to you, Rajendra.
Thank you, Vikramji. And now I invite our speaker, CA Rajendra Arora, to take the proceedings further.
Good afternoon, everyone. At the outset, would like to thank the organizers of this wonderful virtual conference for having me invited. Would like to thank Vijay sir, Kamlesh bhai, and all other Harish sir, and all other organizers. Would like to thank also the chairman of the session, Vikram sir, for setting the tone and giving the path to move forward on this. Friends, today we shall be talking about some of the issues. We have divided the entire. Can I have my presentation shared?
Yes, you can share it, sir.
Now, the moment I share my presentation, video goes away.
No. Yes, the video will go away. No? You just share the thing.
Just a second. Now that's fine. Yeah. Thank you. So today, next 60 minutes or so around, we shall be talking about the two aspects of the law. In fact, law as such should be one itself, but because of the arrangement, because of the constitution of the law, it has divided into two aspects. One, the law itself, and another is the executing authority, that is the Common Portal Goods and Service Tax Network. And whatever the law is, whatever the statute is, that is being implemented by converting into a soft issue, and then implemented by the Goods and Service Tax Network, commonly called as Common Portal. So we would be talking about both these aspects. That what are our expectations, and expectation in the sense that we have already celebrated the 3rd anniversary of the law few days back, and still I would say the celebrations are on, and I would continue to celebrate in spite of the fact that it is not that good and simple, which was being envisaged at the inception of the law, but still no law or no system can be perfect. We have to contribute and make it perfect. And 3 years, for past 3 years, I can always say with my conviction that Goods and Service Tax Council, GST Council, has been adaptive enough, and they have met for around 40 times, of course, including some of the meetings pre-inception. For last 36 months, they have met for around 40 times, and in every meeting they have come out with various suggestions, recommendations, which have been made applicable by the government. And this certainly shows the adaptiveness. This certainly shows the not only the adaptiveness, but yes, on the other side, we can always call it as uncertainty or frequent changes. When we say the basic rate notification for 1/2017 CTR has been changed around 15 times for past 36 months. So you can find that the basic notification, the rate notification for goods has been changed around for 15 times for past 36 months. So you can see every 2 months the rates are changing. I feel yes, to a reasonable extent, changing rates from 28%, the rate was having around 280 items around, and now only 28 items are left to be taxed at 28%, around 30 items if I'm not mistaken. So that way, in other words, it actually expresses the adaptability and the sensitivity of the council towards the issues which require changes or fitments which require regular updations. But at the same time, it perplexes the economy, the stakeholders, to catch hold of the things which are changing every other day. Sometimes when we see, when we talk to people in the society, in the economy, they find that the law is not in the same shape in which it was being started with. It is a kind of a jacket which was made by the tailor first, and then now it has been cut from many sides and many times, that the original shape of the jacket is somehow is getting lost. But that should not be the approach. So today we will be discussing some of the expectations which we feel, which we think that should be made into the law, or those which we feel that those are made should not have been made into the law. So we will be talking about some of those aspects, and then the portal, as usual, because generally what is set for portal is that what is there in the law is not on the portal, and what is on the portal sometimes it is not into the statute book, is not in the law. So it is largely expected by the portal that what is being visualized or envisaged by the law should be implemented in that spirit only. There are multiple occasions when the law said something else and it is being implemented in another manner. Just for an example, when we saw the change in section 49, the manner in tax adjustment, that the first IGST shall be adjusted with the input tax credit of IGST shall be adjusted, and it was introduced somewhere in Feb 2019, until July 2019 nothing happened on the portal, and portal kept on adjusting the input tax credit in the old manner pre in Amendment Act 2018, and later on department came out with the circular that even if you have done the tax adjustment in the old manner, when whatever the portal did, it is correct and there is no harm into it. So it should not be the approach. When the law is there, it should be immediately implemented into the portal, the executing authority, the administration, so that to enforce the trust amongst the stakeholders that whatever the law shall be implemented. So what happens is when there is a law and it is not implemented, so the people who have to follow the law, the society, the stakeholders start taking the law a little light also. So that way I'm actually talking on the very grassroots level what is been happening and what we have been evidencing for past 36 months into this. So moving ahead, to begin with, I would like to remind our learned August gathering today here through this conference, the canons of taxation by Adam Smith. Adam Smith is considered to be the father of economics, and in his book, much acclaimed book, Wealth of Nations, he has pointed out first 4 canons of taxation, and then after the need for having other attributes of a good taxation system, rest 4 from 5 to 8 were being added by future later thinkers after Adam Smith. So first, these first four attributes every taxation system should have into it in order to make it a better system, in order to make it more adaptive system. So to begin with, it has to have equality, equity. It should treat with everyone with equity. It means what Adam Smith visualized, that richer should pay higher tax and poorer should pay lower tax. So it should be having a principle of equity. Then it should have a certainty. Everyone, the law, the one who has to abide with the law, to follow the law, should know that what law is there for him to abide to or to follow. It should not be something which every day changes, so that the people who have to follow the law, the citizen of the country, the taxpayers to be precise here in GST, actually leaves the track, and then they forgot, and then they lose the basic idea what is to be followed, when to be followed. And just giving you an example of what is happening, which is in contravention of this second principle of certainty. COVID-19, this pandemic has actually turned around everything, the entire system, the way we actually look, the way we actually work, the way we actually live now, the entire mankind. And due to considering this, they came out with certain relaxations with respect to compliance part. But what is the present situation of the last dates extended for making compliances is known to everyone. Even the department, when comes out with a fresh notification, simultaneously comes out with a circular also explaining that what does notification say. So they also are not very much clear and very much certain about what the law should be. Whatever you want to do it in one go so that it remains for good long time, stable, so that everyone can actually follow it. And then economy, the tax, the collection of the cost involved into collection of tax should not be more than the tax collected. And this problem we have been facing quite a long time, even in the past regime as well, even in income tax also, direct taxes also, and in GST as well. So this canon also somehow is not being actually applied into our taxation system. So look at it. This has been propounded by Adam Smith way back in the 17th century, and still we are not able to follow the basics of a good taxation system. And then convenience should be easy to apply, should be easy to understand, and then elasticity, productivity, simplicity, diversity. These are the some other attributes of a good taxation system. But to have a more thrust over first four canons of this good taxation system. So I always wish that government or the lawmakers and the policy makers are actually listening to this, and they actually bring into these basic aspects with which the adaptability, the compliance, and many other things can be improved by default without making any extra effort into it. So with this note, I am going ahead with the expectations part. What we do expect, expectations not only would cover what are we actually expecting to do, but also what are we not expecting them to do, what are we not expecting them, that this should not be done. So we will be covering all these things. First, again very basic into the law part, starting with again the considering the backdrop of this pandemic. What comes into our mind immediately, that because of the lockdown there have been a loss of stock, huge loss of stock suffered by businesses, and those loss of stock would require writing off those stocks in books of accounts. What would happen for the input tax credit of those stocks which are being written off, considering the blocked credit of section 17(5) clause H of the GST Act 2017. So first expectation from the government is to have sensitivity, have empathy towards the businesses which are already facing, I would say, unprecedented slowdown in the world economy due to this pandemic. So if the ITC also on the stocks written off due to the loss happened because of I would say not taking care properly stock, or otherwise stocks were not being saleable, merchandisable because of many other reasons. So if this happens and then stocks are written off from the books of accounts, then what would happen to the input tax credit because of the application of blocked credit of section 17(5)H. So first expectation of mine is to be sensitive towards this, come out with the clarification, and you may actually give some circular also or some other notification by way of which that you can defer the application of 17(5) to this specific 17(5)H to this specific aspect. So this is first thing what we are actually looking forward from the government. Then considering the same backdrop of this pandemic, this worldwide problem which is faced by the human beings. Now, when humans are in trouble, other humans do come forward to help each other, and that's what Indian corporates have done in past few months. We have witnessed, and kudos to them, and the way they have come forward to help the fellow countrymen. Now, what happened? Even the circular has been issued by the Ministry of Corporate Affairs with respect to CSR expenditure under Section 135 of the Companies Act. Now, what is expected from the GST Council today on this day is with respect to this CSR expenditure. We understand that so far as income tax allowability is concerned, there could be some problem because of the expressive provision under Section 37, Explanation 1 attached to it under Income Tax Act 1961. But my dear friends, the problem which is of course I would say CSR expenditure is a very widespread discussion. I may not be able to cover the entire gimmick of it, but yes, when an organization distributes goods belonging, goods which are manufactured by them or are being traded by them or are being purchased by them and distributed free of cost to the fellow countrymen as a help, or even the services also provided by the corporate. So whether the input tax credit allowability should be made available to them, I expect the government to come out with a clarification so that in this problem time, in this I would say the pandemic-ish time, wherein the much help is required from every corner to actually sail through the times. So I would request the government to come out with a clarification by way of a circular that CSR expenditure, the input tax credit available on the expenditure made for ensuring the corporate social responsibility, whether it is mandatory or non-mandatory. CSR expenditure could be mandatory or non-mandatory, both mandatory under Section 135 or non-mandatory, even if you are not required to make some CSR expenditure mandatorily under a specific statute under Companies Act. Even if you do that, I believe you are doing the same in the course of furtherance of business only. You are building your image, you are building your brand, you are discharging your responsibility towards the society. You are a business, you are attracting more and more customers, and in a way you are helping the humanity. So I don't see that there are some jurisprudence already established on this aspect in the income tax as well, that I don't see that there is no humanitarian touch with any expenditure incurred by the organizations. So we cannot always say that there should be a direct nexus of any expenditure incurred with the activities performed by the organization. So in the course of furtherance of business, though the term is not defined in the law, CGST Act, but yes, taking a cue from dictionary meaning and the other judicial precedents which are already established even by the apex court of the country. So in a way we can always say that in order to expand, in order to enhance the image, in order to perform the activities which are the basic functions of the organization, whatever is done that shall constitute to be deemed to be in the course of furtherance of business only, and the definition of business is much wider under the CGST Act, and all the activities which we are referring, specifically CSR activities, shall squarely be falling into the business activity and in the course of furtherance of the business activity only. So, and it has not been to my mind if any allowability of an input tax credit is to be determined to two-step criteria, two-step test is there. First is that it should be it should be incurred or proposed to be incurred in the course of furtherance of business only, and then the second criteria that it should be an allowable credit under Section 16(2) and should not be blocked under Section 17(5) of the Act. And when we go into the 17(5) part, so to my mind, clause H, when we say goods lost, destroyed, written off, or destroyed by way of free samples or gifts, I don't think so. It is CSR expenditure would be considered to be either free samples distributed or gifts. So, and when we go into the construction of the word used, disposed of, that also according to various other judgments, and the apex court also has decided that thing, that when we say disposed of, it can be said to be it can be equated with the discarded. So discarded. So when we say goods or services distributed as responsibility of a corporate in this pandemic time, it cannot be equated with the goods discarded. So disposed of is always a discarded, but it is not discarded. So cannot be the phrase disposed of cannot be used here when the goods are distributed as assuming the responsibility of a corporate. So to my mind, both tests are being fulfilled. The credit should not be disallowed, but yes, we expect that in this pandemic times, in this distress times, when if a government comes out with the circular clarifying this, then it would incentivize the corporates to make more expenditure with respect to helping the other beneficiaries into the country. So this will be a second expectation of ours from the government. And then again, considering the present times, when we say Section 16(2), a second proviso of the CGST Act 2017, there is a provision called that when if the recipient fails to make payment of tax plus consideration within 180 days from the date of issue of invoice by the supplier, then the credit of the recipient shall be reversed by way of adding the credit into his output tax liability by way of Rule 37 of CGST rules. So when we say 180 days, considering the present times of pandemic, you find that there is a still lockdown kind of a situation across the country, even if it is unlock 2, unlock 3s in the process, but majority of businesses are not being able to do business properly. People are working from homes only, and it is spreading all the more. Community spread is around the corner if it is not being contained very soon. So businesses are not into their full-fledged mode, and business cycles are not there, working capital movement is not there, so they are not able to comply with the second proviso of Section 16 subsection 2, and they will not be able to meet out the condition, and certainly they would have to require to reverse the input tax credit already taken. But my dear friends, when I go back into the wordings, when I go back into the rationale of bringing this provision with effect from 1st July 2017, I find 3-4 reasons that this provision would not stand the scrutiny of judiciary in times to come. When we read the provision, I would request, please listen to me carefully, because I have not overburdened with you all with the provisions, and you already all know the provisions. That's today that the kind of structure the conference has been made is to actually do brainstorming at this juncture of 3 years. Then where are we actually heading to, and what should be the course of action now in times to come to this system to make it actually realize the objective of good and simple tax. It is I don't see that it is at present a good and simple tax, but yes, as I said in the beginning, no law, no system can be perfect. We people, we are the people who are making the law. We are the people who are making this a great country of ours. So we have to make it a great, we have to make it good and simple. So when we read the law, it says that when recipient fails to make payment, so thrust supplied, emphasis supplied on the word fails to make payment, and then fails to make payment within the due date from the issue of invoice, within 180 days from the issue of invoice, fails to make payment, thrust supplied, emphasis supplied. Please mark these words. And then from the date of invoice, then the recipient has to add input tax credit into his output tax liability. Now, my dear friends, into his output tax liability as the manner prescribed. Now, first is fails to make payment. The Contract Act says that when two contracting parties enter into a contract which is not against the public policy, which is not against the existing law, then it is a valid contract. Now, if a valid contract has happened between A and B, and A grants the credit tenure of 365 days to B, then B does not fail to pay till the time A demands, according to the contract, according to the conditions of the contract, which is the payment becoming due only after expiry of the 365 days. So Contract Act gives power to make a valid contract, and the when a recipient would fail to pay only when the due date comes for making payment, and if B fails to pay even after 365 days, which is the condition of the contract, then he would be considered to be failed to pay within due date from the date of invoice, when it is from the date of invoice. So first is this, and in the guise of this only, I wanted to supply emphasis to one more aspect towards it, is that how can the government put an embargo over me how to do business. My dear friends, if I'm not mistaken, Vikram sir, if listening, then I would request Vikram sir to put some light after this deliberation on this Article 31 of the Constitution, wherein it was said that the state shall ensure to every citizen of the country to have facilitate to earn his livelihood. To my mind, this embargo is a restriction imposed over me in contravention of the Article 31, wherein state has to facilitate me to earn my livelihood. If you interfere into the business, the way how I have to do business, maybe it could be a possibility that A got work from B only on the condition that he would be giving payment after 365 days. Then if the government compulsorily wants B to make payment within 180 days, then A may not be getting business from B in times to come. So that is embargo, that is a restriction, a restraint imposed upon me to do business in this country. So that should not be the situation. And then the Rule 37, which is addendum to the section 16(2) second proviso, which says that in GSTR 2, I would be adding into my output liability, and GSTR 2 is not in place at all. Then how can they ask me to reverse my input tax credit adding into the output tax liability? And there are various judicial precedents also already there in the country, wherein there is a law but no machinery provision provided. Then the provision itself becomes futile. The law itself becomes futile because there is no machinery provision provided, and GSTR 2 has not seen the light of the day till now for past 36 months since the inception of the law. Then I cannot be asked to reverse my input tax credit by way of adding into output tax liability because there is no machinery provision. So to me, this provision, maybe if not read down by the honorable courts of the country, but at least should be put to rest. And if the government comes out themselves to put it to rest in abeyance for at least 2 more years, considering the pandemic situation, retrospectively, because you guys are very good at making retrospective amendments. Past 36 months, you have made 60 retrospective amendments, so you can add one more into the bucket. So this 180 days should not be in operation, at least for next 2 years, considering the present economic situation, business working capital cycle. And so far as whether the this 180 days clause, 180 days issue shall fall into notification 55/20 released on 27 June 2020. Just for the reference of the viewers, listeners, I would like to reiterate section notification 55/20, whereby they have extended the due date of various actions falling within the period of 20th June till 30th August 2020 to 31st August 2020. So if any action which are enumerated into the notification, such as filing appeal, replying to show cause, replying to summons, or filing refund, or applying for LUT, or for exporting goods from the let export days within 90 days from the let export day, all these dates, if are falling within 20th March to 30th August, shall stand automatically be extended to 31st August. Now, whether this 180 days wala condition will be extended to 31st August, this is a question needs to be answered. To my mind, because GSTR 2 is not in operation, GSTR 3B is excluded from this 55/20 because Section 39 calls for GSTR 3B filing. So Section 39 is excluded from 55/20. So to my mind, 180 days wala condition does not fall into 20th March to 30th August, 31st August automatically. No, it would continue to be applied on the date on which it becomes due. So no relaxation for 180 days, but I strongly urge to the lawmakers, to the policymakers to please look into this aspect. This is not going to stand the scrutiny of jurisprudence in times to come. So is to save the image, save the face, come out with the notification to yourself put this provision into abeyance. Yes, another aspect which I would like to, of course, this special discount, post-supply discount has been much into discussion since the inception of the law. Circular number 92, 7th March 2018 came. Then circular number, if I'm not correctly remembering the number, 105, which was being withdrawn by the government, which was actually opening the Pandora's box. So I'm not going into those much details, because that is something which is very, very large topic to discuss. 30-40 minutes is required to discuss this topic itself. So, but I would request the government that yes, today, again, considering the present economic situation worldwide, special discounts, post-supply discounts would be more common. Otherwise, the people, the recipients who have stored the goods would not be able to survive. And we may be falling the big giants in times to come because of this standstill into the economic activities. I feel that the most important activity which government should focus on today, in my humble view, we have always been focusing on tax collection, taxing transactions, instead of creating an ecosystem into the economy, into the entire society, into the country, whereby promoting economic activities on which taxes are related. We are more focused on collecting taxes only, never focus on creating more economic activities whereby more and more taxes are levied on more and more economic activities. Number of transactions would increase, taxes would increase, gross taxes in absolute terms would increase without increasing the rate, without removing the benefits already given to the taxpayers. Now, how can you imagine an already given benefit can be removed post-dated, ipso facto? It cannot be possible. It is against the principle of natural justice. It is against the principle of equity. It is against the principle of certainty. You find a provision going in favor of the taxpayer, you come out with a retrospective amendment and withdrew the entire benefit given. Cannot be possible. There are jurisprudence already established in this country. There cannot be a banana republic. I'm sorry to use this word. So you have to think yourself that these type of issues are required to be addressed today. So if you don't do it, natural deaths, businesses would find their natural deaths, and no government would like to have this kind of a situation. This would reduce the employment generation. This would reduce the this would actually damper the possibility of self-entrepreneurship into the country, ease of doing business. Many things are being curbed and removed from the face of the economy if today one of the most significant fiscal statute is not being taken care properly. Next, which I feel special bailout packages required for hospitality, tourism and aviation. This is the largest hit of this pandemic is to these first three segments of the economy. So we have to have a special attention to these things. When we say hospitality includes hotels and restaurants also. At this juncture only, I would like to urge the lawmakers through this portal, through this webinar, through this August gathering, that lawmakers should come out with an option to restaurants to opt for 2 tax rates, either of them. At present, the rate of tax for restaurants 5% without ITC, no input tax credit. Majority of restaurants are already, majority of I would say cafes, hospitality sector, restaurants are already suffering with the huge fixed cost and total shutdown of the business. In near terms also, I don't think so that the society would like to go physically to those restaurants. Big infrastructures have been created and big fixed costs in terms of rentals and other fixed costs are being incurred every month by them. 5% without input tax credit. I'm actually very much concerned about the life of these sectors, because hospitality is one of the sectors which is one of the largest employment generator in the country. The daily wagers, one of the largest daily wagers get their employment through hospitality sector, including the banquet halls, the restaurants, the clubs, the cafes, the pubs, many other organizations of similar nature, even the small eateries, roadsides, many other. All these are covered under as restaurants as per the law, and the 5% without input tax credit shall require to be paid. So I suggest that there should be a dual taxation system, 5% without ITC and an option of 12% with ITC, with full ITC to the restaurants. This is another suggestion which was going to come in the succeeding slide. So when we spoke about hospitality, I thought to discuss here this suggestion only. So moving on, you know, whenever a thought of advance ruling comes to my mind, with utmost regards to the lawmakers, with these advance ruling authorities, quasi-judicial bodies, but of course headed by the departmental officials, with utmost regards. But whenever an advance ruling authority comes to my mind, it does not remain to be an advance ruling authority, but somehow becoming an adverse ruling authority. So I find, of course, I do read sometimes the advance rulings, because many a times I'm into public life, people send me various questions with respect to advance ruling authority judgments pronounced by various authorities. I have to read and view and to form my opinion on the opinions pronounced by them. But because we have witnessed in past 36 months, around 900 judgments have come, pronouncements have come out from advance ruling authorities across the country. If an organization is registered in 29 states and it is having a particular issue to be decided by the advance ruling authority in advance to be safe, sound, and on the positive side of the law, then it has to refer to various 29 advance ruling authorities. So that way, and otherwise also, if a registered taxpayer goes to a particular state advance ruling authority on a particular issue, and the same issue is being presented to the other state advance ruling authority, the judgment are at contrast. They are at complete deviation from each other. So how would a person decide on a particular aspect? So it is creating more of confusion than bringing clarity about the law. Advance ruling objective, authority objective has been visualized by the law while framing it, is to actually have clarity beforehand, before actually entering into a transaction, because this is a transaction based law. Transaction based assessments are there. So the purpose is somehow is not being met completely. So that is why I strongly feel that an authority, national advance ruling authority, should be made with an immediate effect, giving effects to sections already there in the law, section 101 capital A to 101 capital C. So this is another expectation or a suggestion or a strong requirement of the economy or the stakeholders today to have a national advance ruling authority and pronouncing judgments on national issues instead of making every issue state specific. It's a one nation, one tax, one market. So it has to be a, I would say, when a particular issue is decided by the government or the advance ruling authority, it is uniform. It should be uniform for the countrywide application. Although the judgment is made applicable only to the applicant, no doubt about it, but the ratio decidently can be established for others to follow. At least people are reading these judgments to understand the mindset of the administrators of the law, and divergent views, deviating views. So this is another thing, section 73, 74, this time period should be counted. Of course, the first time period is just started from 7th Feb 2020, because section 73 and 74 says within 3 years or 5 years respectively from the due date of filing of annual return. So my dear friends, for 17-18, the period has just started for section 73 and 74, when they can open the show cause for issues pertaining to previous 3 years under section 73, and they can show cause for determination of tax, interest and penalty under section 74 for past 5 years. So just the time has just begun from 5th Feb 2020, which was the last date for filing the annual return for 17-18. So this time should be counted, the COVID time, because the business is disturbed. So again, one more request to the government to please create an image which is a taxpayer friendly. Do not consider every taxpayer. I would say that the government should not be in a view that maximum tax should be extracted. Even the many officers are of the view that the taxpayers are merely the agents of the government to collect these indirect taxes. Similarly, I also strongly agree with the fact that the taxpayers are merely the agents for the government to collect taxes from the end users, the final consumers who are actually using the goods or services. Those users do pay tax. They are just the mediating agency, the taxpayers. So taxpayers should not be viewed with a preconceived notion. So they should be viewed with the, I would say, utmost sensitivity towards the businesses, and especially in this distress times. Again, now here comes one more, I would say, I don't know, I do call Rule 36 sub Rule 4 as the impossible eventuality. It is impossible to do, and eventuality is there. I don't know when would we actually be able to implement it. I'm not going into the nitty-gritty, the legal scrutiny of it, whether this would stand, whether this would be read down, whether it is constitutionally valid, whether the law permits the lawmakers to actually do it or not. I'm not going into those details. This has already been challenged before the Honorable Apex Court by way of PIL and various high courts of the country, including Delhi, Gujarat, and Punjab and Haryana. So I would just only be requesting the government, though they have suspended the operation of Rule 36 sub Rule 4 for starting from Feb till August, 7 months. I strongly urge the lawmakers, the GST Council, the CBIC, to please rationalize this provision. This is not something which actually, something which is giving, again, with my humble understanding, I feel as a normal citizen of the country, that from every corner in this law, the government is squeezing the taxpayer just to extract more and more taxes. Whether it is a correct manner, I would say moral policies being upheld or not, is not being taken care by the government. So my mind is actually struck with this aspect also. When how would a bona fide recipient would ensure that the supplier files returns? And what would happen to those quarterly taxpayers? Those file their section 37 return quarterly, and they would never be able to, and I would be taking credit under section my 39 return, that is monthly. So on the one side, the law itself prescribes the remedy for the, or the facility for the quarterly filers because of the aggregate turnover, threshold of aggregate turnover. On the other side, one provision of the law is at the logger's head of the other provision of the law. Why can't we rationalize it? This one, at least you came out with a circular in November 2019, when 1st October 2019 this provision was being implemented. 9th October, I beg your pardon, 9th October 2019. Then in November you came out with a circular, but refrain from clarifying this issue. What would happen to the recipient if my supplier is a quarterly filer? So are you asking me to stop doing business with quarterly filers? Or are you asking me to impose upon him that you become monthly filer, then only I'll do business with you? On the one hand, you are concerned with the reduction of cost of compliance for MSME. On the other hand, you are actually creating an environment in the country. Even from 180 days wala issue, even if bigger corporates are afraid, if you have to ensure or install the financial discipline into the system for MSME Act is already there, which ensures if payment is not made within 30 or 45 days, then the interest shall accrue to the recipient of the goods or services. Then I don't know why you are actually creating an environment, whether it is intentional or unintentional, I fail to understand, but the environment of such nature is being created into the ecosystem that MSME is to be suppressed. No, rather we should actually motivate the self-entrepreneurs. Those are the lifeline of the country. They are the largest employment generators of the country. So you cannot actually have this kind of a policy which is not promoting MSME. So on the other hand, you came out with the enhancement of the limits of considering any organization as MSME even to 100 crores. And this ecosystem is suppressing MSME. I don't know why. So I strongly recommend and request the government that Rule 36 sub Rule 4 should be suspended immediately, sine die, and save the image of the government before the court actually asks you to do so. And then you go for retrospective amendment. I'm sorry, what are you going to do with this also? Likewise, what you did in brand equity, you came out with the section 145 a retrospective amendment within prescribed period. Brand equity said that there is no prescribed period, so you installed the prescribed period within section 140 itself from retrospectively. I don't know why you are actually so much adamant about admitting the due legitimate credit of honest taxpayers, which has been forgotten or which has been left out to be taken into the new regime. You are still coming out with the various aspects of the law. You are still pondering on various nitty-gritty of the law, and you are expecting the honest taxpayers or the taxpayers of the country to be much conversant with the law and comply the provisions of the law on the day when it is being told only. And your portal itself is not being very much ready, totally into different shape what is being expected. So I don't know what is, but yes, I assume my responsibility to keep on speaking without fear and favor, and because I feel that the only concern or the only loyalty of mine should be towards the law, towards the subject, and not to anybody else. Even I am not considering that the taxpayer should be given with the undue advantages. But yes, the lawmakers should also consider the reasonable plight of the taxpayers and the stakeholders of the country, stakeholders of the law. This also Rule 86 1B. This is again the same thing. You are expecting me to ensure that the supplier pays taxes. How can you do so? How can you actually think? Now, when we go back into VAT regime, all the learned scholars of the subject are on the platform also and listening also. Mahalakshmi Cotton Greening Mill, Bombay High Court. On the similar line, Arise India, Delhi High Court. Arise India judgment was favoring the bona fide purchaser. When a seller does not pay the tax, if it is bona fide purchase, then the purchaser shall not be asked to pay taxes. On the contrary, Honorable Bombay High Court said something on the contrary, that the purchaser is required. But Arise India favorable judgment of Delhi High Court went to the Apex Court by way of SLP on the pretext of the department. SLP was rejected. To my mind, yes, if SLP is rejected, so this is somehow a larger established principle in the previous regime also, and you are actually bringing out all those texts which are already settled into their long, deep rooted coffins, but still you want to bring them out and still fight on the same issues. I don't know why. So this also is somehow giving rise to the same plight of the honest taxpayer, that is, somebody is asking me to ensure that supplier pays taxes. I don't know how it would happen. So I request that please, and blocking of credit itself also is a much tedious problem. The proper officer is being given power to block credit for anything and everything. So how it is possible? Then RCM issue is there. I feel that RCM should be brought back, and at least 9-4, so that it increases the revenue collection. Every registered recipient should be asked to supply the permanent account number of the unregistered supplier, so that the aggregate value of the supplies made by the unregistered supplier is clubbed, and the moment it increases the threshold of 40 lakh, the automatic notice of getting itself registered should be went to them, and this would enhance the tax net, which is the distribution chain. Entire distribution chain in the society is not being into the tax net, and eventually we will automatically be the $5 trillion economy. Construction per works contract is not allowed. Safari retreat judgment is everybody's delight, but that is again challenged in the Supreme Court by way of special leave petition by the department. Though the operation of the Safari retreat, Honorable Odisha High Court judgment is not stopped, I strongly urge that manufacturing, hospitality and real estate today, considering the pandemic, considering the world economies, considering our neighboring countries, considering the possibility of converting India into the next manufacturing hub for the world, much more investment into infrastructure is required to be made by the manufacturing sector. Please give this benefit to them so that they feel at least a little cushion for their input tax credit incurred on the construction of immovable property. This is something which is very important. Hospitality and real estate. Please, these measures would actually boost the confidence of the sectors. More and more investment would come, more and more economic activities, more and more taxes, more and more prosperity, my dear friends. It is a complete win-win situation for everyone. I don't know when would people come to know. Another wishful thinking of mine is, my dear friends, is intersectorial ITC of CGST in one state should be adjusted to output tax of CGST in another state. You have already a wonderful clearing mechanism within the states and the center, so you can do this also, and the law is amended when the input tax credit of one CGST of the distinct person can be adjusted against the output tax payable of the another distinct person. Then why can't I do so when the lawmakers or the administration can do so? Why can't I do so? Even I am thinking, of course, it is my wishful thinking, Sheikh Chillipana, that the credit, whenever is available to me, should be converted into a bearer instrument, a tradable script, and should not be asked me to go for refund. Departments unavoidable problems or the difficulties can be removed, and this credit can be available to me. I can always sell in the open market. Credit is credit, would be used only for offsetting the tax liability. So no refund process should be there, and this thing can be easily mitigate many manpower which is utilized. Tribunals should be formed ASAP and would reduce much workload on the Honorable High Courts, and they can devote more time on catering to the factual issues. Then they can give more time to the legal issues also, and should be of course Madras High Court judgment is there. A little difficulty in the formation of tribunals, but yes, it should be overcome immediately, and tribunals should be formed in the interest of justice to one and all. As I said, retrospective amendments should be avoided. It does not give a very positive image of the government. It gives an image as if that the government, wherever finds something going against them, they come out with a retrospective amendment and taking away the already provided relief to the taxpayers. This should be avoided to not further hampering the image of the lawmakers. As I discussed with this also, Rule 36 and 16.4 requires little more clarity. We have already discussed this. We have already discussed the credit should not be exporters do pay reverse charge and then they seek refund. So what is the need? What is the reason for that? You are blocking working capital of the exporters, and on the other hand you are putting more workforce on granting refunds on the same, and thereby the leakages is also possible. There could be surplus people in the system also who may seek for some ineligible refunds. So you come out with the policy that exporters should not require to pay RCM and should not seek for refund of the same also. And decision making is very taking time. Many things have been suggested, many more things can be suggested, but please come out with the solutions as soon as possible to install the confidence which is little shaken of the society, of the tax practitioners, of the professionals, of the taxpayers. So that confidence has to be reinstalled. I request that other than the suggested issues which are beneficial to the society and the taxpayers, no further changes should come in the law, at least for next 2 years. Have patience, bring certainty so that the confidence of the society, the stakeholders are being reinstalled. This is another ease of doing business. 10,000 till you may pay into cash or check. Why can't you allow a UPI system into this portal so that you can pay through Bheem UPI, Paytm, XYZ, many online wallets are there and you can pay taxes. And now in order to pay more than 10,000, the taxpayer has to take online banking. All MSMEs are not very much tech savvy. They cannot, now the cyber frauds are increasing day by day. So why don't you give this facility to the taxpayer to pay taxes through UPIs and Bheem app, very other online wallets are there. So this is something which is again ease of doing business. I discussed the restaurant. This is again one very important aspect when there are two distinct persons. One is in SEZ, one is in DTA, domestic tariff area, and DTA charges some cross charge to the SEZ entity. SEZ entity accumulates input tax credit but do not have any facility to seek for refund of the same. Section 54 is completely silent for this. So I request that many SEZs, I have encountered with at least 10 such SEZ cases wherein department is totally rejecting, even not rejecting, but making show cause. And after doing show cause, they are passing the order of rejection, and then we have to go for filing appeal also. So this way, this is creating more and more litigation, more and more trouble for their own monies. Cross empowerment is another very troublesome issue. Earlier, September 2017, they came out with the first circular, and then they said that the only state shall, they employed the random sampling, random technique to find out those taxpayers would be administered by the state authorities and central authorities. And then they came out with one more cross empowerment only with respect to, I would say, intelligence based inquiries. But today, a recent High Court judgment was there. I'm missing the name of that judgment. Recent judgment wherein in 2020 judgment was also only there. Wherein the Central Tax Authority started assessment proceedings and state tax authorities started assessment proceedings on the same issues, and the taxpayer has to go to the High Court by way of writ, and then the High Court decided that only the authority, which is the Central Tax Authority, which is already had initiated the proceedings, would only continue with that, and state would not do. So cross empowerment issue is requires to be, even section 129 wherein the conveyance of goods, carrying goods is being intercepted and then penalties are imposed. Cross empowerment issue is cropping up every day. Very, very big problem. I am registered in Haryana. Goods are moving in Gujarat. Gujarat officer intercepted it, and then they asked me to pay taxes. Instead of sending the case to my proper officer, I have to go and file appeal to them only, and they are not following the procedures. Also, taxes are paid. I contested appeal, fought and won, and the tax required to be refunded. Now the department says the temporary registration which was being awarded to me in Gujarat is now being done away on the portal itself. Now what would happen? Nobody knows. So these are the issues of cross empowerment also, which are troubling a lot. Now moving ahead with the portal, now just last 5 minutes, because I'm afraid I'm already crossed the time limit prescribed to me. If anybody can confirm how long I can continue.
Sir, another 5 minutes are there.
Thank you, sir. So portal has always been tooth and nail. It is actually, when I say in Hindi, ये हमें लोहे के चने चबवाए जा रहा है, चबवाए जा. So it is actually giving us complete bad taste since last 36 months. I feel law is not that bad. I'm sorry, I'm using the word that bad. Of course, there are certain improvements which are required to be made, but law is not that kind of a piece of statute which is totally not. It is very good piece of statute, but the implementing agency, that is the portal, that is one very important pillar of the administration, is not being able to implement it the way the law is being visualized by the lawmakers. Look at the GSTR 1, 2, and 3. My dear friends, earlier in VAT regime, we used to work very closely across the country in VAT regime. Of course, the portals were totally different in all 39 or 29 states, 31 states. But by and large, the revenue leakage in terms of bogus billing, fake invoices was being curbed to a largest extent. Had this GSTR 1, 2, 3 been in place, this would have, what is being faced today, we have been evidencing across the country, the kind of rackets which are popping up unearthed by the intelligence agencies of the government. We would have not seen those revenue leakages, biggest frauds in the era. So similar, whose shortcoming it is? It is certainly the portal's shortcoming, my dear friends. I do not like to criticize, but at the same time, unless I do not speak, of course, even the various high courts also have said the same things to GSTN many a times earlier. But we are the largest, one of the largest exporter of software in the world, and we cannot even cater. Pardon me, by taking name of Amazon, Flipkart, Paytm, many other online software portals, Zomato, Swiggy, wherein lakhs and lakhs of people are actually using the portal software on the same time, and it does not give any kind of a such response that only 1,50,000. Now they are saying now we have doubled the capacity, only 3 lakh people only at one point of time can use the infrastructure. I don't know, when there are 1 crore 30 lakh people are there. So you generate the infrastructure according to that. So today also I would like to strongly request them, please do tell us whether with effect from 1st October 2020 also new return forms are coming or not, so that we prepare. We do prepare, we read it, we find the nitty gritties, we follow the mechanics of the form, and then you, because of your system is not ready, you come out with the extension one and again. So please inform the society, inform the stakeholders in very much in advance that what are you going to do. Take the season. Even if you defer it, no problem, no hurry. You have got section 43 capital A, which is giving you the power to implement these new form supply return forms. You have already implemented partially the section 43 capital in the form of rule 36 of rule 4, though that may find the agony of the jurisprudence in times to come. But you actually tell the stakeholders that what are you going to do with these forms. Infrastructure, I told also already, IT infrastructure requires total upgrading. Please do that. It is in the interest of the society, in the interest of the economy. Of course, e-way bill system is working so beautifully. Then why can't we have GST? And also, why these staggered dates are there on the pretext of the fact that all the people do come on filing on the last day. Last day you have provided, I may come on the last date, 23 hours, 55 minutes. 5 minutes are taken for the return forms to file. I may come on the 23 hours, 55 minutes. Why can't, how can you stop me to use my lawful right of filing the due return by the due date? You cannot stop me. So you rather create, it is your responsibility to create an infrastructure to facilitate to do what you are asking me to do. You are saying many other things. I don't want to go into those details now. So, but it is strongly recommended to the portal, to the lawmakers, to please give some time for the portal also. This has already been, as I was referring before the start of the program also, this is one of the issue. Online, you reject my refund application and now I have to file an appeal. There is no facility provided on the portal to file appeal for the rejection of refund. And when I go to the department, proper officer, he says, I don't have any guideline to file manual refund appeal for this. Now, where would I go? Where is my refund? Where is my money? I cannot, wait for perpetuity till this universe remains, that my refund comes. On the one hand, you are saying that refunds are expedited, refund payments are expedited. On the other hand, these are the issues which are cropping up every other day. Form 9, I always speak and speak very at the top of my voice. As I said earlier, my only love is the love towards subject. My only loyalty is the loyalty towards the subject. I don't want that there should be a revenue leakage for the government also. I don't want there should be a unjust treatment for the taxpayer also. Now this Form 9. Form 9, you asked me to file Form 9. You guide me that while filing the Form 9 for 17-18, for 18-19, if your supply is left out to be reported, this is an opportunity to, on 3rd July, you gave a press release and guided me, though I don't know what is the legal sanctity of that press release. So you guided me, if you have 3rd July 2019, if you have forgot to report your supply, then you can report the supply in Form 9 and pay taxes. Now, my dear friends, if I add table number 4 in Form 9 with additional supply, which has been auto-populated from GSTR 1, if I have forgotten to report, then auto-populated GSTR 1 supply is not matching with my book supply. So supply which is there in books, I changed the auto-populated supply and added more supply. Now what happens is, I am a very innocent taxpayer. I have a supply of maybe 50 lakh, 40 lakh, 70 lakh, but I have to file my annual return. Though you have made it optional for up to aggregate turnover of 2 crore, that is separate, but I am filing. Even if I am more than 2 crore, I am filing. Now what happens is, if I increase the supply in table number 4, technically the form itself should ask me to pay the difference of tax liability which have increased, but the form does not ask me. I'm sorry, ironically. Supply increased from 100 to 120, but 20 rupees additional supply tax on that form does not ask me to pay. I can file the form without paying the additional tax liability created by myself. And inadvertently, innocently, I pressed the button submit and filed. And I thought now the portal would ask me to pay the tax. Now the portal would ask me to pay the tax. Portal does not ask me to pay the tax. And the return form 9 is filed. And I'm waiting, then the mail will come, I'll pay the tax. I'm waiting, the message shall come, I'll pay the tax. Nothing comes. I forgot. And the department doesn't have any control over that. Then what would happen? The honest taxpayer who was ready to pay the tax of the differential tax liability did not pay. So my dear friends, this is something which is, a simple Excel file can be created. My first year article in the office can create an Excel file where the result can be controlled. And here the result is not controlled. I don't know what is going to happen. Form 9 requires amendment because while filing Form 9 of 18-19, 17-18 details are not being a proper tabulation is not provided to me. So requires revision, requires clarification from the department. Please do the needs. Another aspect which is very interesting, but I have last 1 or 2 slides, I am finishing it off. Now, while filing my TDS return, this is a very interesting aspect on the portal. Though I do not use much portal, but because I am into public life, so many queries do come to me every day. And then query come, I research into it, probe into it, then find actually this is the problem. Now, this is the problem which I am trying to bring home in front of you all. I am a supplier. I supply goods to the government department. And according to section 51, if the value exceeds 2 lakhs, then the government department has to deduct tax at the rate of 2%. 1% each, 2%. Now, I have many suppliers, I have many recipients to whom I supply. Say, for example, 5 recipients to whom I supply goods. 4 of them deducted, paid, filed return. 1 of them did not deducted but did not pay the tax. Government department, you can't force them. Now, while filing for the TDS return, TDS entry acceptance, I have to file a return for accepting the TDS entries appearing in my login ID, and then only after accepting those entries, those tax deducted by my recipient appears in my cash ledger, electronic cash ledger, and then I can utilize it. I can do whatever I want with that cash ledger. Of course, I cannot buy a pizza for my family from that cash ledger, ironically, but yes, I can pay taxes. I can even now form a PMT09 is on the portal now. I can transfer the tax from the one major head to another major head or minor or whatever I can do. Now, out of 5, 4 deducted, paid, filed return, 1 did not. Now, that 1 entry is not appearing in my TDS entry for the relevant month for which 5 entries were there. Now, what happens? That one particular deductor, the recipient of mine, I am the supplier, pays the tax 2 months thereafter from today. Say when in July, deducted, pays in September. Now he files for July return, appears in my July TDS entry. But the moment I accept remaining 4, that the remaining 1 entry, the moment I accept remaining 4 and file my TDS return, now the next entry, 1 entry which will be filed in September but appearing in 2A ledger would not appear to me because the July TDS return is already filed. Now what to do with the tax deducted, cash tax deducted? What to do with that? I have informed many GST officers by way of this August gathering, this wonderful, very elite platform. I would like to bring home this fact for the concerns that this is a very big trouble for the innocent taxpayers. GSTR 2A, I don't know why the GSTR 2A is troubling me all the more now. GSTR 2A Act does not have any legal sanctity. By way of rules, you cannot bring anything which commands the credit of tax. It does not it does not borrow power from section 16 subsection 2, and nothing is there. But still GSTR 2A is becoming the lifeline for all the recipients of supply of goods or services. So 2A, when one entry is there, when entry is amended after 2 months, maybe because of many reasons, then amended and original entry both appears. That also creates confusion. Now this is something which is very common. When you amend a particular entry, the original entry, if you allowing that original entry to be amended, then original entry should be removed from the portal, and then the only amended entry should appear. I don't know for what reason. Of course, they may be having some good reason, but this is creating confusion, and this is even creating revenue leakages also. Original entry for 100 rupees credit, amended entry for 80 rupees credit. Recipient taking 100 rupees credit, though he is eligible for 80 rupees credit only. So now here reaches to our last slide, and I hope that I must have done the justice to the topics which is being given to me, and I must have ignited the minds, the very brilliant minds of our country, so that to actually think on these lines and bring some changes which are required to realize the dream of good and simple tax. Thank you for the organizers. Thank you, Vijay sir. Thank you, Harish sir. Thank you all. Thank you, Kamlesh bhai. Thank you all the other organizers. Thank you, our chairman sir, Vikram sir, for allowing me this opportunity. Thank you all. Thank you.
Thank you. Thank you, Rajendra ji, for such a marvelous and a detailed presentation. I now invite our chairman, Shri Vikram Nankani ji, to share his concluding remarks, and later we will take on the questions that we have received. This time, sir, we have received lots of questions for you, so we will try to complete limited time, whatever questions we can take, as the time permits. Shri Vikram Nankani ji, please.
Yeah, thank you, Rajendra Roy. That was really, really illuminating. I think you touched upon topics which are both historical, which we have been experiencing in the last 3 years, and also the problems that we are presently facing, especially aggravated by the pandemic that has captured the world over. You did touch upon some of the topics, and one of the aspects that you said, ease of business and what is the constitutional provisions for that, especially in the context of 180 days. It is unfortunate that the government does take resort to the exception created in the constitution, and they do not really deal with what the constitution permits in terms of Article 19(1)(g), which talks about freedom of trade, business and commerce. And that's one of the fundamental rights guaranteed to every citizen under Part 3. They often take recourse to the exception in Article 19(6), which is if the restrictions are reasonable, then the government can always put reasonable restrictions on the fundamental right to carry on trade, business and commerce. The all-important question is, what is reasonable? And there's no one size fits all. And that is where I think the government has the luxury of playing in the joints, does take full advantage of that kind of a situation. And Tran 1 is a great example of that. 3 years, this baby is still having teething problems. I don't know what will happen for it in the next coming years. By now, it should have got over all the teething problems, technical issues, which you so very rightly pointed out. The network, which was TomTom to be the backbone of GST, which would enable it to operate smoothly and seamlessly across the country, but that has really not withstood the pressure of the system as a whole. So we have seen conflicting judgments. Delhi High Court saying something, Bombay High Court first saying something else, and now recently, 3 days back, taking a different course altogether in the case of South Bees and permitting it to be filed by the end of the month. Now, all these show that there is not only a problem at the government end, but there is a serious issue with the courts not having uniformity in the interpretation of this one statute, which is supposed to have been the fabric on a pan-India basis, coupled with the fact that there is complete apathy of the courts to GST. One thing we all recognize is that if judgments do not come in time, if the courts take their own sweet time, and that situation has now been compounded, the misery has been compounded by the lockdown and the pandemic. If they take their own sweet time in interpreting the law, everyone in the field operations are going to have a great day, a gala day, and each one will pull and push in his own way the law. And that will lead to a complete chaos as far as the administration of the law is concerned. So we need quick courts to react quickly. They should appreciate that this law, if I am going to keep the final hearings at the end of 4 years, 5 years, you are not going to achieve anything. So very well said about the retrospective amendments. We have seen recently also the retrospective amendment in relation to these same transitional arrangements about the timing, the power to have timing of the prescribe the time limit, and that amendment has also come in 2020. There are various other issues, for example, inverted tax structure refunds. There was an amendment made last year, and one doesn't know what is the full scope of that amendment. That is still to be tested by the courts. And there again, input services are not part of the formula in calculating the refund in case of inverted tax structures. I mean, I could multiply and go on, and so very rightly brought out by Rajendra Arora about the multiple issues that we have. The adverse authority for adverse ruling, if I may call it, that is a real pain as far as the SSC is concerned. It was supposed to be a place where people could go and get first aid. Instead of first aid, now that has become the last recourse for the SSC. Time doesn't permit us. The moderator, the MC has told us there are a number of questions for the speaker. I'll leave it to the speaker to deal with those questions. Thank you, Mr. Chugani. Thank you, everybody on this panel.
Thank you, Mr. Nangani.
Harish, just a minute before we proceed. I would just like to inform the chairman and the speaker that this recording will also be shared with the GST Council Vice Chairman. We already spoken to him. So your message will be forwarded, sir.
Thank you very much, sir.
Thank you. Chalo, coming to now question and answer sessions, I'm going to take some of the questions because the time has already gone. So we will take 3-4 questions from the availability. So let us start. The very first question, I think so you have already addressed in your deliberation that there is no appeal mechanism. Online mechanism is still not there, and physical appeal filing guidelines are not available with the officer. Now going to another question is, can slump sale exempted from tax under GST can be a tool to escape liability in the hands of taxpayer? Since Schedule 2 exemption notification only deals with taxable person, what would be the position in case of person exclusively dealing in exempted goods and services, where business as going concern is transferred? Can proper officer take recourse of Section 85 in case of transfer of business as going concern in case of transfer of business by person dealing exclusively in exempted goods and services? Example like pathology labs.
Sir, this is very rightly pointed out that slump sale can be in the guise of transfer of business as going concern. So yes, I also agree in concurrence with the queries that the department, the proper officer can actually, so far as specifically what he has asked for about the supplier who is exclusively into supply of exempt supply services like path lab, diagnostic sectors. So that could be a very well possibility. And but I feel that in order to give a true color of the transaction, the agreement would come to its savior, and the agreement should be designed in such a manner that if it is actually not a slump sale and actually a transfer of going concern, then all the assets and liabilities along with the other things should be transferred as such. So that way, it would be difficult for the proper officers to assess that transfer as a slump sale instead of transfer of business as a going concern.
Thank you, sir. So there is another question which I am taking up. It is whether ITC is available on GST return for March 2019 submitted on 22nd October 2019. Return is delayed by 2 days. Last date to avail ITC credit for 1819, which is 30.
If I'm correct, if I'm thinking correctly, the last date for 1819 was 21st August, 21st September. I'm sorry, 21st October for filing 3B return of September 19. September 19. That date was extended by 1 day.
Correct.
If I'm correctly remembering it. So if you file on 22nd October, then you are filing 1 day delayed. And the credit pertaining to March 19 shall not be available to you because of the application of section 16 subsection 4.
Thank you, sir. Another question which I'll take it up is, this will be, I think so, the last question, as we have to conclude with the vote of thanks also. With lockdown now being implemented at local levels, Section 5 of the Limitation Act ought to be made applicable to allow the jurisdictional officer or appellate authorities to condone delay in compliances?
Sir, for this matter, the CBIC has already addressed by way of this 35/20 and then substituted with 55/20, wherein the time limit, whatever the thing which is being falling within 20th March to 30th August shall stand to be due dated on 31st August. So law of limitation, somehow they are not even considering the entire period for that matter. The due date is automatically falling on 31st August. So that has already been taken care, I believe.
Yes. Thank you, but I'm sorry to all the delegates, the other questions cannot be taken up right now, but definitely we will try to pass on these questions to our speaker and try to address your queries. Now coming to the task of vote of thanks, I would like to thank our esteemed chairman and speaker for the session for gracing the occasion and rising the bar of this conference. Chairman sir, it was really a pleasure listening to you and having such a vast experience behind you, and you sharing your experience with us is like a blessing given to us. And coming to our speaker, sir, yes, you have did justice to the topic. The name of the topic is GST expectations from the lawmakers. So expectations means उम्मीदें, उम्मीदों पर तो दुनिया टिकी है. So वही हम कर रहे हैं. आपने काली रात तो बहुत दिखा दी हम लोग को, and लास्ट में आपने बोला कि we expect कि lawmakers सब ठीक कर दें. Like advanced ruling is nothing but adverse ruling authority. But again, we have to have faith in our law. So thank you so much for coming out with each and every point, like Rule 36.4, Rule 86.1b, payment within 180 days, post-supply discounts and all. You have rightly touched to the important topics of our business industry. I thank you so much once again for such a good and marvelous presentation. Thank you. Thank you all.
Thank you.
Thank you very much.
Thank you, sir.
Thank you, Chairman, sir. Thank you, all the organizers. Thank you, Vijay, sir. Thank you, everyone. Kamlesh bhai, thank you.
Sir, we shall now take a very short break and we will come back at 3:45 p.m. sharply. Thank you so much. Welcome to the third technical session of the virtual National Tax Conference. For this session, I welcome the following dignitaries on the dais. Srimati Premlata Bansal, Chairperson of the session. Shri Siddharth Ranka, Speaker of the session. CA Bharat Sajdev, Conference Convener. CA Arvind Ramani, Tax Practitioner Association. For this, I invite CA Bharat Sajdev to introduce Chairman and Speaker of this session.
Good afternoon, all. It's a proud privilege bestowed upon me to introduce our chairman and the speaker today. Our chairperson for this session is a senior advocate designated by the Delhi High Court, Mrs. Premlata Bansal. She has always been a bright and shining student, be it senior secondary school exam, where ma'am was a rank holder. A knack of reading and learning can be gauged from the fact that she did a year in BSc and then pursued MBBS for another 2 years. And then, after a gap of 12 long years, resumed studies in Delhi and did her BCom honors, followed by LLB, and bettered it by doing CA. Wow. This is the kind of thirst for knowledge a session chairperson has. Not the one to be stopped, she started a practice in Delhi and in no time started representing the income tax department and rising to become a designated senior advocate by the Delhi High Court in 2011. She has been associated with various organizations during her career. Timelines, prominent amongst them, she was the national president of All India Federation of Tax Practitioners for the year 12-13, president of Delhi Tax Bar Association 2005-6 and 7-8. A regular columnist, she has written numerous articles in journals and has given many representations with the departments, particularly on the income tax laws. Thank you, ma'am, for accepting our invitation and agreeing to chair this session. Thank you, ma'am.
Thank you, Bharat Bhai, for your comments for which I do not deserve. But in any case, you have done your job and now I am starting my job.
Please, ma'am.
Friends,
please.
before should I start?
Yeah, ma'am, I would give you opening comments. After that, I will introduce the speaker. Please, ma'am, with your opening comments now.
Okay. So, first of all, friends, I want to congratulate Tax Friends Mumbai and the other associations for successfully organizing this virtual webinar. I am grateful to you all for giving me this opportunity to share my views. Friends, we are passing through a difficult phase. When first lockdown was announced, it appeared so difficult that how this phase will be over. However, with the advent of these webinars, the first amongst all was started by this consortium, for which they should be given appreciation. Guthi kuch kuch sulajhne lagi hai. Vision hatched by the organizers became successful. Former President of India, Dr. APJ Abdul Kalam, once said, "Vision elevates the nation. National development is powered by competition. Competition is powered by knowledge. Knowledge is powered by technology and innovation." So it is this technology that we are able to meet each other and share our knowledge for the benefit of all. Friends, once again, I congratulate to organizers and to the delegates. Now I coming to the subject. Today's subject is interplay between the deeming fictions under Income Tax Act 1961. Deeming provisions are a familiar feature of legislative text. Rather, it is a powerful tool, powerful weapon in the hands of legislature to tax all which is not the income actually. So what is this deeming provisions? What is to deem? The word deem and its variations are not defined in the statute book. The concise Oxford Dictionary defines the word that deem, to deem, as to believe, to consider, to judge, or to count. Webster's Dictionary provides the meaning as to come to think or judge, to consider, to have an opinion. But none of this meaning are helpful to us for understanding the deeming provisions under the Income Tax Act. Every deeming provisions under the Income Tax Act is created with certain purpose, certain intent, certain object sought to be achieved, and that can be gathered. How can it be gathered? That can be gathered by applying the hidden rule or the mischief rule of interpretation. That is, what the problem sought to be remedied. That can also be gathered by the memorandum explaining the provisions introduced in the Finance Act. In the legal context, deeming provisions are typically thought of as creating a legal fiction. That is, declaring that legislation is to be applied as if something were different from what is actually is. Legal fiction is not the only thing, not the only function. There are other functions as well. Deeming provisions are of 4 categories. The first category is to create a legal fiction by declaring that something is existing or has occurred regardless of the truth of the matter. The second category is to declare the law. The third category is to create a legal presumption by declaring that certain facts are to be taken as established. And the fourth category is to confer discretion on the authorities. In CIT versus Godavari Sugar Mills Limited, 63 ITR 310, Supreme Court have held that the word deemed is apt to include the obvious, the uncertain, and the impossible. All the 3 things: obvious, uncertain, and impossible. A legal fiction has to be carried out to its logical conclusion. However, in CIT versus Vadilal Lallubhai, Supreme Court have held that the fiction operates only within the field of definite purpose for which the fiction is created. As far as the Income Tax Act is concerned, there are catena of deeming provisions. I am not explaining those provisions, that is for the Siddharth to explain the same. I am only discussing 4 or 5 legal principles to interpret the deeming provisions. The first principle is there is a difference between legal fiction and presumption. The difference is very crucial to understand the scope and meaning of legal fiction. Supreme Court in one case, that is Nandlal Vasudev Badvayak versus Lata Nandlal Badvayak, 2014, 2 SCC 576 have held that legal fiction assumes existence of a fact which may not really exist. However, a presumption of effects depends upon the circumstances, upon satisfaction of certain circumstances. That may happen, that may not happen, that exists, that may not exist. Whereas legal fiction assumes existence of a fact which is not there. Section 112 of Evidence Act does not create a legal fiction. Number of items, examples are given in that section. They do not create a legal fiction but provides for presumption. Similarly, Supreme Court in another case, Bhuvalka Steel Industries Limited have held that fiction assumes something which is known to be false, but a presumption, whether conclusive or rebuttable, assumes something which may possibly be true. That may prove to be true. Legal fictions create an artificial state of affairs by a mandate of legislature. Once the fiction is created by law, nobody can plead or defend or argue that artificial state of facts created by law are not true unless the virus of the provisions are challenged in the court of law. It is a subtle law that legal fictions can be created only by the sovereign legislative authorities and not by subordinate legislation. That is the second principle. There is no possibility of a fiction being rebutted by evidence because legislature says that you have to assume that facts, and therefore it cannot be rebutted. It cannot be challenged. Hence, it is very essential to understand the purpose, intent, and object of a deeming provision so as to analyze whether it creates a legal fiction or presumption, and that too whether rebuttable or irrebuttable. How to determine the object and purpose of a deeming provision? It is a very complex process. In one of the case, Bombay High Court, in CIT versus Lokmat Newspapers Private Limited, 322 ITR, page 43, Justice Devi Chandrachud, while sitting in a Bombay High Court, has discussed the scope of a deeming provision while dealing with meaning of the term speculative transaction under explanation to section 73 vis-a-vis section 43(5). It is held in this case that once the requirement of explanation of section 73 are satisfied, that is, the SSE is a company and the part of the business of the company consists in purchase and sale of shares of other companies, then the consequences which are envisaged in the explanation as a fiction of law are to be brought into existence. The legal fiction is that the SSE is deemed to be carrying on a speculation business to the extent to which it consists of sale, purchase of shares, and any loss arising from that business cannot be adjusted against non-speculative business. Loss can be adjusted against the profit of the speculative business. In this case, what revenue had contended that the loss which arises on account of transaction of sale, purchase of share would constitute a loss, but the profit arising out of transaction on actual delivery cannot be treated as profit from the speculative business, and therefore are not available, and therefore are available for set-off against the losses from speculative business. Justice Chandrachud said that to accept such submission of a revenue would introduce a restriction into the scope and ambit of deeming provision created by explanation to section 73, which is not contemplated by Parliament. Once a deeming provision is created by law, it must be given full and free effect, of course, in relation to ambit within which it is intended to operate. There is no justification to restrict the ambit of the provision. No provision, restriction can be imposed only by a legislative function. The next principle is that the courts have to assume all those facts and consequences which are incidental or inevitable corollaries while giving full effect to the legal fiction. At this juncture, it is worthwhile to note one often quoted para of the judgment of Lord Asquith in the case of East End Dwelling Company Limited versus Finsbury Borough Council, that this para is very important and quoted almost all the decisions by all the high courts. This para is, if you are bidden to treat an imaginary state of affairs as real, you must surely, unless prohibited from doing so, also imagine as real the consequences and incidents which, if the putative state of affairs had in fact existed, must inevitably have flowed from or accompanied it. The statute says that you must imagine a certain state of affairs. It does not say that having done so, you must cause or permit your imagination to boggle when it comes to the inevitable corollaries of that state of affairs. So once the legal fiction is provided, then you have to assume all the circumstances and consequences followed from it. Though deeming provision must be given full effect to, it is worthwhile to note the observation of Supreme Court in the case of Bengal Immunity Company Limited, which says that legal fictions are created only for some definite purpose, and therefore it is to be limited to the purpose for which it is created, and it cannot be stretched beyond the legitimate field. So for the purpose for which the deeming provision is created, that can be extended to that extent only. I can give one example for this, that the proviso B to section 10(2)(6), that is corresponding to section 32 of the Income Tax Act, which says that unabsorbed depreciation, which creates a legal fiction, that unabsorbed depreciation, either with or without current year's depreciation, is deemed to be current year's depreciation. It is well settled that, as held in Bengal Immunity Company's case, legal fictions are created only for the definite purpose, and therefore it should be extended to that extent only and not beyond that. So Supreme Court rejected the contention of the SSE that because of the legal fiction, unabsorbed carried forward losses are to be given preference in comparison to unabsorbed depreciation. So the unabsorbed depreciation will become the part of current year depreciation. There is no modification or no deviation from the basic and well-recognized principle of commercial accountancy. Similarly, in section C Parthasarathy Mudaliar's case to section 222E, though 1922 Act was discussed, which says that loans and advances are to be treated as deemed dividend. But that doesn't mean that the loan taken by the concern or the SSE, being the shareholder, that is treated as income of the SSE by way of dividend, and therefore it cannot be repaid. So legal fiction cannot be extended to that effect. Legal fiction has to be stopped at the juncture that the dividend, loans and advances received by the shareholder or by the concern in which the shareholder have the beneficial interest or the substantial interest, then that is to be deemed as dividend. That cannot be extended beyond that. That's why interpreting the deeming provision, one has to treat as real the consequences and incidents which are flowing and accompanying those circumstances. What is the scope of legal fiction? Deeming provision may create legal fiction and a fact. Sometimes, what is legal fiction? Sometimes deeming provision are given overriding effect. That is complete overriding, and that can be partial overriding. Complete overriding is section 69(6), that expenditure cannot be allowed irrespective of any provision in the Income Tax Act. That is the complete overriding. Limited overriding, section 50, which creates that the depreciation asset, the transfer of the depreciation asset has to be treated as short-term capital asset and therefore to be treated as short-term capital gain. So it is partial, that it affects only to section 242A. Factual, what is factual fiction? Factual fiction, section 72A, that the losses of the amalgamating company are to be treated as losses of the amalgamated company, and the consequences will follow that can be allowed to the amalgamated company. Avoidance. The deeming provisions are also created to curb the avoidance of tax. What are those, what are those provisions? You are knowing that section 43CA, section 50C, section 56 to 10. So these are for curbing the tax evasion or tax avoidance. The next principle is, can something be deemed which actually exists? No. Which actually exists. That is a factual thing which really exists, that cannot be deemed. What can be deemed which actually doesn't exist? Say that one case is there that from the possession of one person, from the car of one person, one incriminating document was found. Assessing officer sought to assess the third person, stating that that belongs to the another person. Under section 153C, satisfaction has to be raised by the assessing officer that this document belongs to the third person. Whereas under section 132(4)(a), assessing officer of the searched person has to raise the presumption that that document belongs to the searched person. So the quality is different. Under 132(4)(a), there is a presumption. Under section 153C, there is a legal fiction. So this is the difference between the two. So I am not going further to another examples. I am leaving to Siddharth, who has prepared the subject very well. So friends, I will cite another things in the concluding remarks if time will allow me. Now the mic is over to the organizer.
Thank you, madam.
To invite Siddharth.
Thank you, ma'am. Thank you for opening remarks. Before I hand it over to Siddharth, a brief introduction about our next speaker. Our speaker for the session today is none other than Siddharth Ranka, a very learned and renowned speaker. Siddharth has done his graduation in commerce stream and followed it by doing his chartered accountancy and then further pursuing LLB degree. Siddharth has been practicing since 2004 and as an advocate represents as a standing counsel of the Central and Goods and Service Tax and Central Excise Department before the Honorable Rajasthan High Court. His major clients include the government departments, government corporations, multinational companies, foreign corporate trust, wherein he represents for both direct as well as indirect tax matters. So when government is winning, we know who is representing them. So we have to catch Siddharth before the case is filed. He has written many articles on a variety of subjects and has been a keynote speaker at numerous forums covering topics from income tax, economy, taxes, annual union budget, and social entrepreneurship. He was the president of Tax Consultants Association Jaipur in the year 1314, an active member of AIFTP, and has been honored with a certificate of appreciation for his exemplary service to the CGST department as a standing counsel before the Rajasthan High Court. Friends, it's a first for a non-department employee to receive such an honor. And yes, we are glad to have us in our midst today as a speaker for this session. Over to you, Siddharth Bhai, for your topic. Thank you.
Thank you very much, Bharat Bhai. Respected Madam Premlataji Bansal, a younger sister, like a younger sister to my grandfather, who was always in awe of her. It's such a pleasure to have you as my session chairman. I wish my grandfather was here to see this in his lifetime. You are a very reputed senior advocate. And recently, yesterday itself, we got the news that you won the exemption for the Delhi Bar and the Advocates Welfare Trust from the Income Tax Tribunal. So, ma'am, seeing you active, seeing you thriving is a blessing, and getting this opportunity to share whatever little I know about this subject, which in itself is as good as income tax, talking about the Income Tax Act in itself, because deeming provisions are like a never-ending sea the ocean of Income Tax Act. Before I come to my topic, I will fail in my duty if I don't express my gratitude to the host organizations, Tax Practitioners Association, Income Tax Bar Association, Prayagraj, Income Tax Bar Association, Banaras, Bhiwandi Tax Bar Association, for organizing this virtual national tax conference for the first time, which is a conference being organized without a host city. So whether it is Banaras or whether it is Thane or whether it is Bombay, the host is virtually present in all the locations. And this COVID, no doubt, has given to all of us, thrown challenges to all professionals and everybody, in fact, has also led to forged partnership. Like these host association has joined hand. I think it is in times to come, whenever we will be going back to the normal times, that this partnership between different cities, with different associations come to fore. And everybody who's joining this seminar and then conference gets to learn. I will be also I'm very, very thankful to Vijay ji and all Harish ji and everybody who's been taking so much pain and task to organize this. It's virtually a very, very well organized, well thought of. You maintain all the timelines and everything which a normal conventional conference would require. We are seeing everything being handled so beautifully. Friends, coming to my topic, which is deemed income and interplay between the deeming provisions of under the Income Tax Act. As Ma'am Premlata Bansal has just given us a fantastic background about the various principles involved while decoding the deeming provisions under the Income Tax Act. In itself, as I said, deeming provision is as enlarged or as important in scope as the Income Tax Act in itself. Gaining knowledge and sharing knowledge in today's time is the new thing that one has to be accustomed with. And I think Vijay ji, by organizing 50 webinars and then this conference, has taken a lead, and he's been ensuring that each member of his association and all the partnership associations are benefited with all the subjects, whether it is income tax, whether it is GST, whether it is accounting standards, or whether it is motivational talks. I think wide range of topics have been chosen, and wish you all the best. Friends, we know whether it is GST Act or Income Tax Act, it is full of sections, subsections, provisos, clauses, subclauses, explanation, notification, circulars. And to top on it, we have deeming fictions incorporated within the sections, within the subsections, within the provisos, within the clauses, subclauses, or explanations. And as ma'am has said, the deeming fictions through Honorable Supreme Court at various occasions, which I'll also be touching upon briefly, has to be very, very strictly construed. The Act itself refers to the term deeming or deem in about 287 points, and the rules also refer it to 67 times. So friends, you can understand that what is obvious, for that to be said through the statute, the deeming provisions have been referred time and again by the Parliament in the Income Tax Act, or to show that what is not present under the Act is brought to taxation. When we are decoding the deeming fictions, at most of the points we'll find that the facts and the law. If you have facts with you, the deeming provision may not be in your favor, and there could be also saving graces where the deeming provision is purely in your favor, and factually you are not able to draw out a good case. So, and it's always oscillating between which side of the coin is on the stronger side, whether it is the factual foundation or the legal foundation. By a normal corollary, deeming fictions states how something is to be treated. In the legal parlance, it is as simple as that, how something is to be treated on a given set of facts. On the backdrop of facts, what is the logical outcome? That is what is going to be defined by the legal term of deeming. What would be the conclusion is irrelevant. Supreme Court in Mafatlal Gagalbhai has said, sometime it is used to impose for purpose of a statute an artificial construction of a word or phrase that would not otherwise prevail, or sometime it is used to put beyond doubt what is uncertain, and sometime it is used to give comprehensive description that includes what is obvious, what is uncertain, and what is in the ordinary sense impossible. And this phrase has been used, as ma'am has also highlighted, at various other judgments. In another case of Consolidated Coffee, the Supreme Court observed a deeming provision might be made to include what is obvious or what is uncertain, or to impose for purpose of a statute an artificial construction of a word or phrase that would not otherwise prevail. So what normally we can decode is that deeming provisions have been incorporated under the Act either to remove certain uncertainties, to show that what is the obvious intention of the legislature, or to bring in its fold, which a normal definition would not be able to bring within its fold. Supreme Court again in Delhi Cloth and General Mills Company also observed, when a statute enacts that something shall be deemed to have been done, which in fact and in truth was not done, the court is entitled and bound to ascertain for what purpose and between what persons the statutory fiction is to be resorted to. So from the earlier conventional literal meaning, now Supreme Court also says that not only look in the definition what is being provided, but also look into the fact what was the reason that deeming fiction was incorporated. What was the backdrop under which this deeming fiction was incorporated, so that one doesn't create injustice beyond what was intended to. If the deeming fictions were not there under the Act, then Honorable Supreme Court in KP Varghese says, then this burden would lie upon the assessing officer. And once the deeming provision is provided as an arm shield to the assessing officer, then his responsibility to disprove or to prove what is obvious goes away. And again, Supreme Court in Arujan Sugars also said, as was said in the earlier case, that what is the purpose for which that deeming provision was incorporated should be looked into before doing the justice or before arriving at the interpretation. In the case of Voltas, it was observed that deeming fictions are to be construed strictly. No word should be added, modified, deleted than what is stated. And the simple rule of strict interpretation and literal construction would apply. Whatever illogicality it may lead to has to be ignored. So we have two broad thoughts which are prevalent while dealing with the deeming fictions. One, which says that whatever is referred there to, do not go into what conclusion it may lead to. And second version is that look into the deeming provision, why it was brought to statute, what was the mischief which was sought to be removed, and in that circumstances interpret that deeming provisions. So this will always be a debatable subject. It will always intrigue any professional, whether it is in the realm of indirect taxes or direct taxes, because rules of interpretation always changes. Sometimes the court balances the equation between the assessee or the assessing officer so that it doesn't lead to a complete absurdity. The courts are also armed with reading down the provision. And a lot of time where the provision is worded in such a manner that it may lead to complete illogicality, then courts are definitely do intervene and read it down for what purpose the provision was incorporated. For example, in the Companies Act, director's disqualification, Delhi High Court has read down the provision of 164 to restrict that disqualification only to the company where the default is there. And they've gone into the backdrop of the material. Why was that section incorporated? At the same time, there are other courts which have gone by literal meaning and simply said that once a disqualification is there, the disqualification remains for all the companies and is not restricted to the company where the default is there. So yes, this will be a very, very intriguing provision whenever it is being interpreted. As ma'am has already highlighted, that there could be various types of deeming fictions which are brought under the statute. One could be that creates a legal fiction like section 9, which defines under what circumstances it will be deemed that an income has accrued in India. There could be deeming provision which declares the law, like deemed dividend under section 222E. So where the provision is being, the law is stated as it is, it's a case of deeming provision that declares the law. Third could be a deeming provision incorporated under the Act to ascertain or to declare certain facts. For example, 292BB, where the notice is served or a defective notice is served upon the assessee. So it is deemed as obvious that yes, the Act acknowledges that there were certain infirmities under the notice which was issued, but that should be treated as or deemed to be treated as correctly served. Or section 171 when it involves partition of a HUF. Deeming provision that confer discretion upon the assessing authority or a quasi-judicial authority is like under provisions of 12AA-263, where the commissioner is armed with revoking the registration already granted or to not to grant a registration, or 263 is reviewing the order passed by the assessing officer. Then there are certain provisions which determine the quantum of income. Like for example, section 43CA, 50C, 56 to 10. 43CA and 50C come into play when there is a transfer of immovable property, either as a capital asset or as a stock in trade. And similarly, when there is a buyer involved in 56 to 10 and capital, it is purchased as a capital asset, then the difference is quantified and deemed to be the income of the assessee. Then there are certain computational provisions like section 48 and 49, which determine under certain set of facts what will be and how the computation of income will be worked out. Then there could be deeming fictions which also determine the timing of the income. For example, compensation or interest received on the compensation. So 145 and 45(1) define the year in which income had to be taxed. Because earlier there were certain differences between the courts. Some courts opined that the interest has to be bifurcated year on year. Some courts said that in the year when the interest or compensation is received, it will be brought to tax. To do away with those controversies, this 45(1) is there. Then there are deeming fictions, friends, like clubbing provisions, where a simpliciter income is earned by a minor or income is earned on the basis of gift given by the in-laws to the daughter-in-law or by the spouse to another spouse. So there is a different class of provisions under which these have to be taxed. Then we have presumptive taxations, 44AD, 44AD. Against a backdrop of SSE, these provisions will be there. Then we have cessation of trading liabilities, that any liability which is there, which has been written off by the SSE or which is not payable anymore, will be deemed to be income in the year when it is written off. Then you have section 159, 159(1), 159(2), 159(3), which defines the responsibilities of the legal representatives. How that debt which ought to have been discharged by the SSE is to be discharged by the legal representative. In what manner the legal representatives will enter into the shoes of the deceased SSE. Then we also have provisions like where other statutes are referred, like ESI and PF deposits of employees' share, where if there is any delay in deposit of such share, then even Income Tax Act, though there are judgments in majority in favor of the SSEs, but as far as the plain language of the Act goes, it is not restricted to a provision within income tax. Deeming provisions are also brought in to look into the other statutory provisions of other enactments. Then we have non-deduction of TDS. That could also lead to a disallowance of income. Payment above cash limits under 48(3), above 10,000. If there is a violation of those provisions, then we automatically that is treated as income. So these are all the ambits of deeming provisions under the Income Tax Act. In fact, to really decipher what is the income is a difficult task. What we now know is that the Income Tax Act is as good as deeming provisions of Income Tax Act, or the income tax of deemed income. Then we also have forfeiture of advance towards immovable property on transfer of capital asset under 56(2)(9). So that is also a forfeiture which was not brought under the ambit of tax, has been now brought under the ambit of tax. Other case of deeming provision could be a second house property where the annual letting value has to be determined. In case even the property is not let out, even if the property is vacant, then also one has to work out the deemed income under that circumstance. And then one of the important facets of cash credits, unexplained income, that is section 68, 69, and with the involvement of 115BBE, which has now gained a lot of importance. The topic assigned to me is a topic on which the entire conference of 2 days can be devoted. For me to do the justice in a period of time allotted to me, friends, there would be always a gap in what one may have in his mind, but whatever I have been trying to, whatever I can cover, I'll try to cover. In the corporate world, cash flow is the biggest challenge a corporate house now faces. And with restrictions imposed under the Companies Act and deeming fictions under 222E has gained tremendous importance. So to start with my topic, in case any SSE has 10% or more voting share in a company, and he's also a member or a partner or a shareholder in another enterprise, or directly himself where he's holding 20% or more, or directly himself, and there is a transaction between this company and that company, then the amount which is received by the recipient is deemed as dividend in the hands of the recipient. Now, it's not that every loan or every advance is to be deemed as dividend. Only if the concern A from which the transaction has flown has some accumulated profit, has some profit in its as in the reserves and surplus, then only this provision will come into aid. So any company where there is losses, but there is liquidity available, there is no problem of deemed dividend being flouted or deemed dividend not being involved. When we talk about accumulated profits, then share premium received by the company has to be ignored, and what is freely available as distribution of dividend, only that revenue is to be treated as accumulated dividend. If it is a transaction between holding and subsidiary company, then this provision will not apply. As ma'am has rightly in the earlier session said, when there is a transaction between two entities and it's for the normal course of business, then that provision is also out of the ambit of deemed dividend. Now, this is the crux of controversy involved, because once the assessee gets caught, then the normal thing for him to rebut is that this was a business transaction, that this advance was received for some real estate transaction which did not fructify the landowner, and then documents are created or things are there. And then assessing officer also knows that this is a powerful or a big amount that he has caught on. So for him also to come out of the ambit of business transaction, because in the light of circular of the board in creative die, following creative die, where the board itself has said that business transaction, normal transaction will be out of the ambit of 222E. So in the case of Shravan Chaudhary, the tribunal has said that if the transaction is a business transaction, then the amount received under such circumstances will be out of the ambit of loan or advance. But for that, the factual foundation of the transaction has to be proved by the assessee that this was an actual transaction which took place and not an artificial transaction which has been created. That has to be very, very carefully be taken care by all the professionals. Similarly, friends, current account transaction between two companies will be out of this ambit. Now, this is a problem point which you can see from the slide. There are three judgments which refers to what is accumulated profit. Gujarat High Court says in MB stockholding that ignore the current year's profit and what was the opening balance under the reserves and surplus, treat it as accumulated profits. So current year profit have to be ignored. If there is a accumulated profit on the 1st April of that financial year, then only to that extent accumulated profit can be taxed. Jaipur bench of tribunal in the case of Shravan Chaudhary said that you work out the transaction on the date when this transaction has taken place. On that day, what was the position of profit and loss account? That has to be worked out, and then that accumulated profit has to be looked into. And Rajasthan High Court in Rajasthan Wire says that whatever is the current year's profit is also to be included in the accumulated, the definition of accumulated profit. So there are three case scenarios, and definitely, as depending on the factual backdrop, one has to take advantage of whatever is available. But there are three different, completely divergent views of the authorities, where one says that ignore current year's profit, the second says that work out the profit till the date of transaction, and the third says the entire profit as on 31st March has to be looked into while defining the accumulated profit. Now, what is how badly this deemed dividend can inflict a wound upon an assessee can be looked into from this slide. Given a backdrop that Mr. A, Mr. B, Mr. C, and Mr. D are shareholders in XYZ having 25% shares each. These four gentlemen are also shareholders in ABCD Private Limited having 25% each. Let us assume that XYZ has accumulated profit and XYZ gives the loan of 10 lakh rupees to ABCD. Now friends, this is a classic case how the deeming provision can really be interpreted. Now Supreme Court in Madhur Housing says that given under the same set of facts, tax A, B, C, and D all, because they all cross the 10% shareholding limit in XYZ, they also cross the limit of 20% in ABCD, then all will be liable to tax at the rate of 10 lakh rupees. So for a transaction between XYZ and ABCD of 10 lakh rupees, ABCD can end up with a tax liability of 40 lakh rupees. Cumulatively, they may end up with tax liability running into 40 lakh rupees. And then again, Supreme Court in National Travel Agency says, no, don't tax the shareholders. Tax ABCD, which is the recipient. Now, this matter has been referred to the larger bench. Last judgment is of Justice Nariman in National Travel Agency and Justice Sinha, where they looked into the Madhur Housing and the earlier judgment of Delhi High Court, and they came to this conclusion. And if there is no involvement of ABCD, then why even invoke tax provision against them? If at all, it should be the recipient company which should be brought under the ambit of tax. So friends, when we talk about deeming fictions, as ma'am has also highlighted, as some of the judgments referred by her and also referred by me, that and this deeming provision under the Income Tax Act is not something which was introduced, or deemed dividend concept was introduced sometime 15 years, 20 years back. It is there under the statute for a long time, and it remains unamended broadly. So it can really rip apart an assessee, and it can lead to unimaginable damages. And also consider the plight of the assessee. Now he has to also deduct TDS under the TDS provision now ABC also XYZ, if suppose there is a transaction, it is also burdened with the TDS liabilities. And it will be very, very difficult for it to work out under which provision, under whom it should be brought to tax. And even now auditors also have to report in their income tax reports as to how this deemed dividend is applicable or not applicable. The second segment of my presentation, I would like to take the deeming fiction with regards to residential status. Earlier, Section 5, which we were all very comfortably accustomed to, when you are a normal ordinary resident, you are liable to be taxed globally. But when you are not ordinary resident, then you are not liable to taxed for income which has accrued outside India or which has no relation outside India. And if you are a non-resident, then only you have to be taxed for income which has accrued or received in India. That was the broad principles that we were all aware. Now this Finance Act 2020 has brought in a concept of deemed resident. Now who is a deemed resident? One who is not paying any tax in any country due to his residential or domicile status. For example, we used to have 182 days as the minimum threshold requirement. Let us say a person is also living for 100 days in US, is also living for another 150 days in Japan. And there also the number of days as prescribed under their Income Tax Act is also 182 days. So technically he is not even a resident of US for the income tax purpose. He may not be a resident of Japan and he may not be a resident of India. So if suppose he is crossing this limit or he is qualifying for this condition that he is not a resident or a domicile in any other country. Number two, he stays more than 120 days in a year in India. So that threshold of 182 days has been brought down to 120 days. And third, his income from India is more than 15 lakh rupees. Now, if these three conditions are cumulatively satisfied, then even his foreign income, like a resident used to be taxed, he will be taxed for his foreign income. And it will be, this is the definition of the deemed resident, which has been incorporated for the first time under the income tax statute. So in case you are a resident, then this is the condition which one has to look into. You are an Indian citizen or a person of Indian origin, your income is more than 15 lakh rupees, you stay more than 182 days in India or more, or you are in the last 4 years, you've stayed for 365 days. Now, additionally, one more condition will have to be looked into, whether you have stayed 120 days more or more as well. Because if you are not qualifying for first two condition, but you are qualifying for 120 days, your income is more than 15 lakh rupees, then you will fall under the definition of deemed resident and your foreign income will be also taxable. And similarly, if you are a not ordinary resident, the number of 120 days has been changed. 182 days requirement is changed. Third set of deeming fiction to move forward could be Section 9 and 206 AA and the DTAA provisions. Now, Supreme Court, Tribunal, High Court have concurrently held that DTAA provisions will override the provisions of the Income Tax Act. Because DTAA provisions are sovereign enactments which have been entered between Government of India and the foreign country, and it's a reciprocal transaction which the foreign country has also ended with the Government of India. That will have a precedence over income tax provision. If income tax provisions are in variance to the DTAA provisions, the income tax provisions will not prevail. What will prevail will be the DTAA provisions. Only where the DTAA provisions are silent, then the language used under the Income Tax Act can be brought to be read into the DTAA provisions. Then we now move to charitable trust. When suppose a charitable trust has accumulated certain income to be spent for over a period of 5 years, and it has not been able to spend that income within that period of 5 years for the purpose for which it was set apart, then Bombay Tribunal says that this is a deeming provision under 11.3. Whether you have subsequently spent it for in the normal course or you do not spend, it is further not available for set apart, and it has to be deemed as income and tax is liable to be paid. Friends, you should be aware that this budget has also changed the provisions with regards to requirement of registration under 12AA and 1023C. Incidentally, if you are holding a registration under 12A or 1023C other than agriculture income, no other exemption within exemption can be claimed. So suppose you are having exempt income from dividend, a charitable trust, let us assume earns dividend income, which is normal course was exempt. So you cannot, by the provision of Finance Act 2015, you could not have claimed dividend as a separate class to be treated as exempt and then remaining amount to be shown for taxability. So if you are registered under 12A or 1023C, then other than this, no other exemption can be claimed. But Finance Act 2020 has brought on about again a very analogous situation that institutions which are registered under 12AA can claim exemption under 1046. So 1046 is available to regulatory bodies, primarily regulatory bodies like Pollution Control Board or electricity commissions. So if those bodies are having 12A registrations, they can very well apply for 1046 and get it. But suppose those institutions have opted for 1023C registrations, then they cannot obtain 1046 exemptions. And you know this, from this Finance Act, you can either have 12A or you can have 1023C. Both exemption certificates cannot be taken by the trust. While you are dealing with or discussing with your clients who are into this field, this minute difference can be brought to their knowledge, and in a given situation, this thing can be taken care. Moving forward, the other important and most controversial subject of the day is 14A, which deals with expenses incurred in relation to income which is not included in the total income. Some principles which have now more or less been settled. Number one, disallowance cannot exceed the exempt income. Suppose your exempt income is 10 lakh rupees, and on the basis of Rule 8D, the formula works out 20 lakh rupees. It has to be restricted to the exempt income ultimately earned. It cannot go beyond what was earned as exempt income. Second formula within this is, if there is no exempt income, so you have invested in the portfolio to earn exempt income, but there is actually no earning of exempt income, then this entire 14A goes out of its ambit. Third, it also applies to deductions and is not restricted to only exemptions, because the terminology used under the Act is total income. The fourth principle which has settled is now that this is also applicable where you are holding certain stock shares as stock in trade, and it is not restricted to only capital investment. When in the normal course you are earning any exempt income, which is then also this 14A would be applicable. One very interesting query which comes, that if exempt income only is to be taxed or proportionate has to be worked out, then what is the value of investment that should be taken? Suppose in a portfolio there are shares worth 10 crores and you have received dividend out of 5 companies only whose value is only 2 crores. Then whether while working out in the Rule 8D, whether the entire 10 crores ought to be taken or only 2 crore should be triggered, I carry a view that it should be only 2 crores that you should be taking while calculating, because ultimately if suppose there are investment which has not led to any exempt income, that can be segregated, and only those investment which has ultimately led to some exempt income can be brought to calculation. Similarly, a lot of assessing officers were even making 14A disallowances in cases of people, let's say salaried employees or non-business professionals who were earning also income from shares. Even if they have not claimed any, deduction, they have not maintained any books of accounts, then also 14A was being calculated, and on assumption additions were made. Tribunals have broadly come to the rescue of the assessees and said if there is no deduction which has been claimed, then 14A itself is out. And before invoking Rule 8D, The assessing officer has to record his satisfaction. It is not a mechanical thing that he can bring about. I may be speaking slightly fast because the topic is wide and my time is that. So coming to now capital gains or immovable properties, or three important provisions, 43CA, this is triggered in case your client is having real estate as a stock in trade, and then there is a sale of such real estate, and the local ready reckoner rate or the DLC rate as we call it here is more than the value recorded in the sale deed, then that difference is brought to tax. 10% variance is permitted. Similarly, 50C, now very old provisions, since last about 17 years it is there. Then there is a transfer of a capital asset. 43CA comes into picture when there is a stock in trade. 50C comes into picture when there is a capital asset. Again, the value determined by the stamp registration authority and the value recognized in the sale deed, the difference thereof is brought to tax. 10% variance permitted. 50CA is in case of unlisted companies, unlisted entities, and there is a transfer of shares. There also now the fair market value or the intrinsic value of that share has to be worked out. And then what is the ultimate selling price? The difference, if there is any, will be brought to tax. 56 to 10 is applicable on buyer of the property, which is a capital asset. And 10% variance like 50C is also available here. Now 43CA would come into picture in the year in which ultimately the sale deed is executed. Even if you are maintaining your books of accounts under project completion method, percentage completion method, year of taxation would ultimately be in the year when the transfer of the property takes place. Because again, friends, like this is a deeming fiction, it prevails about over the normal conventional accounting. Because even while you're doing your accounting on the project completion method, it will be, at that point of time, you will not be aware of what will be the ready reckoner rate at the time of registry. Now, there are certain class of people who are out of this ambit of 43CA, 50C. One is a buyer of property who buys the property for stock in trade purpose, or the property is a non-capital asset. So 56 to 10 is applicable only in a situation where the property is of capital asset. The moment the property is not a capital asset, then it is out of ambit of 56 to 10. 56 to 10, unlike 56 to 7B, now refers to any person. Earlier, it was only individuals and HUF. So even now, a partnership firm or a company is buying a real estate as a capital asset. And if the DLC difference is there or the price difference is there, then even in their hands, it will now be subjected to taxation. Now, if suppose there is an agreement to sale which has happened in the past years and only the execution is taking place subsequent years, then that value has to be given importance, provided that there are some transactions carried out under check or other than cash transactions. 50C and in times to come 43CA or even 56 to 10 matters are going to be referred to DVO. Most of the time we have appeared before the DVO, but these are the normal things that there are umpteen number of judgments now which say that automatically you can't refer, or even the DVO cannot refer to the value adopted by the stamp registering authority. You can possibly argue, depending on the facts, the variance or the reasons on which the property could not fetch the real price. One could be the width of the road upon which the property is situated, because DLC rate is determined for the entire area irrespective of the location of the property. Second of the arguments that can be brought about is nature and use of the adjacent property. Suppose your property is residential property, the surrounding properties are commercial properties, and you are residing in that property, and stamp authorities have taken that value to be commercial property. Those objections can be highlighted. Third, as I said, the use of the property. A case which I argued was a case where the property was a cinema hall property. For the stamp authority purpose, they treated as commercial property, and no difference or no discount is offered for a property which is assigned for a specific use. So the specific use can be highlighted. Again, the area and the locality can be argued. And a very good point could be a distress sale where the assessee is having a lot of loan liabilities on its shoulder, and it has under pressure sold some properties. That can be a very well and valid argument. Then number of owners. Suppose there is a property where there are joint owners running into, let us say, 5 or 6 or 7. And we all know that until and unless all 7 agree, the sale deed cannot be executed. Even number of owners are more, that can be highlighted for fetching a lower price. Similarly, if the property was given on rent for a long time and the tenants are residing there for long period of time, that could be a reason for price not being arrived at or not in the normal circumstances, and these issues can be highlighted before the DBO and the assessing officer. Jaipur Tribunal in Vimla Devi Samaria has said that once sale instances of nearby areas are given, then the DBO cannot automatically reject and ignore those instances. If all he has to ignore, then he also has to bring on record alternate sales instances in order to justify. So if you have some sale instances in the vicinity also, that can be very well argued, because at least I can say with my experience in Rajasthan, even a difference of about 100 meters between two properties can create or have led to a huge variance in the price being adopted by the stamp authorities. So comparable sales incidents should be brought about. And the tribunal also says that though the report of the DBO is binding upon the assessing officer, it is not binding upon the appellate authorities. And appellate authorities looking into the facts and the arguments, the reasons pointed out, can go into and give further relief than what was worked out by the DBO. Delhi High Court in Modern Lace House has said that in case the assessee requests for valuation to the DBO and the assessing officer does not refer it to the DBO, then the entire provision of 50C, the invocation of 50C is bad in law, and no second opportunity can be given to the assessing officer, and assessee cannot be burdened to go back to the DBO once again. So it is important for you to, while the assessment is going, to ask for that reference to the DBO. Again, another judgment of Madras High Court, where language used is, in case the assessee wants to go for a DBO, then it will be an insult to the honest taxpayer. Language used is very interesting. It will be insult to the honest taxpayer to adopt and assume higher market value to impose capital gains tax without allowing him or her an opportunity to rebut even the legal presumption under 50C. So courts have come very heavily upon the assessing officer where they have not followed statutory provisions under 50C of referring the matter to the DBO. Now, whether 50C would apply in case of charitable institutions. Charitable institutions are a class on their own. Their calculation of tax are governed by section 11, 12, and 13. Hence, 50C provisions are inapplicable for registered charitable trust under 12AA. Even if there is a DLC difference in case a charitable institution is buying or selling, because now 56 is also there. So even if there is a difference, this provision of 56 and 12AA would be out. Similarly, if suppose there is a difference in the stamp reckoner price, can the assessing officer directly refer to the difference and add in the case of the buyer? Then the view is that automatically the assessing officer, until unless he puts on money, cannot jump to 69B tax in the case of the buyer. Now, and another controversy which was going on, which has to a certain extent laid rest by the Bombay High Court, is with regards to, suppose there is the 100% investment has been made of the sale proceed actually received as per sale consideration. There were views of various tribunals which said that if 100% of the sale consideration stands reinvested under 54 or 54EC, then 50C provision itself would not be applicable. But Bombay High Court has decided in favor of the revenue to hold that irrespective of the fact that 100% of the sale consideration was reinvested. Ultimately, that sale consideration value has to be replaced with the deeming value, and whatever out of the deeming value stands reinvested. Only then, if there is a exemption available, will be worked out. In case of a contribution of asset by a partner to the partnership firm, so now there is a two provisions which are parallelly available. 45(3) says that the value adopted by the partnership firm will be the value in the hands of the partner or the transferor. And 50C says that whatever is the value as per the stamp authorities would be deemed as the value. So this provision or this controversy has been more or less now laid to rest by Bombay Tribunal in Amartara and Moti Ramanand Sagar, where they say that 50C is a general provision, whereas 45(3) is a specific provision working under a specific facts and circumstance, and 45(3) would prevail over 50C. And when there is a controversial or when there are two deeming fictions which are involved, then the deeming fiction which is specific to a situation will prevail over a general deeming fiction. Moving to the definition of relatives, we are all aware about the definition of relatives involved. But very interestingly, again, like deemed dividend, how certain relations which have been completely had been bygone by the legislature can be seen from this slide. So, assessee cannot receive a gift from the brother's son or a daughter. Though he can give gift to the brother's son or daughter, but the reverse is not true. When we look under the definition of the relatives under the 5627B, then we find that similarly, when there is a sister, son or daughter, you cannot receive gift from them, but you can give gift to them. So when we look into the literal interpretation, strict interpretation, then the entire purpose of relatives is being defeated here. But if you look into why this definition was brought in, then it appears that all these four should also be included. But anyways, this is a very, very controversial subject, and Rajasthan High Court in one of the cases has taken a view that when the gift was received by a person from his nephew, that amount was held to be taxable. Tribunal had decided in favor of the assessee, but it was reversed by the Rajasthan High Court. Two more situations, and which is now very common. Suppose a son or a daughter is adopted, and he or she has gone to another family, maybe within the family to another brother or a sister. Once that adoption takes place, her relation with the earlier family is severed. And the moment it is severed, then if any amount is received by that child from her natural relatives, will be outside the definition of relatives. This is again a classical example how without imagining what could be the consequences of this definition under 56, how one can damage the fabric. Similarly, if there are a joint family where three brothers or a big joint family are living together, between cousins, they may be having excellent relations, they may be living together, they may be doing business together, but cousins cannot give gift to each other. Only and also, as I said, you cannot even give gift to the generation which is above that. So this is maybe unintentional, but it has led to a miscarriage of justice when we look into the definition of relatives. A lot of queries also come to me with regards to what happens in case of, let us say, divorce or annulment of marriage between two husband and wife, and the spouse or the wife receives certain amount by way of maintenance or one-time settlement from the husband. In my opinion, it is a non-taxable event. The amount could be received at the time of annulment based on the court decree or even prior to the court decree. This will not come under the ambit of 56 because they will be covered under the definition of relatives. And another interesting query which regularly comes is, suppose there is a divorce which has happened between husband and wife. The child, even after divorce, receive certain gift from the grandfather, whether it will be taxable or non-taxable. Suppose there is Mr. A and Mrs. B, which have separated and they have a child C. Now, father of A wants to give a gift to C, and there is a divorce which has happened between A and B. According to me, that relatives, the definition of relatives for the purpose of income tax still continues, and hence this will not be coming under the ambit of taxation, and it will remain a non-taxable event. One of the topics which is yet to be settled or which is yet to be tested is what happens in a case where there is a remarriage of the spouse. One of the spouse has died and the spouse remarried. And there is certain transaction which happens from the first family. So whether that will be covered under the definition of relatives is something which is to be tested. In my opinion, the relation continues irrespective of the fact that the person has remarriage or not. But as far as Hindu Succession Act is concerned, it is silent. As far as the Income Tax Act is concerned, it is also silent, which may in times to come be tested. So another provision is with regards to allotment of shares, where you are already holding shares and you are getting some shares at a discount from its normal fair market value. So tribunals have said that if you are receiving shares which everybody is receiving, then 56(2)(7)(c) is out. But if you're receiving certain disproportionate amount, then yes, that could be brought under the ambit of taxation. I am skipping associated enterprises because that was probably covered in the first session of today's conference, and which brings to the very interesting topic of assessment year 17-18, where 68-69A read with 115 BBE has been brought into focus. Primary difference between 68 and 69A is 68 is involved in a case where the assessee is maintaining books of accounts, and it is any sum found credited in the books of accounts. As long as any sum is entered in the books of account which is maintained by him, and the nature and the source thereof is not explained by the assessee, or in the eyes of the assessing officer it is not explained satisfactorily, it will come under the realm of 68. 69A comes into a picture when the assessee is not maintaining any books of account, and there is any asset, money, bullion, jewelry, or any other article, etc. found. And again, the language is that the assessee is not able to offer explanation, then this will be brought to tax under 69A. Invoking of wrong provision where books were maintained and 69A was invoked and books were not maintained and 68 was invoked, that in itself may not lead to annullity of the assessment, because CIT appeals are empowered to rectify all these things. Some important judgments which one has to keep in mind while dealing with the situation would be case of Vinod Chadha, Surendra Kumar Sanpal, Kailash Jewelry, Akshat Kumar, JM Wire, where broadly the courts have come to this conclusion that once the assessee has explained his version and the accounts, the books, the transaction is entered in the books of accounts and he's explained his version of story, then assessing officer has to disprove the transaction, and simpliciter on assumption and presumption, he cannot simpliciter invoke section 68-69 and bring it to taxation. 68-69 also assumes importance, read with 115 BBE, because as ma'am has already highlighted that no deduction, no benefit of loss, etc., no exemption, nothing can be claimed against this amount. And as far as disclosures found during the course of survey search, Rajasthan High Court in the case of Bajargan Traders has held that in case of a jeweler carrying on business transaction, undisclosed stock found, that will be treated as part of his business profit, not as part of undisclosed sources, and so that section 68 and 68-69A were not involved. These are some of the judgments which I have referred. Because of time, I'm not referring them in detail, but one has to time and again go through these judgments whenever the situation comes while your matter is being before the CIT appeal or any other forum. Madras High Court, incidentally, in Salem Shri Ramvilas, has quashed the assessment proceedings, where the assessee highlighted that whatever in the case of e-proceedings, what he highlighted, the assessing officer did not verify those transactions, and Simpliciter both went ahead with making the additions. So in case there is a miscarriage of justice, this judgment can also be taken, benefited of to again go back to the assessing officer. Once there are two languages involved under 68 and 69. One is the assessee offers no explanation, and second language used is that the explanation offered is not in the eyes of the assessing officer satisfactory. So the second limb of those would come into picture only when assessee first discharges his onus of explaining the transaction. If the assessee himself is not able to discharge the primary onus, then the assessing officer job has become very easy. And in order for assessee to discharge his onus, there has to be supporting material on the basis of which some cash transaction or closing stock, whatever is found, has been. Common examples could be highlighted that for how long this business was being carried, whether books of accounts are maintained, what is the past history, what is the immediate past transaction, what is the transaction disclosed under the GST returns, and whether stock register is being maintained, nature of trade, which is very common to the trade itself. And there were some past cash withdrawals. These could be highlighted. And 115BB is out. If 6869 is not invoked, then 115BB itself is out. Why this has become a point of rage is because of the huge taxability involved. You can see, friends, that it leads to a tax rate of 60%, then on top of it, surcharge of 25%, then cess of 4%, penalty of 10%, and interest. And in most of the cases where assessment orders for 17-18 have come, the demand is more than the cash deposited itself, because then you are also having interest under section 234B. Now, two courts that I am aware of are seized of this virus of this section 115BBE, which was inserted on 15th December 2016, and it was made retroactive from 1st April 2016. First is the case of Deepak Maratha, which is pending at principal seat at Jodhpur, where the court has come to the rescue of the assessee and said no further coercive action. And the lead case is of Gujarat High Court. There are at least about 7-8 cases which are pending before the Gujarat High Court, and where in the case of HLP Associates also the Honorable Gujarat High Court has said that no coercive action has to be taken against the assessee. The importance of introducing this provision from 15th of December 16 with retrospective effect from 1st April can be also gauged from the fact, forget demonetization, if a normal course, a survey has taken place against the assessee in the month of June 2016, and he voluntarily surrendered certain amount on the basis of common understanding of the income tax department and the statute and the professional, and he offers a sum of rupees, and he also has also paid the due advance tax also. Now, based on this amendment brought in from retrospective effect, his liability has gone many folds. Not only 30%, it has gone many folds, maybe 2.5 times than what was originally envisaged. So even a ground of promissory estoppel, though ma'am is the right person or highlight whether the ground of promissory estoppel can also be brought about under this facts and circumstances. There are various judgments of Supreme Courts, Vatika, and many judgments which says that normally retrospective taxation should be avoided. Here is a case that not only the tax was brought in, though it was already available, but the rate of tax has been introduced or increased substantially. So as I was taking about my topic, the more you read into this deeming provision, the more unsure, the more puzzled, the more confused, lost you are left with, because you are ultimately wondering what was the thing which was going on in the mind of the framers of the statute when this provision was brought in, and what ultimately it has led to. So one has to be very, very cautious about these deeming provisions, and the seminars like this are very, very relevant to bring about the awareness about this. Now, when we talk about MAT provisions, Rajasthan High Court in Krish Homes has held that in case of rural agricultural land situated beyond the boundaries of 8 kilometers, etc., would still attract provisions of 115 GB. Because the profit earned on that sale of agricultural land is credited under the P&L account. So on the basis of reduction clause 2, you claim that this is exemption available under section 10(1), read with 2(1)(a). But the Rajasthan High Court has come to this interpretation that once the rural agriculture income would be referred, or the intention of rural agriculture or agricultural income is only on the basis of income earned on that land. When that land itself is being transferred, it will not be getting the advantage of rural section 10(1). Subsequent to this judgment of Krish Homes, there is another judgment of Jaipur Tribunal in Moti Sons, wherein they have said that provisions of 115 JB would not be attracted in case of rural agricultural land. So again, there are versions and there are versions. And this is the beauty of deeming provisions. As you read it, you will end up being more confused, and there will be always a difference of opinion. To come to a common consensus would be a great achievement in itself. Similarly, while disallowances under 14A are there, that cannot be taken under the realm of 115 JB. Suppose there are certain disallowances which are there under 14A, that has to be restricted and read only with reference of 14A. It cannot come under the realm of 115 JB, which is now settled by two High Court judgments, Shri and Nirma. This is Gujarat High Court. Similarly, if there are deeming additions made under the statute, they are also out of the ambit of MAT provision. Because one of the golden principles of deeming fiction is that you cannot deem beyond the language used, you cannot deem within the deem and bring to taxation transactions which were not originally planned under the deeming fiction. Just before conclusion, 292B, we are aware that 292BB is a beneficial provision to the assessing officer where there is effect in service of notice, and that can be the legal presumption cannot be raised by the assessee if he is that Maruti Suzuki Justice Chandrachud categorically holds that whatever there cannot be an estoppel against law, number one. Number two, and notice which was void ab initio, which was non-jurisdictional notice from the very starting, the benefit of 292BB is not available. 292BB is a example could be, suppose the firm name is ABC Private Limited and the notice only refers to ABC. Those could be the cases which would be coming under the realm of 292BB. But if suppose the notice itself is issued, which is, let us say, a notice issued to a person who is already dead, or in the case of Maruti Suzuki, where the amalgamation had taken place and the department was aware about the amalgamation and it still issued the notice in the transferor company. So that notice in itself is bad in law, and 292BB will not come to its rescue. Now, when one talks about deeming fiction, one cannot do away with penalty provisions, because suppose because of deeming fiction, there is some additions which one assessee has to face the music of. The broad consensus is that when deeming fictions have been incorporated, brought to tax, then assessee should not be burdened with penal consequences, because that will not come under the realm of concealment or even filing of inaccurate particulars of income, because there is a great deal of discussion, confusion when one talks about deeming provisions. Even court, Supreme Court, at various occasions carry different views. And just to bring to my last, friends, we have been, as students of law, as students of CA, we've always been taught that ignorance of law is not an excuse. So when it comes to professional shoulders, it even becomes even more difficult duty until unless we are not sure about what the law stands for, what the law stands for, we will not be able to guide our client. And it will be a self-goal in case we are not updated with the topics. And I would just say, wish you all the very best. Thanks again to the organizers. I hope I have been able to cover my topic within the time permitted to me. If time permits, we can again debate this topic for hours together, because this is like a ever-flowing river under the umbrella of Income Tax Act. And I'm very, very thankful to the organizers, and I hand over the back to the organizers.
Yeah. Thank you, dear Siddharth. In your presentation, and I have tried to explain all the nitty-gritties of this deeming provisions. I hope this is helpful to everyone. Now I would request our chairperson, Premlata Bansal Madam Ji, to share her concluding remarks in say around 5 to 7 minutes, as we have got certain questions also to ask Mr. Siddharth, so that we can complete the formalities in time. Thank you, madam.
Let it be first questions, answers.
Okay, as you permit me, no problem. So should I take the questions first?
Yes.
Okay. So the first question is, exemption not claimed on dividend income, can the assessing officer disallow expenses under section 14A?
Not claiming exemption income will not be ground for you to get out of the ambit of 14A. Well, ultimately, if there is exempt income, whether you claimed under your computation or doesn't make the difference. As long as you earned exempt income, and if there is anything which has to be disallowed, 14A will definitely come into picture.
Okay, thank you. The second one is, in 43CA, it is generally observed that customer gives the amount and major consideration in previous years and agreement executed later. What is the solution in such cases?
Friends, this situation is already envisaged under the section of 43CA, fully under 50C, where the Act itself says that in case there is an agreement which has been executed in previous years, then that based on that agreement, provided you have received some consideration other than cash, that is to prove the genuineness of that agreement, that is there, then the period on which that agreement was executed, the value will be adopted on that day, not the date when the document is provided for execution. May I also add, for the benefit of the audience gathering, that now under the RERA laws, I think as far as Rajasthan is concerned, the moment the builder receives more than 10% of the consideration from the customer, that agreement has to be necessarily executed before the sub-registrar authority or the stamp authorities. So I think in times to come, the same laws would be broadly there in the various other states. So this rescue of referring to the earlier agreement will be in itself a thing of a past in times to come. But the Act itself gives that situation, takes care of that situation. Thank you.
Thank you. The third question is, one-time amount received at time of divorce is not taxable, but monthly subsequent maintenance received would be taxable. Please confirm.
Yeah, this is definitely a point of controversy. As long as the marriage subsists and there is a maintenance given, no problem. But if suppose some amount is being given on the basis of court decree, that argument can be taken that this is also not part of income. Forget about 56(2), it's not part of the definition of income itself. And it is more or less like a capital receipt received for maintenance of a child or the lady herself. So according to me, even post-divorce, suppose some monthly maintenance is being received, that should be out of the ambit.
Correct. Okay, sir. The next question will be whether 56 subsection 2 is applicable in case of disputed property and leasehold property when property is purchased.
56(2) is applicable irrespective whether the property is disputed or not disputed, whether it is rented or not rented. But these are available for you as a defense to highlight before the assessing authority or even before the stamp authorities for that matter, or before the DVO, that these are the backdrop of the facts and circumstances, and on the basis of which that difference should not be subjected to tax. But as far as coverage is concerned, it is very well covered.
Thank you, sir. And now last two questions are there that I'm going to ask you together. I think so both are related. Actually, I think so there is some confusion in the question, but nevertheless, I'll just try to tell you.
Sure, sir.
can you throw some light on taxability on sale of third-party property held by bank and sale proceeds used to set off loan? And I think so this is continued. Borrower is declared insolvent and there is no relationship between property owner and borrower. They are just...
Yes, these are very, very challenging situations where the property of a guarantor is taken over by the bank, or even a property which is mortgaged with the bank is ultimately auctioned, and no sale proceed comes to the bank account of the assessee. But as far as the provisions of the Income Tax Act are concerned, the moment there is a transfer, it is delinked with the receipt of consideration. The moment there is a person to whom the possession has been handed over and there is a transfer of asset, liability, whether it is a business, whether that asset was held as a business asset or whether as a capital asset, comes to, and whether you have given that property as a guarantor or as a owner of the property makes no difference. Although I would leave ma'am to answer this.
It's a debatable issue.
Yeah, definitely it will be a
debatable issue because nothing comes in the hands of the borrower.
That is where
property
the deeming fiction
is transferred. So whether
section
53A would apply or not, and whether Podar cement will apply or not, all has to be seen. It is not so simple.
Yes. And that is why deeming fiction pinches.
Yes.
Thank you, Speaker sir. These were the questions. Now over to you, madam, to please proceed the deliberation.
Friends, subject is very vast and time is short.
Yes.
But Siddharth has justified both time as well as subject. Siddharth has very well explained the provisions in great details because the Income Tax Act is full of deeming provisions. Rather, it is an act of deeming provision. As and when Supreme Court, highest court decides against the revenue, deeming provision come into picture, either retrospective legislation or deeming provision. So this is the weapon in the hands of Income Tax Department. Many issues arising out of the deeming provision regarding interpretation of these provisions. And the solution of the same depends upon the case study, precedents, and regular fundamental principles evolved by the judges in various decisions. The subject is not very simple. There are so many provisions in respect of capital gain. There are so many issues. I mean, bundle of issues are there. Whether in respect of Section 50, whether beneficial provision of Section 54 would apply or not. Whether 54 EC would apply when stamp duty valuation, say the property is sold for 1 crore, but stamp duty valuation is 1.5 crore. SSC has not received more than 1 crore and he has invested only the amount which has been received under 54 EC. So whether what benefit is to be allowed, at what rate it is to be allowed. There are so many issues regarding holding of period Section 242A and Section 48, whether the previous owners have held the period for which previous owner have held the asset that is to be included in the subsequent owner or not, who has received the property by way of gift or will. I mean, there cannot be enumerated. I mean, number of issues are there, but the time is very short. Time is over and the delegates are hearing, rather intentionally, rather happily or unhappily, the speakers for the whole day. Now I am winding up this. So deeming provisions, we have to, friends, let us deem this Corona period also as an exemplary, exclusive phase gifted by the God. Why I am saying so? Now it is a time to introspect ourselves. It is a time to obtain the knowledge. It is a time to enjoy with the family, to enjoy with friends, rather virtually, and to slow the pace of life so that we can enjoy the life for some more time. Because we were running so fast that we had no time for us. We had no time for our family members. So friends, I want to say 4 lines. If you will hear me, you have to bear me for hearing this. What I want to say, कभी तानों में कटेगी, कभी तारीफों में, यह जिंदगी है यारो, पल पल घटेगी. पाने को कुछ नहीं, ले जाने को कुछ नहीं, फिर क्यों चिंता करते हो यारो, यह जिंदगी है, पल पल घटेगी. बार बार रफू करता हूं जिंदगी की जेब, कम वक्त फिर भी निकल जाते हैं खुशियों के कुछ लम्हे. बटोरते रहिए उन लम्हों को यारो, ये जिंदगी है, पल पल घटेगी. उड़ जाएंगे एक दिन तस्वीर से रंगों की तरह, हम वक्त की टहनी पर बैठे हैं परिंदों की तरह. संजो के रखिए उस वक्त को यारो, यह जिंदगी है, पल पल घटेगी. ना राज है जिंदगी, ना नाराज है जिंदगी, बस जो है वो आज है जिंदगी. इसलिए बांटते रहिए प्यार और खुशियां यारो, ये जिंदगी है, पल पल घटेगी. बांटते रहिए प्यार और खुशियां, ये जिंदगी है. So with this, with this, I hand over the mic to organizers.
Thank you, madam, so much. आपने ये जो इतनी अच्छी कविता बोली, उसको अगर मैं दूसरे बॉलीवुड के रूप में बोलूं तो इट इज एज सिंपल एज कि सोचना क्या, जो भी होगा देखा जाएगा.
बिल्कुल.
कल के लिए आज को ना खोना, आज ये ना कल आएगा. Thank you so much, madam. Thank you for your such a nice deliberation. And with this, now I invite CA Arvind Ramani to present vote of thanks to our esteemed guest. Over to Mr. Arvind.
Thank you, Harish Bhai. Respected chairperson of the third technical session, Premlata Bansal madam, today's speaker, Siddharth Ranka sir, dignitaries, seniors in the profession, and friends. It is a proud privilege to propose a well-deserved vote of thanks to today's speaker, Shri Siddharth Ranka sir, for masterly analysis of interplay between various fictions under the Income Tax Act. Friends, you all will agree that sir had enlightened us on various integrities of the provisions and enrich us with knowledge and also answer all the questions. Thank you very much, sir. Thank you very much, sir. Respected chairperson of the session, Bansal madam, we all thank you for your sparing valuable times and chairing the session and conducting the proceedings of the session. Thank you, ma'am. On behalf of the all consortium of the association and delegates of this first ever national level online tax conference, I propose a very well-deserved, very hearty vote of thanks to today's speaker and the chairperson of the session. Thank you, sir. Thank you, ma'am. Thank you, one and all. Thank you very much. Thank you.
Thank you, Mr. Arvind. Sorry, madam, please. Yeah, thank you, Mr. Arvind. And now we have come to end of our day 1 of virtual National Tax Conference. We shall now meet tomorrow on day 2, sharp at 10 a.m. in the morning. All are requested to use the link that we have already sent you in your WhatsApp messages and emails. Thank you once again. Good night. Stay home, stay safe, use masks, follow social distancing, and take care. Bye-bye. Thank you to all. Thank you to one and everyone. Thank you.